Apple.com.
Chinese state media reporting authorities have removed the head of its Securities Regulatory Commission. The new regulator, Wu Qing, is a banking veteran who earned the reputation as the broker butcher when he led a crackdown on traders in the mid-2000s. That change comes amid a sharp sell-off in the nation's stock markets. The United States and China held their third meeting of the Economic Working Group this week in Beijing to talk about economic challenges facing both countries. Our next guest says that the U.S. needs to figure out what exactly it wants from China economically. Joining us right now is the Council on Foreign Relations President, Michael Froman. Of course, he's also a former U.S. trade representative. And Michael, thanks for coming in today.
Thanks for having me.
You're probably right. I don't know that we know entirely what we want from China. I'm not sure China knows what it wants from us either.
Look, I think that's right. In the short run, I think both countries just want a stable relationship. They want to get through this year, getting past the Taiwan elections, getting past our elections without any major blow-ups. I think the question is, over time, when we get past this year, what is it that we want to try and resolve? Right now, it's good that they're talking, they're having dialogue, but it's not going to really resolve any of the underlying, it's unlikely to resolve any of the underlying issues, including China's building overcapacity in critical sectors like electric vehicles.
And not just building overcapacity. I mean, I think there are a lot deeper issues that come, and us reassessing our relationship post-COVID, too. There were all kinds of trade wars that were already taking place before. Then you add on this idea that we suddenly realized we were a little too reliant in our supply chain on China. Even if we say we're not decoupling, we're actively pulling back. And it's not just the United States, it's all of these multinational companies, many of them based in the United States, that are looking and saying, we need to diversify. What kind of pressure does that put on the relationship as well?
Well, I think there is that effort. That's good risk management to be diversifying your supply chains.
Very good risk management, but how do the Chinese see it?
Well, the Chinese aren't happy about it. They're trying to get U.S. companies and other multinational companies to come back into China. On the other hand, they're sending quite schizophrenic messages. On one hand, they're saying, please come back, we need the investment. On the other hand, they're detaining foreign executives, they're raiding offices, and a lot of businesses are very concerned about whether they can continue to do business,
Michael,
whether it's investable.
When we heard President Xi said, and we've had some obviously issues recently with China, but when he said, listen, guys and gals, that the world is a really big place and there's enough room for more than one superpower. And we really aren't harboring any ill intent towards the United States. And we can both coexist going decades into the future and kumbaya, and we'll sell to each other and our consumers will both benefit. Can we believe, is that true? Do you think there's some version of that's true, or should we just really have a much more, take off the rose-colored glasses and know that China would like to supplant us as the leader?
I don't think we should have rose-colored glasses on. I do think President Xi's been quite explicit. He wants to dominate certain key technologies, certain key sectors, and it's important for us to maintain the competitiveness in those sectors.
But is it a healthy, nice competitiveness where both can benefit, or do they, COVID, they closed down flights within their own country, allowed flights out of the, was that intentional? Was that really as devious as it seems, or not?
Well, I'm not sure I would comment on their deviousness. I would just say what we've seen in COVID is actually the weaknesses of an autocracy. Right. They aren't able to make good decisions under pressure.
Michael, let me ask you a potentially delicate and very political question, which is, in China, President Xi, you think he would prefer, as he looks at this presidential election and what's going to happen next year, so it may be that this year he doesn't want to do anything, but they are watching this election in the U.S. very carefully. What do you think their preference or his preference would be for who the next president is, and is his preference, whatever it is, a good thing for America, for America, or does that mean it's bad for America, and how should we think about that?
Well, look, let me answer it this way. When we talk to allies and partners around the world, but also our adversaries and our competitors, they're concerned about two things in the United States. One is the rise of isolationism, and we see that it's not about any particular candidate, it's across the American people. There is a theme of isolationism out there. And the other is our political dysfunctionality. Right. And I think they would be very happy if we were more isolationist and more dysfunctional in our politics, because it gives them more runway to expand and to expand their power.
Well, then they're happy.
So which candidate are you suggesting? You're saying that Trump is more isolationist? Well, more dysfunctional? Is that, and you think they would like that?
Chinese officials over time have told me they would be very happy to have a President Trump in office because they think that it would create tension with our allies and we would be focused inward, and that would give them more room to. But I think both Trump and Biden have pursued quite similar policies in terms of standing up to.
But here's
to
the thing that I can't understand, which is the argument that Republicans have made is that we've now had a number of true geopolitical problems emerge on Biden's watch. Whether they're idiosyncratic and have anything to do with Biden or not, we can debate, but there's a view that's been put out there that maybe there's a power vacuum or something else, and you know, we saw what happened in Israel, and Putin's taking advantage of Ukraine, things like that. Do you think that that's the same case, meaning if we put this year aside on the Taiwan issue and put Taiwan back on the table in 25, what president of the United States keeps China in a box and which president doesn't?
Well,
or do they both? Or do neither?
Like I have faith that the U.S. will pursue the strongest policy vis-a-vis China, regardless of who's in the office
Do
there.
you? You have faith that it's exactly the same?
No, it's not the same, but I think that what President Biden has done is strengthen alliances. Certainly NATO is much stronger. If you look at the Asia Pacific, what's happened with AUKUS, the alliance with Australia and the UK, the trilateral agreements with South Korea and Japan, the Quad that brings India into the Indo-Pacific, into a security arrangement. I think those are all important contributions that this administration's made to strengthening security across the region and standing up to China. I think those are very important innovations.
NATO should pay more, though.
They should. They should. Some countries have finally stood up to the 2% of GDP that they're supposed to spend on defense, and there's a longer way to go.
Before you go, got to ask, I don't know if you're going to answer. He's on the board of Disney. Nelson Peltz. If he was on your board, do you think it would change the dynamic of the board in a materially bad way?
Look, all I would say is I think Disney has gone through one of the most difficult periods of its history. I think we're incredibly fortunate to have Bob Iger and the management team there who've put creativity back at the center, who've cut costs substantially, and who are dealing with a bunch of really complex strategic issues, including the one you talked about earlier today around sports. So I think the management team is there, the board has full confidence in them, and I think we're on the right track.
You learned a lot in Washington. That was a good answer.
Michael, thank you.
Thanks for having me.
Squawk Box will be right back.
Coming up, a major game changer in sports media. ESPN, Fox, and Warner Brothers Discovery teaming up to create a sports streaming service. And check out the potential winners and losers when this happens, if it happens, next on Squawk Box. Disney's ESPN, Fox, and Warner Brothers Discovery are teaming up to launch a joint sports streaming service later this year. Joining us now is Puck's Matt Bellany, and offensive, defensive, a lot of nuance to this, I think, Matt. It's like it does help to pool resources with an uncertain future.
Absolutely. A lot of uncertainty and a lot of questions still remaining. And I think Bob Iger is going to have a lot of those questions on the earnings today because, I mean, this is a massive gambit here. I mean, this is the same as when these studios teamed up to launch Hulu, I mean, more than a decade ago. It's basically Hulu for sports, which is a bet that by pooling their resources in streaming, they can get the customer to pay a big price for sports year round. And that's the big question here. What is the price of this service? Because we don't know yet, and it's probably going to be pretty hefty.
Well, other bundles can run $100. I thought it'd be 100. Everybody's telling me it's going to be more like 30 or 40. What do you think?
My bet is in the 30 range, 30 to 40. I think that it's going to be substantial. And listen, Fox does not want to kill the cable bundle here. because that is the big question. The sports has been holding the cable bundle together, even though it's going down. It's still being held together and profitable for these companies, not forever, but for now. And if you price this too low, all those cable subscribers are going to quickly switch over, and you're going to be left with not much. It's also damaging. Remember, this is not all the sports. The NBC Universal and CBS sports packages are not included in this. They have football, and it's potentially very damaging to those companies if this is priced low and everyone goes over and out of the bundle. So, there's a lot left to, and also the logistics. Who's gonna run this? There's gonna be margin between this new entity and these owners, and they're all still competing against each other for the sports rights. The NBA's coming up, and Disney and Warner's are competing against each other for these NBA packages. Now they're also potentially here partners.
So if Comcast, CBS, NBC, if they call a meeting today amongst themselves, what do you think? If you're a fly on the wall, what's Brian Roberts saying? What's going on in those meetings? What's the answer?
He's asking a version of what you just asked. What's the price? Because that is the key question here. If they lowball this and the price is very low, that's a scary proposition.
But Matt, I think at least from my reporting, it's impossible for the price to be lower than what they're selling those channels on a sort of a la carte or grouped basis. Now, there could be a little bit of fuzzy math because some of these things are sold as packages, if you will, to the cable operators. But because of these favored nation clauses in the carriage agreements, it can't be that low.
No, it's not going to be super low, but the question is how much above that. And keep in mind that these channels are coming as they are, meaning there's going to be other programming available here beyond sports, even though sports is the goal. And the split amongst these three companies is also important because they're saying that this is going to be a 1/3, 1/3, 1/3 proposition. But if you look at what each is bringing to the table, Disney in particular with ESPN is bringing a lot more to the table than, say, Turner Sports, which really has the NBA and it has some Major League Baseball, March Madness, and a couple other things. Disney has big NFL packages. They have Monday Night Football, and the Fox has Sunday night or Sunday afternoon football. So those are much more alluring. How are they going to split that up? Disney says they're going to get more ad revenue out of this, but it's a very complicated line they're going to have to walk here to make this fair to everyone while also representing what each is bringing to the table.
Very weird, Matt. It should be the golden age of sports with the way betting is coming into all this and engagement and fan engagement. I want to see every single game. It's just weird that it's being squeezed. It's the same the nickel story that the pipes are. I don't know. So why everybody should be benefiting, but that's not the way it's going to be. There's going to be cost pressure.
Because of the price. It is so expensive to buy these rights, and you are renting them. I mean, that's what Netflix has said at the beginning. The reason they're not in live sports is because you're renting the rights.
Travis Kelce, you're happy, I think.
Yeah, I mean, that's the thing. Players in the league are happy.
Yeah, the Trojan horse to capture the other channels. That's, I think, the point that Matt's making. That's super important to think about.
All right, Matt. Thanks.
We've got a lot more coming up in just moments. Uber releasing quarterly results. We will have those numbers. And then we've got CEO Dara Khosrowshahi joining us next in a First on CNBC interview when we return. Squawk coming right back.
more energy.
Good morning. Investors parsing earnings at the midpoint of the reporting season. That, coupled with Fed speak, have the futures little changed ahead of the open this morning. We do have some news to focus on, though. Snap pulling back more than 30%, and its ad business struggling to keep up with Meta. We'll break down what it means for the company and other social media stocks. Plus, Uber delivering quarterly results. We will speak to CEO Dara Khosrowshahi. The second hour of Squawk Box begins right now.
Good morning and welcome back to Squawk Box here on CNBC Live from the NASDAQ market site in Times Square. I'm Joe Kernan along with Becky Quick and Andrew Ross Sorkin. And here are the futures. You have to be somewhat impressed with sort of the beach ball tendency of the futures. Looks like the Fed definitely not going to be as accommodative as the market was thinking 6 weeks ago. And yet the sell-off seemed to last a day, and it happened on Monday, but came right back yesterday. This morning, you're seeing a little bit of weakness in the Dow, down 32 points or so. NASDAQ, though, is trading higher. A lot has to do with yields, and we have seen a little bit of backup in the 10-year now, back to about 4.13%, Andrew.
Meantime, ride-sharing app Uber beating on both the top and bottom lines. Earnings of 66 cents a share, easily topping estimates of 17 cents. That's on revenue of $9.9 billion. Uber now seeing gross bookings in the range of $37 billion to $38.5 billion. That compares to estimates of $37.4 billion. And joining us right now, first on CNBC, Uber CEO Dara Khosrowshahi. Good morning to you. First full year of GAAP profitable earnings. Congratulations. If there's any question about the health of the consumer, it seems like it's pretty healthy. Is that just one slice of the world, or is that everywhere?
Well, when you're talking about Uber with over 2.6 billion trips and 28 million trips every single day, it really is everywhere. We're a global company, as you know. We're a leader both in mobility and delivery around the world, and we continue to see consumer strength, and especially consumer strength as it relates to services. People are going out to dinner, they're going out to concerts, sports events, etc. And when people go out and they spend money, or when they want anything delivered to their home, Uber benefits, which is why you've seen gross bookings of $37.6 billion, up 22%, which is actually an acceleration over the last quarter. So we see a lot of consumer health, and certainly we see health in the system as far as spending on the Uber services.
Do you see any shift in terms of how people are using the service, meaning on mobility, for example, going from X to Black? Are they upgrading? Are they downgrading? I mean, and what kind of, when you think about the Uber consumer, if you will, what strata in sort of an economic strata do those people live in? Is this a luxury good, do you think, or you think it's much broader than that? 26 million trips is enormous.
Yeah, it is broader than that. And what we do is we target different demographics and we build different services for different income strata. So, for example, one of our fastest growing products is Uber Reserve. And you pay more for greater reliability. The driver shows up early, and you have that comfort to know that the Uber is going to be there. A lot of people take it for travel, and that's a product that's targeted for a higher demographic. At the same time, we've introduced UberX Share as well, and we continue to expand UberX Share across markets where you potentially share a car with someone else, and you get a discount when you're matched up with someone else. That's for someone who wants more affordable travel. And actually, the consumers who take our most affordable options, whether it's UberX Share or high-capacity vehicles, they tend to have the highest frequency on the platform because we become a necessary part of their everyday life, so to speak. On top of that, we've got our Uber One membership program, which is, if you're an Uber One member, you get discounts both on mobility and on delivery. We've got 19 million members now, and that's another way of bringing prices down as some consumers feel the pinch of inflation.
On the share business, is that a lower margin business with the goal of eventually upselling those folks? Is that a higher margin business because you're packing a whole bunch of people into the same car? How do the economics of that Is that where
Yeah,
they
it's
work?
definitely lower margin business. We essentially are investing. We think it's good for the world in terms of the environment and congestion for two people to share a car. We think it's a significant growth vector for us as we continue to look for ways to grow the business. And we want to reach out to that younger demographic who may be looking for a more a lower price transportation option that's still on demand and still safe. So it's an investment that we're making in the long term. Absolutely.
So we just talked about mobility. That's folks getting in a car, whether it's a Uber Black or Uber X or Uber Share, whatever. Let's talk about Uber Eats, though, and some of the other services and the competition both with the DoorDashers in the universe. And increasingly, it seems like, given some of the grocery business, with Instacart.
Absolutely. So we're very pleased with the progress that we made with Uber Eats. Uber Eats actually has been accelerating its growth, up 17% in terms of gross bookings this quarter, and has really been accelerating throughout the year. And it's a reflection of the breadth of Eats now. It's not just about food. We've got a great Super Bowl ad that talks about that. It is now about grocery as well. Anything you want, you can get on Eats. And one really interesting innovation that we're pushing now is when you order your food, we may say, Andrew, do you want a bottle of wine with that comes from a local liquor store? Or do you want some dessert with that, et cetera? We're augmenting your restaurant order with a grocery order to show you what we've got. And then we've got a ton of consumers coming back and saying, well, if there's grocery on Uber Eats, you already know me, you know where I live, I trust you, et cetera. Why don't I just order groceries on Uber Eats? That's now running at 7 billion, growing more than 40% on a year-on-year basis. It's a new initiative that we're very excited about.
I asked you about margin on the different cars. Now I want to ask you about margin on delivery. What's that look like right now?
Well, margin is improving in delivery, so we're solidly profitable. We had a record profitable year. The mobility business has higher margins than delivery, but we're quite confident that delivery margins are going to continue to expand. Some of that is augmented by our advertising business. Our ads business now is over a $900 million annual run rate. As you know, advertising is close to pure margin, and we bring a huge audience to both Uber Eats and Uber Rides. And advertisers are more and more interested in targeting those eaters and those riders.
We talk about California because there's some new rules put in place that impact minimum wage. And we've had this debate with you, and it's been sort of a question about gig workers for a very long time. There's now a minimum wage in California set to go to $20 an hour in April. It's a 25% increase. This is at some of the restaurants and the like. But how is this going to impact what you're doing?
We don't think it's really going to impact what we're doing. As you know, in California, we have Prop 22 that similarly does provide earnings benefits and minimums for our drivers, along with other benefits. And we think that's what Uber is about, which is flexibility of work and then safety in terms of what minimum earnings come in and our other benefits. So I actually think things are moving in the right direction in California, certainly for Uber. We'll see what happens in terms of this minimum wage for the restaurants.
You have a Super Bowl commercial. It's a coming.
Yeah, absolutely.
How much is it costing you this year?
I'm not going to comment on the cost because it would alarm me too much, but we have some great stars in there. We've got David Schwimmer and Jennifer Aniston coming together, and then I'm a huge soccer fan, so we've got the Beckhams as stars as well. It's highlighting, again, you can get anything that you want on Uber Eats, including groceries, including alcohol, and it's a lot of fun. Can't wait.
Let me ask it to you this way then. Is it more expensive to produce the commercial, meaning to pay all the celebrities and everybody who's in the physical commercial to make a commercial, or is it more expensive to buy the airtime during the game?
The airtime during and around the game, I think, is the greatest expense. And what we do too, that it's not just about the game time commercial. This commercial actually is going to spawn a campaign that you're going to see over the next 3 to 6 months. So it's just the start. You know, some brands kind of do one campaign and that's it. For us, it's a campaign that carries on. It's stories with the various stars that we think make it well worth the investment that we're making.
Tara, this is kind of tangential, but we've been talking a lot this morning about sports rights with this new deal that Disney's putting together with some other partners for ESPN and the sports rights. Why is it so valuable to advertise on a premium sports event like the Super Bowl? Why does that make sense?
Well, because it's one of the few times when you have broad cross sections of populations coming together with very, very wide demos, men, women, from all over the country. And those moments are few and far in between. And again, if you're just buying for that moment, the price isn't worth it. But the buzz that comes in, all the attention in terms of your brand and your ads, and then the campaigns that follow on, in addition to the stars themselves amplifying your advertising with, on their own social media. That actually is a new feature of these advertisements. You used to have stars, but now the stars themselves are very, very strong media vehicles. I mean, when you get the stars actually using their own brands, you get return for your money.
Right. By the way, how big a day is the Super Bowl for Uber itself? Meaning, folks going to each other's homes to watch the game, all the deliveries. I mean, is this 5% of your year in one day?
No. I mean, our business is way too broad for that. But it's a top 10 day for us in the U.S. It's big both for riding, so that people want to be safe and they go to Super Bowl, eat and drink, and have fun. So certainly at the end of the game, our rides business has a big boost, and then during the game, certainly our eats business has a boost as people order wings and everything else that you have in the Super Bowl.
And for those analysts who follow Uber, is there a Taylor Swift effect? Can you describe a Taylor Swift effect to this past year?
Oh yeah, I mean, her concerts were events in and of themselves, and when she came into town, we actually have our local teams planning specifically for what's not just happening at the event itself, but the surrounding hotels, etc. Uber definitely ups its game for Taylor.
But should an analyst then make that like a one-time earnings situation, or should we give you a multiple for that?
It's again, when you're talking about billions of trips a year, we're almost at 10 billion trips. Taylor Swift is a positive, but it's not enough to show in the overall trends.
The good news is you still have our concerts coming up the rest of this year. So
looking forward to that.
Thank you very, very much. It's great to see you. Congratulations on the numbers, and we'll look forward to seeing you again soon.
Thank you. See you soon.
When we come back, renewable energy company Avangrid making the Just 100 list for the second year in a row. It's the top utility on that list, and the CEO will join us right after this break to talk about the business and the issues that matter most to investors. Snap plunging on a revenue miss. The company's struggling to get its ad business back on track. We will talk about it in just a few minutes. Squawk Box will be right back. Welcome back, everybody. Earlier this week, Just Capital announced its annual Just 100 list of America's best corporate citizens. Sustainable energy company Avangrid achieved the top spot among utilities and placed 12th overall. Joining us right now is Pedro Azagra, who is Avangrid's CEO. And Pedro, welcome. Thank you for being here with us today. What do you think puts you in this Just 100 list?
Thank you very much. A pleasure to be here. And the first thing is the work of our women and men. I think, without them, we would not be here. We were the 224 in the list, a few years ago. I think we are right now the number 12, but also we are the number 1 in the utility, and we were before 16. So women and men, doing their job is, what brings us here. And thank you to CNBC and also Just Capital, because these are the type of rankings that we're not used to, but also very important for our society.
Why don't we talk about Avangrid's business and what you all are doing just in terms of renewables? Renewables is a place a lot of money is kind of funneling into these days, but a lot of it's driven by government initiatives and government funding. How important is that government funding, and what happens if governments change and decide that they are no longer going to pursue those same initiatives?
As you know, there are many ways of helping renewables development. In different countries, different approaches. I think in the US, there is a tax-driven mechanism. You have production tax credits, you have investment tax credits, tax equity is available. That's important. The history right now is that it has never been an issue for any of the two major parties in the US. It's always, you are okay with this, but you negotiate other things. As long as, that remains there, the industry will continue. In our case, we're on the road, to achieve, 10,000 megawatts in the US in renewable energy. We are right now in excess of 9,000 megawatts. And globally, being part of, Iberdrola Group, with the leadership of Chairman Galan, we're approaching more than 40,000 megawatts. So I think we are already contributing to the world.
But your point is that if the government funding wasn't there, this would not be a booming business. It has to be supported by governments at this point.
Part of the development has to be, helped, to make sure that happens. But also part of the assets, you already do PPAs. So you go straight to the market. You have customers, big customers, people that you interview quite often. We have PPAs with them as well. So you have a combination of, just, market, but also, some help, from a production point of view for the major projects we are doing.
Where are the biggest hurdles right now? I mean, most of the time when you talk to people about trying to change things, and it's the grid that is the underlying issue, trying to get power from where the wind blows to where it doesn't, trying to get power from where the sun shines to where it doesn't.
I think in the mini meetings we're having with both the federal government and many states, I can tell you they are very, very focused on these issues. The first one is permitting. I mean, the amount of permitting you need, it takes years. It takes probably 5-8 years to do an offshore wind park. It takes 3, 4, 5 years to do an onshore park or solar. The permitting is critical, so that's one of the issues. The second one, as you were saying right now, is also, what I would call litigation. I think in the US, everybody litigates. It's quite, normal to have litigation for everything. That also delays, the projects. So from our point of view, it's not access to capital. It's just predictability and permitting. Regulation is key. If you change regulation every year, things do not work. If you have a predictable framework, then things will be invested, and you will have, the reality in the assets.
Yeah, especially when you're talking about billions of dollars in investments. Those are not things that companies do lightly, and having stability over time definitely makes a big deal. Pedro, just last month, you all ended a merger deal that you had put through and planned with PNM Resources. That was a deal that had been in the works, I think, since October of 2020, so it's years in the making. PNM wanted to extend the deadline for that deal to get done. You all chose not to go that route. Why is that? You think this was something that was never going to get past regulators?
I think there are moments in life that you just need to move on. I think we've been 3 years. We have 23 out of 24 parties either supporting or opposing the deal, and still we had a negative reaction by a public commission. The public commission changed, but after 3 years, we're still waiting. We were still waiting for the public commission decision now after, the Supreme Court that we were waiting. So it's basically a moment that after, so many delays, we didn't have certainty on the timeline. And that was the decision. But at the same time, last year, we were very successful in upgrading networks in New York. We have a rate case, Maine as well. We actually put, more than $9 billion with, both renewables and networks of additional investments for the years to come. $9 billion is a lot of money. So there is a moment, I think, when you don't have certainty and clarity in timelines, you just need to move on.
Does that give you any sort of fear factor in terms of attempting another deal?
Well, I think when you have organic investments, probably more than 20 billion for the 5 years ahead of us, both in networks and renewables, that seems to me more than enough to focus on. So if we were not to have that pipeline of organic investment, then maybe we'll think about something else.
Pedro, thank you very much for joining us again today. Pedro Zagra is the head of Avangrid, the CEO there, and we appreciate your time.
Thank you.
And coming up, Snap, struggling to get its ad business back on track. The stock plunging following its latest report. We're going to talk about that when we return. The futures right now have worsened a little bit, down about 52 points now on the Dow. NASDAQ remains higher. We'll be right back.
Time now for today's Aflac trivia question. In honor of National Women in Sports Day, who was the first long-distance woman swimmer to cross the English Channel in both directions? The answer when Squawk Box returns. A member. And now the answer to today's Aflac trivia question. In honor of National Women in Sports Day, who was the first long-distance woman swimmer to cross the English Channel in both directions? The answer, Florence May Chadwick. The California native swam across the channel in record-breaking time in 1950 and again in 1951.
ESPN, Fox, and Warner Brothers Discovery are launching a sports streaming service this fall. It's going to include offerings from at least 15 networks and all 4 major professional sports. A name and pricing will be announced at a later date. And it's expensive to name something. They pay, and we've made fun of people that spend a lot and then they just do like a combination of the two. There's no combo.
Or a brand new word.
Got to be a brand new name.
Like Venator?
Venator or Verizon.
Verizon.
But you can't do a Warner, Espin, Fox. There's no. That's not going to work. It's going to have to be new. So I could see paying a lot for this. It's important. You got any ideas?
No.
It's hard. It's hard work.
I know what
Hard
sports
work
center-
being a decider, being the
Sports Center's
strategery.
take something that already exists on ESPN.
It's going to be hard. It's worth
Yeah,
how
it
much?
can upset the others.
Right.
Sports Center.
No, but you got to pay how much?
it's a
How much
basic,
you got to pay? You think for
straight up
that?
name.
And who do you go to for that? Where do you
This package, I
advertise
think
it?
it's I think it's $39.99.
No. Who do you go for the name? Who do you pay to come up with the name?
Consultants.
A consultant. And how much does it cost? $5
And
million?
$19.99, you go on to ChatGPT.
Yeah.
That's a
Why don't you try that? What would you name the streaming? Whoa! No! Now, what's your problem, Greco? I was going to read it. All right, we're not going to say anything about, tell you anything about the actual service. So, in case you don't know, but we will tell you, Iger's going to be on Closing Bell tonight after the company reports results. And Hugh Johnston, the CFO, new CFO, relatively new CFO, our old friend, it was at Pepsi. He will be on tomorrow, Disney CFO, at 7 a.m. Eastern time. When are you going to have an answer for me? Is it going to take a while, Sorkin?
Hold on.
Because think
we go.
of
You
some of
ready?
the great names. You know what I was thinking is a great name? Uber. Whoever came up with that.
Okay, hold the fort. The Triple Play Sports Bundle they're offering.
Okay.
All-Star Sports Pass.
All-Star Sports Pass.
Champions League Package.
Champions League package.
Ultimate Fans.
Ultimate Fan.
End Zone.
Enzo. You know what?
Victory Lap. Cable Collections. MVP
Sports Center's
Sports
better.
Suite. Arena Access Pass.
This is
Primetime Players
This is
Network.
amazing. This is amazing.
Global Goal Line.
This is much
Package.
better than
The
I
goal
could
line.
have.
You could call it the goal line.
Yeah.
That's actually pretty good.
So those are 10 for now.
And
So
that's
if you're listening,
$20 million worth of like ridiculous McKinsey, you know,
did it in 1 minute,
babble.
and I think I pay $19.99 a month for your ChatGPT. So there you have it.
There's one in there that would work. It's as good as what they're going to come up with. You know that.
Awesome.
Now I can't wait. The pressure's on. If somebody does get paid to come up with something, it has to be better than
It has to be better than Andrew's 10. And
All right, in the meantime, Alibaba is reporting its fourth quarter results just moments ago. Revenue falling short of estimates, but the company is boosting the size of its share buyback program by $25 billion. You can see Alibaba shares up by about 0.8%.
Coming up, Snap's advertising business struggling yet again. We're going to talk about it after the break. And then later, Minneapolis Fed President Neil Kashkar is going to be our special guest. We'll talk about the Fed, and maybe he's got a name for the sports package. I wonder if Sam Altman's going to get a vig on this if he were to use one of these things, you know? Squawk Box returning in just a moment.
Hubble.com.
Yeah.
All right, welcome back to Squawk Box, everybody. Check out the futures this morning. Looking at a mixed picture right now. Dow futures off by just over 30 points. S&P futures are flat. The NASDAQ is indicated up by about 25.
Really looking forward to the name now.
Well, Andrew's got more names.
Well, we got more names,
got
so
a
we're going
bunch
to
of
try
really
them
good ones.
out. I think, Bob Iger listens and watches the program, as does Zaz and some of the others.
Thrillix?
So the other names that are on offer, Thrillix, which I kind of like, Thrillix.
Thrillix.
It's its own word, super unique. I don't
He
think
has
you've
better
seen that
ones, I think.
before. Sportify X.
Sportify, I like.
Sportify, and they have like Sportify X. I
The
think that's coming up
Fanatics
better.
one is good, but you're right.
Fanaticore, Michael Rubin
Fanatical
might
Michael
not-
Rubin's not
he
going
might-
to
he
go
might
for that.
sue over that.
But it shows you how good Fanatics was as a name.
ScoreStream, one word, ScoreStream.
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 ScoreStream, it's a streaming service.
It's hard to say, kind of.
ScoreStream, one word.
What about SportsStream?
Vortexa, Rally Roots, Windwave,
When are we going to know?
Athletic. How about Athletic?
That sounds
like
like,
Metaverse,
that sounds too much
Athletic.
like Athleta, the clothing company
Okay.
owned by Gap.
Yeah, the producer just said, how about moving on?
Moving on.
Moving on. How about get to the next segment, Donna?
Yeah, this is going to be. I'm not, but I'm really looking forward to what the name is now. I'll just say that.
I
And
hope
the
it's
price.
something you just said.
That would
Well,
be amazing.
I'm sure we have some great Squawk viewers who might be playing on X right now or something, who might send in their own. Maybe they're
Which,
doing
by the way, is a
X.
really crappy name.
Which X?
Yeah. Snap revenues missing the mark, shares plunging on the news. The company has struggled to navigate a slowing digital advertising business. Joining us now with more on the ad landscape, Tal Jacobson, CEO of Perion, and we were shaking our heads, Tal, and I'm interested in your view on exactly what's happening here, company specific. The war in the Middle East, the weather. What do you attribute this to? They've had trouble quarter after quarter trying to grow digital ad sales. Other companies haven't had quite as much of an issue, it doesn't seem like.
Right. Thanks for having me, first of all. I think social platforms such as Snap, TikTok, especially within war, are just becoming news portals, right? So for advertisers to advertise there, with all the negative content, it's just becoming harder and harder. So I think that was a big thing in Q4 for them. But they did grow their user base. I just think the content wasn't the right content for advertisers to be associated with, as brand safety is a big thing.
The stock had been trying to make a stand and rebound from the stratospheric levels that we saw during the pandemic. I think it was a $70 or $80, almost $100 billion company at one point. So it was making a comeback, giving it all back today. What do you think that management needs to do to get this back on track? What would you be doing? You have your own company.
Right. So I think what they're doing now is laying off 10% of their employees is the first good step to be efficient. Reddit are probably going to go public this year. So I think they're going to have the same issue, telling advertisers that they are ready to be brand safe. I think that's the bigger issue. And that once they have that, they have the demographics, right? They have Gen Z, they have millennials, the user base is actually growing. They just need to have better communication with the advertisers.
Who would you say, in as far as digital ad revenues, who knows who's the best? Who should they emulate at this point? Give me the top three companies that are leading here.
Right. So obviously Google showed a great growth. Meta showed a great growth, and Meta knows how to deal with sensitive content around it. I think I would look at how Meta solved that issue and tackle that.
As far as the overall environment now, on a scale of 1 to 10, what is the rebound that we've seen in digital advertising? If not digital, then where is it going right now? The Super Bowl?
Well, obviously Super Bowl is a very interesting event. I think 2024 is big on all those events that are going to attract a lot more advertising budgets, right? Super Bowl is the main thing. But we also have March Madness. We're going to have the Olympics. We're going to have the political budgets, which are expected to be about $17 billion. So yeah, and I think, it's interesting to see how the Super Bowl actually changed in demographics within the past few decades. I mean, it's a lot more female oriented. It's like half of the viewers are going to be female. And, with everything goes on with Taylor Swift, a lot more cosmetic companies are going to advertise there. So it's very interesting. Obviously, out of home is becoming very, very big. The Las Vegas Sphere, which is now charging $1 million for a spot. All of those are growing. So I think 2024 for digital advertising is actually a good year.
It did bring in, obviously, the ads themselves bring in a cross section of society for the Super Bowl. But this year, as you even just talking about it in passing, you brought up Taylor Swift. So the female demo, and I'm not saying that there's not male Taylor Swift fans, but just in my family, I cannot believe how interested people that didn't used to be that interested in football. I can't believe how much they're looking forward to this game because of the Taylor Swift effect.
I mean, look, think about it. Like 20 years ago, Budweiser was a big advertiser, right, for the Super Bowl. Now it's cosmetic companies. So that shows you, the shift, the huge shift. And it is, at the end of the day, it is an entertainment event, and it's being treated that way, which is good. I think it's good. 46% females, and a lot of millennials and Gen Z, which is kind of new. I'm guessing Taylor Swift had something to do with that. And yeah.
Yeah, it should be record ratings and 7 million for a 30-second spot. We're still debating a squawk ad, aren't we? What have we raised?
$12.66.
We got Sorkin. Can you thinking about, should we do a squawk spot? 7 million for the Super Bowl? How much can you help? No, probably.
I'm gonna lose. I'm not
Yeah,
with this.
Thank you. Yeah, we're not going to be someone
The opposite day. Whatever I say, you should do the opposite of
Squawk Sports is not going to be the name of this.
No,
thing.
but Twitter has come up with some really good proposals for this sports streaming
Yeah, what do you got?
project. Trifecta,
It's not bad.
Band Fusion Sports, Score with an exclamation point at the end of it,
I
and
think
then
Score is not going to be trademarkable.
maybe not. The Control Room with Paul DePavio came up with one too.
Yeah, what's that?
Athletic supporter.
That's not bad. That's not bad. But totally not surprising that DeFabro would come up with that. Yeah.
They reported it to me. Anyway, keep the suggestions coming. We'd like to prove that, yes, we too can do the work of consultants. When we come back, New York Community Bank under some pressure again this morning, and Janet Yellen making some comments. We will bring those to you. We'll be right back.
My maternal grandmother was one of 6 sisters, and they came from Columbia, South Carolina, and we called them the Lewis girls, and they were fiercely independent women, and I really, because of them, grew up believing that I could be anything that I wanted to be, so having that foundation was really incredibly important.
things they never thought they could.
Look at that beautiful shot of New York City this morning. More concerns about the future, though, of New York Community Bancorp not looking as pretty. Moody's Investor Services downgrading its credit rating on the bank to junk status, saying the company's commercial real estate lending significant losses on its office and multifamily properties could create potential confidence sensitivity. That's in quotes. The tumbling stock now is down, well, this morning up again, but in the meantime, the company reported larger than expected losses from real estate lending, and NYCB's CEO responding to Moody's saying the downgrade isn't expected to have a material impact and its deposit ratings are still investment grade. It says as of Monday, NYCB has about $17 billion in cash on its balance sheet and $83 billion in deposits. Treasury Secretary Janet Yellen was asked about the troubled lender. She commented on the situation without mentioning the bank's name.
We are monitoring current banking stresses carefully. Commercial real estate is an area that we've long been aware could create financial stability risks or losses in the banking system.
New York Community Bancorp is the 7th largest originator of residential mortgages and the 5th largest subservicer of mortgage loans. Meantime, when we come back, a CNBC investigation looking into whether investor-owned utility companies are properly assessing the risks that wildfires pose to their operations. CNBC's Brian Sullivan is going to join us next with that story and so much more. Squawk Box rolls on.
Now, a CNBC investigation. It has been nearly 6 months since the devastating wildfire in Hawaii. That fire, along with PG&E's massive fire in 2018, are raising more fears that utility companies are not properly assessing the risks that wildfires pose to their operations. Also, that investors in those companies are doing the same. Brian Sullivan is here, and he has more. Brian?
Yeah, thank you very much, Becky. Hawaiian Electric, which is Hawaii's investor-owned utility company, is facing allegations that its infrastructure caused the wildfires that burned Lahaina and left at least 100 people dead. The company's stock has collapsed. Some people say bankruptcy is a real risk, and Hawaiian Electric is not alone. Experts say these wildfire risks have not been priced into many utility companies' stocks. Here is our report.
Michelle Glogovac remembers November 8th, 2018.
It completely went up in flames.
It was the day her childhood home and much of Paradise, California were destroyed in a wildfire caused by utility giant PG&E's infrastructure.
For it to have moved so quickly, so fast, it was unheard of.
She was just running and terrified.
For Brent Jones, that day was August 8th, 2023, the day his aunt, Lori Allen, ran through a burning field to try to escape the deadly Lahaina wildfire.
Hawaii officials are fearing the worst as the sun comes up in Maui.
Your Aunt Lori was the 98th person to pass away from the Lahaina fire. And I would imagine that her 53 days in the hospital with 70% of her body burned were pretty difficult.
There were a lot of days that were just really very difficult. She was in extreme amounts of pain.
The cause of Hawaii's wildfire is yet to be determined, but a lawsuit filed by Maui County alleges that Hawaiian Electric inexcusably kept their power lines energized during the forecasted high fire danger conditions. A separate investor lawsuit alleges the company made misleading statements about its wildfire prevention and safety protocols, calling them inadequate. Hawaiian Electric is not alone. A CNBC investigation finds some utility companies are not properly assessing the risks climate change poses to their operations.
I think there's a failure to fully understand the risk.
Michael Wara, director of the Climate and Energy Policy Program at Stanford University, studies wildfire mitigation plans. He says Hawaiian Electric lacked basic risk mitigation efforts, like a power shutoff plan, which is when a utility intentionally cuts off electricity when certain conditions, like strong winds, occur to prevent power lines sparking a fire. Hawaiian Electric has publicly stated it did not turn off power when high winds occurred, which caused its power lines to fall and start a morning fire on August 8th. It said this fire was contained, and that a second afternoon fire later that same day, the cause of which is still unknown, is what devastated Lahaina.
Are you investors properly discounting the utility stocks risk?
Not right now. We don't see that kind of discounting happen, except in cases where the utility has already caused a fire.
Hawaiian Electric, which trades as HE on the New York Stock Exchange, saw its shares crash after the fire. PG&E's stock price also plummeted after a 2017 fire and dropped again after the one in 2018 that destroyed Glogovac's childhood home. These fires resulted in the company filing for bankruptcy in 2019 and settling a $13.5 billion lawsuit alleging its infrastructure was to blame. Hawaiian Electric declined an on-camera interview with CNBC, but in a statement, a spokesperson said Hawaiian Electric's power lines had been de-energized for more than 6 hours when the afternoon fire that spread to Lahaina broke out. The company also has been executing on a wildfire mitigation and grid resilience program for years and was evaluating wildfire defense strategies, including whether to implement a public safety power shutoff program as a tool of last resort.
We've reduced our wildfire risk.
Despite coming on CNBC last quarter, PG&E also declined an interview for this story, but in a statement wrote that since 2017, PG&E has reduced wildfire risk from its equipment by 94% through measures like burying power lines, vegetation management, and implementing its public safety power shutoff program to de-energize power lines.
Your utility is taking some of that money and using it to fund their political machine.
David Pomerantz is the executive director of the Energy and Policy Institute, a watchdog for utility companies, which is funded by philanthropic foundations that support climate actions, environmental conservation, and environmental justice. He says the failure to assess and mitigate risk boils down to one thing: money.
Like all investor-owned companies, it's all about the bottom line. Utilities are trying to boost earnings.
Pomerantz says utility companies make money through capital expenditures, which involve building new infrastructure like putting power lines underground. The cost of this, plus an additional percentage of profit determined by regulators, all get baked into customers' bills over time. On the other hand, operational expenses, things like trimming trees or clearing grass near power lines, don't make money for the companies and their shareholders. Pomerantz says this is why utilities might be less motivated to spend on expenses, because the more they spend on operational costs, the more their profits shrink.
Now, Glonovac's parents in Paradise, California were lucky guys that they had fire insurance on their home. They were able to rebuild, but many victims are still waiting on payouts from the trust that was created to compensate the victims. Guys, it gets worse. Right now, under federal law, any money that you get from the payout can be taxed. And in fact, even the money spent on the lawyers that represent you can be used as imputed income and taxed. So some people, it's unbelievable.
That doesn't make any sense.
No, it
If
doesn't.
This is to pay you back for something that was
Yes.
lost. That's not income.
The government considers it income. There is a bill right now that is in the House. It's part of it's tucked into the broader tax package that would change this, Fire Victims Trust Compensation Act or something like this. You're also taxed on the lawyer fees. The lawyers made over $1 billion. And if they represented you, and they represented almost everybody, they consider that imputed income. So they're trying to change that.
So not only did the government
some people
not
make
do
it
anything
half.
to help, not only did the government not do anything to help, they're going to come and take.
Of course they are. And by the way, the trust is $13.5 billion. The people running the trust make a lot of money. The lawyers have made a lot of money. And a lot of these people, because some people didn't have insurance. And you can say, well, that's dumb. Well, if their house is paid off and they never had a problem in the past and insurance costs have gone up, some people are left penniless.
But PG&E is now doing what it needs to do, in your view? I mean, I heard 94%. I'm not sure how they arrived at that number. But the mitigation, that you need better infrastructure, you need to do enforcement, clean out all the old stuff that...
But that costs money.
What, they haven't learned their lesson about what really costs money?
So they turned down an interview with me for some, I have no idea why, but they did come on CNBC around earnings. And they talked a lot about wildfire mitigation efforts, and but they will also, I think, and I'm not going to defend PG&E, but I will say they've said, if we do everything to make it fireproof effectively, it's going to jack your electricity rates up so high because it's so expensive to bury the lines.
Isn't it pay me now or pay me later, though? I mean, look what happened.
I think many would view it that way, Joe, in particular. Thanks, guys.
Thanks, Brian.
Thank you.
Yeah, you're welcome. It was a long, no, we didn't.
You know how long it was? 4:20. Don't get into that. Don't get into that.
Oh, 4:20, was it? That's how those fires got started. All right, still to come, what a new sports streaming platform means for your living room. We haven't got a name yet, and the company is involved with the deal. We got some good ideas. So there's a comedy channel called Dave in the UK. What about Joe? Just call it Joe.
There you go.
Plus, Minneapolis Fed President
After Morning Joe?
Yeah, the real Morning Joe, me. Neil Kashkari joins us to talk interest rates, the economy, and much more.
Good morning. A big day for earnings. New results out from CVS Health, Uber, and Alibaba. Plus, shares of Snap deep now in the red after its latest numbers were released. Let the games begin. 3 media giants teaming up for a new sports service that could disrupt the entire streaming industry. And is a marked interest rate cut completely off the table for the Fed? We're going to ask Minneapolis Fed President Neil Kashkari in a can't-miss interview. All of that as the final hour of Squawk Box begins right now.
Good morning and welcome back to Squawk Box here on CNBC Live from the NASDAQ market site in Times Square. I'm Joe Kernan along with Becky Quick and Andrew Ross Sorkin, and U.S. equity futures, at least the S&P at this point, I just looked over, and it's positive. So is the Dow. So we've made up some of the ground. It was never anything that substantial. We're down about 50 on the Dow. The NASDAQ has added to its gains now, up almost 60 points. Take a quick look at Treasury yields. The 10-year about 412 or so. Last time we looked, 413, Andrew.
Okay, meantime, one of the today's key stock movers, Uber, this morning. The company reported fourth quarter earnings and revenue far above analyst estimates, but the stock down marginally on the news, 2%. I should say more than marginally. Uber CEO Dara Khosrowshahi joining us last hour gave his view on the state of spending.
We continue to see consumer strength. And especially consumer strength as it relates to services. People are going out to dinner, they're going out to concerts, sports events, etc. And when people go out and they spend money, or when they want anything delivered to their home, Uber benefits, which is why you've seen gross bookings of $37.6 billion, up 22%, which is actually an acceleration over the last quarter.
Current quarter, Uber said it expects to report gross bookings between $37 to $38.5 billion, with the midpoint of that range above street account analyst estimates. The company seeing adjusted EBITDA of $1.26 billion to $1.34 billion versus the consensus of $1.26. And you're looking at that stock, as we said, about off about 1.5%, but up close to 100%, 98%, 99% year on year.
Its valuation over the last year. Also, shares of Snap. They have not fared so well. They're plunging in the pre-market. Revenue there fell short in the fourth quarter, and the social media company's first quarter sales guidance was slightly below the consensus. Investors have been questioning whether Snap can effectively compete against larger rivals like Meta for ad dollars, and that stock this morning is down by 30%. Make sure you don't miss an exclusive interview that's coming up with Snap CEO Evan Spiegel. That is later this morning on CNBC. And the big media story of the day today, Disney's ESPN, as well as Fox and Warner Brothers Discovery, planning to launch a joint sports streaming service later this year. Each company will own a 1/3 stake in the venture, which does not yet have a name or a set price. Subscribers probably have the ability to bundle the new product with the company's existing streaming platforms, things like Hulu and Disney Plus. We're going to talk more about this story a little later this hour, but this news did come ahead of Disney's earnings that are scheduled for this afternoon. Right now, Disney shares off by about 0.8%, but Fox shares up by 3.5%, and Warner Brothers Discovery shares up by 2.75%. Also, don't miss a CNBC interview coming up, an exclusive interview coming up with Bob Iger. That is today on Closing Bell, after the numbers hit. Also, tomorrow we'll be speaking with Disney's new CFO, Hugh Johnston, an old friend of the show from all his years at Pepsi. We'll get details from him tomorrow morning right here on Squawk Box.
Time. Take a look at shares of Roblox jumping after reporting fourth quarter results. That company lost 52 cents a share, 3 cents narrower, though, than expectations on revenue of $1.13 billion. That topped expectations. Daily active users coming in at 71.5 million. That was also ahead of the street's 70.7 million consensus. For the first quarter, Roblox now sees bookings, they're saying, in the range of $910 million to $940 million. It's better than the $903 million expected by analysts, and you're seeing that stock up big on that news, 16%. And we're going to be speaking with the CEO of Roblox tomorrow in a first on CNBC Squawk interview right here.
All right, let's talk more about earnings this season in the broader markets. Joining us now, Ethan Devitt, Moneta Chief Global Market Strategist and London CIV. chief investment officer, and even lately we have made the point that earnings might even be more important because perhaps we're not going to get the same number or timing on the Fed rate cuts. So earnings, the baton has kind of been passed. Maybe we keep the same multiple. That doesn't get, we don't see multiple expansion from a drop in rates. But things, a stronger economy can be good in its own right because earnings are good.
That's right. There's been a lot of focus on earnings, but primarily on how those earnings expectations are managed, which has been very well. And that's why I'd say we're seeing some of this reaction in some of the stocks today, like Uber that you just mentioned, strong numbers, but ultimately maybe that was already priced in. So good telegraphing going on. And yes, there is a focus on earnings, but let's not forget we're at 43% earnings, so double digits increases. So really surprising on the upside. No earnings recession in evidence. We're seeing inflation come down. We're seeing companies retain pricing power. Every company is talking about the resilience of the consumer, especially around discretionary issues. So what's not to like, essentially, around the earnings picture right now?
Ethan, is there an actual demonstrable linkage between a strong economy and inflation, strong labor and inflation, or can we actually have a strong economy and continue to see inflation moderate, which it would almost be too good to be true? Is that a pipe dream, or is that actually what we're seeing?
It doesn't fit with the economic models, but it does. This is an extraordinary economy that's not fitting with much precedent or with models. Of course, how much do wage increases contribute to inflation? If we look back at what's contributing to inflation right now, and remember it's very much receding, it is the service sectors, things like insurance, things like shelter. It's not generally the cost of labor. The cost of labor is up slightly, but it has been a lagging indicator and has been trailing. I would suggest we're getting close to the end of some of that frothiness around labor. We're definitely seeing softer indicators around the economy, less of the great resignation. We're seeing more of these layoffs that's going to take hold. It is a lagging indicator, as I said. So the good thing about the employment market is it's stable. It's keeping the consumer in jobs and stable and spending. But I do think we can see recession continuing to fall, inflation continuing to fall as the jobs number stays solid.
So the pandemic-related stimulus that was going to run out and eventually show up with consumers that that weren't going to be able to keep consuming. Did that not happen, or did once again another baton? The strong labor market is actually giving consumers a second wind, or there's no reason to think that at the end of all the support that we saw during the pandemic, that's not something we need to deal with? That was we shouldn't have been worried about that all along.
Well, the support is going to has run out, but remember it's still in money market funds. So over $6 trillion in money market funds today, an all-time high. So that's sitting there, or it's already been spent, and we're seeing the fruit of that in some of these earnings that we're hearing about now. There's a lot of money there. The stimulus, perhaps, though, is not going to be there in excess, certainly not in terms of handouts. And we can see with the Fed, why should it lower rates at this point unless it has a compelling need? Because we can see the perils of overshooting in that respect. So I'd say we're not worrying so much about stimulus. That's still there and ready to be spent. But on the labor side, what that does is take some of the uncertainty, some of the worry out of the consumer. Although as we can still see, sentiment is still fairly depressed. It doesn't reflect the economic numbers we're seeing. We've heard about a vibe session. And why is that? Probably because of the cumulative effect of the high inflation. We're still, with the exception of gas prices, which are lower, we're still looking at a much higher grocery basket. And that's still continuing to sting. That's why the sentiment is depressed.
Well, tell me about the sentiment. Do people think 2024 is going to be a good year, as election years are, more often than not, for the stock market? Last year, you could cut the negativity with a knife right from all through the first quarter, probably the second quarter, and now we know what happened. Seems different this year. It's certainly not as negative. Do we need a wall of worry to climb, or can we continue to sort of just drift higher?
Certain political narratives certainly benefit from a wall of worry. I'd say that right now there's still a little bit of uncertainty in terms of the actual political landscape. It's certainly every day that is cleaning up that uncertainty. Once the election gets into full swing, We're going to have rhetoric that is charged on either side, and that's likely to lead to perhaps to sparking some uncertainty. But overall, there does tend to be a strong market in election years, especially once the uncertainty of which candidate is likely to prevail has been removed. I don't think that uncertainty will be removed till right to the end, but there's going to be definitely a strong rally after that. So, of course, remember, it's on both parties benefit to really to drum things up and to not have a recession of any kind. So I think that all bodes well in terms of the incentives, and much of the economy is about incentives.
And how many rate cuts and when do we get the first one? And does it matter?
It definitely matters, because that's going to be a sign that the Fed has seen reason to cut. So they've either been assured around inflation that it's in the rearview mirror, that they've achieved their targets, their data is right, or there's been a negative surprise like we saw with the regional banks, and it's not just a pause, but it's a cut that we get. So it will be momentous whenever it comes. I'd say we're not looking at the first half. I think we can already see expectations have come down significantly around that. I'd be looking at the second half of the year, 1 or 2, but again, very data dependent. And I think we have to be quite satisfied with the economy as it is, ticking along without needing that rate cut.
Really unbelievable. The number of people that were sure that we would have had at least a slowdown by now, and it's just nowhere to be seen. Ethan, thank you. Good to have you on this morning. Thanks.
When we come back, Minneapolis Fed President Neil Kashkari will join us for an extended interview. You don't want to miss that. But next, we've got fighting AI misinformation as we get closer to the presidential election. Can the authorities and tech companies respond fast enough to prevent harm? We will talk about that and much more when Squawk Box returns.
.com.
right, folks, welcome back. I want to take a look at shares of New York Community Bank Corp. That's symbol NYCB. This is not the big headline here. They have named a new executive chairman, Alessandro Danella, who had been the not executive chair of the board. But if you take a look at the stock this morning, you're going to see they're trading up slightly, up by about 6% to $4.45. This comes after Moody's downgraded this stock to junk status, actually 2 notches below junk status. Over the 6 months, you can see it's down 66%. A lot of concerns about what's happening here. The company actually coming out today and saying that their total deposits are actually up from the year end. At the end of the year 2023, they're now talking about $83 billion in total deposits. They're saying liquidity is ample. Again, the stock is up today, but this comes after some severe trading down on some of these issues. And this morning, there are a number of downgrades that are kind of after the fact on this. JP Morgan cutting them to a neutral from an overweight, cutting their price target to $5.50 from $11.50. Bank of America also cutting them to neutral from a buy and cutting their price target to $5 from $8.50. A lot of talk around what is happening with some of these mid-sized regional banks. New York Community Bank Corp is unique in that it was above $100 billion in assets. It pushed it to have to hold more in deposits, but also dealing with some pretty unique situations on the commercial real estate front. And if you look at all of these stocks right now, this is here. We are going to talk to Neil Kashkari about this, along with what the Fed is considering. But this has been something the market's been eyeing since last week, and we will continue to have more on this.
After what happened last year.
Right, in March of last year.
It seems like a one-off, though. I mean, commercial real estate in New York, doesn't it?
Yeah, I mean, you can look at probably some other areas like Seattle or San Francisco or different places. There are some unique issues to New York Community Bank Corp that are putting pressure on this.
Deposit there. Would you keep your deposit there? I hate to say that, but would you?
Well, more than 100?
More than what's insured by the FDIC.
I mean, do you believe that? I mean, this sort of this goes back to the issue of the implicit guarantee.
Yeah, why would you leave it there?
That's the question.
Banks.
That's the question.
Well, if they would, I guess, pay a lot more to keep.
Meantime, the New Hampshire Attorney General's office saying a robocall from last month, which appeared to be an AI-generated voice clone of President Biden urging people not to vote in the state's primary election, has been traced to a Texas company called Life Corporation. New Hampshire's AG saying charges could be brought, resulting in prison time for thousands of dollars in fines. Joining us right now to talk about this and Meta's new labeling of AI content and so much more is Hanny Farid, UC Berkeley professor of computer science. Good morning to you. You know, we are now we are within striking zone of the election here, and I'm so curious just what kinds of things like this you think are going to take place, and what needs to happen to prevent this kind of thing.
Yeah, well, let's talk about what's happening right now. So here in the U.S., we have the national election. Over the last few months, over the last year, we've seen the rise of generative AI interfering with our elections, from the robocalls in New Hampshire, trying to discourage people from voting, to the images and the audio and the video that are floating around social media, trying to harm candidates, but also around the world. Some 2 billion people will vote this year in some 70 elections, and we are seeing the same type of interference around the world. So these are serious issues around our democracy.
I'm not disagreeing with that, and I appreciate you laying that out. I think the bigger question is, what do you actually do about it? Who do you hold responsible? Do you hold the tech companies responsible? What kind of responsibility do they have in all of this? How do you hold the bad actors accountable? By the way, several $1,000s in fines, which could happen. That doesn't seem like enough. I mean, what are we talking about here?
I agree. Look, everybody's got responsibility. So obviously the bad actors who are committing these crimes of trying to interfere with elections have to be held accountable. And I'm glad to see the New Hampshire Attorney General going after them, whatever the consequences are. Absolutely, 100% the tech companies. Those who are creating the content, those who are not putting the guardrails on the content, those who are allowing the content to spread. So that's Twitter, that's YouTube, that's Facebook, that's TikTok. And then, of course, we as the public, because at the end of the day, this content is showing up online, but we're the knuckleheads who are clicking on that and sharing and amplifying, and that's what's also causing a storm. So I think there's blame up and down the ladder that we all have to take responsibility from the C-suite all the way down to the individuals.
But assuming that the individual never likes to take responsibility for themselves, which we've seen before, how do you actually do this? We've talked about regulating social media forever. Do you actually regulate the AI programs that can write these things? I'm not sure. I mean, you wouldn't hold Microsoft responsible for things that I write on Microsoft Word.
Yeah, it's not the right analogy, of course, because a generative AI system, I go to a portal, I upload somebody's voice, I click a box saying I have permission to use that person's voice, and then I get them to say things they didn't. And that's not the same thing as me typing into Word. But let's put that aside for a second, and let's talk about how do you regulate this, because it is difficult. We're talking about political speech, and we have to give a very wide berth here, because lots of speech, including lies, should be protected. And so I think if the government is going to get involved,
Including lies, you say.
Including lies.
Let's go back. Let's hold on. Let's, as they say, as the kids now say, let's double click on that. What do you mean?
First of all, let's not say that. But it is okay to lie, but it is not okay to tell people that they can't vote or where they can vote or try to interfere with an election. There's a really big difference. There are limits to those lies. You're allowed to say certain things, but there are still guardrails. So let's talk about how the government could do this without running afoul of the First Amendment. We could simply say we need for all AI-generated content to be rigorously and robustly watermarked and fingerprinted so people know what they are consuming it. Think about nutrition labels at a grocery store. You can go to the grocery store and buy all kinds of junk food, but you need to know that you're putting bad things into your body. Same thing can be for our minds. Let's force the companies to label the content as AI generated or not, and then the consumer can make decisions on whether they want to believe it or not.
But here's the thing I don't understand, Professor, and this goes to sort of how you're going to police lies. So if I said that you robbed a store last night, and we'll assume that's a lie, should that be regulated? If I said you graduated from a college that you didn't graduate from,
yeah.
Is that a regulated lie, or is the lie only that I'm lying about, you know, some kind of effectively election interference, that somehow election interference is a different type of lie?
Yeah, so understand, I'm not talking about regulating lies. I'm talking about labeling content as deceptive or not. And that is really different than what's inside of the content. So all I'm saying is that if you are going to generate a robocall with Joe Biden's voice, it has to be clear to the receiver that this is not Joe Biden's voice. If you're going to create a video and post it online of Joe Biden or Donald Trump saying and doing something they didn't say, it simply has to be labeled. We're not talking about regulating the speech, within limits, of course. We all recognize there are limits to
Well, what happens
defamation.
if I want to generate a video of you online? Do I have rights to do that?
Again, I am not saying what you have a right to do or not to do. I'm saying if you do that, the consumer of that content should simply be aware that it is not me speaking, that it is something that is AI generated. And then downstream we'll deal whether it's defamatory or not and whether it's illegal or not. Labeling is a gift. It doesn't put value on the content. It doesn't restrict the speech. It simply says, this is what this is. And it's a very low bar, by the way. We are not asking for a lot here.
Professor, it is a longer conversation. Maybe our bots will have that conversation, or we'll have you back. Thanks again.
Good to talk to you.
I got it.
I got what? His name?
The wide world of sports.
The wide world of sports?
Wide world of sports. Canceled in 1998.
Here's the good news.
They didn't hold the copyright?
Owned by ABC.
Is it still owned? It's
I
canceled.
imagine.
Well, okay.
Eastern.
Still to come, we will speak with Minneapolis Fed President Neil Kashkari. Stay tuned. Squawk Box will be right back. Welcome back to Squawk Box right here on CNBC. We are just a few seconds away from a new look at the U.S. trade deficit. Ahead of that, we're watching the futures this morning, and after the Dow was indicated off maybe 40 or 50 points earlier this morning, it's now indicated up by about 53 points. S&P futures are up by about 14. You've got the NASDAQ indicated up by 83 points. Treasuries, we've seen yields a little higher this morning. You can see right now that the 10-year is sitting at 4.11%, the 2-year is at 4.42. Rick Santelli is standing by at the CME in Chicago. And Rick, take it away.
Yes, thank you, Becky. Our trade balance for December, $62.2 billion, a minus sign, of course, but that is smaller than the rearview mirror, which was 63.2, which was just revised to 61.9. So these falling trade deficits may augur for some bolstering of our fourth quarter GDP. If you recall, the advance on GDP was up 3.3%. So the fact that these deficits are getting a bit smaller for November and December could figure in to make exports a little greater than imports, which could give us a little bit more economic horsepower. We have 42 billion of 10s auctioned off at 1 Eastern, and we all know auctions are super important to monitor these days because debt continues to grow. Becky, back to you.
All right, Rick, thank you very much. In a new essay this week, Minneapolis Fed President Neil Kashkari says that he thinks the Fed has time to monitor upcoming economic data before starting to cut rates. He said there's less risk that the too tight monetary policy will derail this economic recovery. Neil actually joins us right now. And Neil, thank you for being here today. There have been a lot of questions in the market after Jay Powell went on, the chairman of the Fed went on 60 Minutes over the weekend and talked a little bit about how those rate cuts, basically, don't expect them in March. That's been your message as well. What are you seeing right now?
Well, we keep getting surprised in a good way that the economy is showing up to be remarkably resilient. Consumer spending is staying strong. The labor market is staying strong, as evidenced by the really strong jobs report on Friday. That's all really good news, and that tells me maybe monetary policy is not putting as much downward pressure on demand as we would otherwise think. And so, given that, I think we can take more time, get the inflation data, see it continuing hopefully to come in very attractively around our 2% target. It gives us more time to assess that data before we start reducing interest rates. And so I think this is a good problem to have, but we're trying to figure out some of these mixed economic signals.
What would it take for you to think that rate cuts would be acceptable come May? What kind of data would you need to see leading up to that?
Well, I think it's similar to what the chairman said on his 60 Minutes interview, which is we're not looking for better inflation data. We're just looking for additional inflation data that is also at around this 2% level. On a 6-month basis and 3-month basis, inflation is already back roughly to our 2% target. If we get to see a few more months of that data, I think that'll give us a lot of confidence that we are well on our way back to 2%. And then, of course, the other side of our dual mandate is equally important, the labor market. Yeah. Hopefully, we will continue to see a very strong labor market. That, I think, would give me confidence that now is the time to start dialing it back slowly.
You need a strong labor market to suggest that it's time to dial back slowly? I mean, that's almost counterintuitive. Because Chairman Powell made those comments. They were taped before the jobs report on Friday. That was a really strong number.
It was a really strong number. I think there's been a lot of debate over the last few days on the speed with which we would then cut. If the labor market continues to be quite strong, that would give me confidence to say, well, we can dial things back quite slowly from here. If we saw a material slowdown in the labor market, then that would say, hey, maybe we need to start cutting rates a little bit more quickly. And so that's why it's the speed of the reductions that the labor market, I think, is going to have a big influence over.
So how many rate cuts are you factoring in for this year right now, given this latest information? I mean, if the Fed dot plots were suggesting 6 rate cuts, what do you think is more likely?
I mean, I think we're going to put out a new dot plot in March. We'll see where I'm ultimately at, given the data that we get between now and then. Sitting here today, I would say 2 to 3 cuts would seem to be appropriate for me right now. But again, I don't want to prejudge things, but that's my gut based on the data we have so far.
Okay, that's a very different picture than what the market had been anticipating. This week, we did see the 30-year mortgage rise above 7% again for the first time since December. And that's a pretty significant number for homeowners. Does that concern you at all?
Well, that's a great example, Becky. When we went from 30-year mortgage rate at 3% all the way to 8%, I would have thought that would have slammed the brakes on the housing market. As I put in my essay that we published on Monday, remarkably, construction employment has continued to grow over that time. Investment in residential investment has been roughly flat. So there has been remarkable resilience in the housing market, whether it's single family or bleeding over to multifamily. That's been surprising to me. I would have thought that 7 or 8% mortgage rates would have been a bigger constraint on demand. That's also what makes me question how tight is monetary policy relative to what we consider the neutral rate in this reopening economy.
The commercial real estate entire industry will tell you that they are in big trouble, at least anybody who's an owner of any of these loans that need to get repriced. Anybody who's out there maybe potentially on the sidelines thinking they can step in and get a better bargain wouldn't go along with that. But how much does that weigh on you? The idea that there are a lot of commercial real estate loans that if they don't get refinanced are going to be problems, and then there are banks that hold some of those commercial real estate loans, New York Community Bank Corp, the pressure that we've seen it under over the last week.
Well, we're paying attention very closely to it. I do want to make one adjustment to what you said. It's not commercial real estate across the board. It really is focused on the office sector. Many other segments within commercial real estate seem to be doing very well. And so I think that delineation is important. And we think it's going to be on a bank-by-bank basis where we see pressures flare up. And our bank supervisors are in very close contact with other supervisors around the country. and of course with bank management to monitor their portfolios. So it's something we're watching very carefully, but I do think most of commercial real estate is doing well. It really is just the office segment.
So that is not enough for the Fed to really be concerned, though. I guess the expectation is you don't think that this is a big problem that spreads through a lot of the banks?
As of right now, again, you never want to say never. As of right now, it does seem to be more idiosyncratic to individual banks with individual exposures rather than systemic. But again, we're monitoring it very, very carefully.
Neil, the other issue that people will point to is the amount of debt that we have as a nation, and the idea of trying to sell treasuries at 5.3% versus 3%. I mean, that's a big deal, too. Does that ever come into the conversations or the thoughts at the Fed, just what happens with what we're going to have to do?
Not for the Fed. You know, ultimately the amount of treasuries that get issued, the amount of taxes and spending, that's up to the Congress and the U.S. Treasury Department. Our jobs are to just take those inputs and try to model what they mean and ultimately achieve our dual mandate goals. So that really, for us, is the distinction between fiscal and monetary policy.
Neil, is growth, economic growth, by definition, do we know for sure that it's inflationary? And where I'm going with this is that you could make the case that if it's not inflationary, there's no reason to try to ever curb economic growth. You ought to let the good times roll. In other words, there'd be a reason, I guess, to bring rates down, because you know, that's expensive too. That's inflationary. It's hard for business development. So it'd be nice to keep rates as low as you could. But on the other hand, do you need dry powder for the next time there is an actual slowdown to cut? What is a more important force for central bankers?
Well, I think the core of what you just said, Joe, the scenario you just gave, is really about productivity growth. If we do see a big boost in productivity because of AI, for example, then you would expect a higher growth rate, which is non-inflationary, and that would be really positive. And then you would expect then the neutral interest rate would likely be higher in that environment. And then we would adjust policy to not try to tamp down growth, but just to respond to the economic environment. So in that situation, you'd see strong growth, not a lot of inflation, and monetary policy would be supportive of that. And so I hope that's what in the end, I hope that's what we end up seeing.
And Neil, as you were watching 60 Minutes, I'm sure it dawned on you that there was a voiceover in the middle of it that seemed to suggest that the first interest rate cut would come in the middle of the year. And then there's a whole bunch of people who went to read the transcript of exactly what Jay Powell said, and it wasn't exactly like that. What were you thinking when you watched that part of it?
Well, to be honest with you, I wasn't that focused on the voiceover at that time. I was focused on what the chairman was saying, and I thought the chairman was on his message very clearly. And so I didn't think much of it at the time, but I understand that it led to some questions from investors going forward. But that's why I'm glad that they put out the transcript so investors could see for themselves.
And then, Neil, we ask this of everybody often about the presidential election, and you know, most folks on the Fed say, look, we can't think about the election. The election has nothing to do with this, and we need to be seen as independent of the election. But when it comes to being seen as independent of the election, you have to somehow think about it. Does it ever even come up in the conversation?
Honestly, it doesn't. The only thing that comes up in the conversation is us reminding ourselves that we must be non-political, that we must always conduct monetary policy based on what we think the economy calls for, what the data is telling us. And the only way for us to do our jobs is to hug that mast as tightly as we can. So the only time it comes up is us just reminding ourselves that's our job and we must not stray from it.
So what are the next 2 or 3 data points that are going to be most critical that you'll be watching most closely?
Well, it's always the same. I mean, it's looking at the actual inflation data. Well, let me back up. Because our models have so utterly failed to forecast the high inflation, to then forecast the disinflation, which is a good problem to have, I've been saying we just need to look at the actual inflation data to guide us. So I'm looking at the actual inflation data, and then all the subcomponents that we look at: core inflation, housing inflation, services, goods inflation, and then of course the labor market and looking at wages. And so far the data has been resoundingly positive. I hope it continues, and then the question will simply be, at what pace do we then start to adjust rates back down? And ultimately, where is that destination? I mean, a big question mark is, for me, is where is that neutral rate once we ultimately get through this reopening period? There's a lot of uncertainty around that. There are good arguments to suggest we're going to go back to the old rate environment, but there are also compelling arguments to suggest we could be in a longer, higher rate environment going forward. You know, we're going to have to see how the economy performs before we draw any firm conclusions.
Your gut, though, just in terms of, I mean, it sounds like you think it is going to be a higher rate structure.
You know, it seems like there's some big fundamental changes in our economy that have been longer lasting than I expected. I'll give you an example. When the pandemic hit and the services economy was shut, people were flooding the goods market. And so you saw huge goods inflation and goods supply chains were stressed. Now that the services economy is reopened, remarkably, people are still buying more goods than they did before the pandemic. So it seems like there are some longer-lived changes in consumer behavior that we're having to pay attention to. And especially when you think about work from home, it doesn't seem like we're going back to the old world. We may still adjust from here, but not go fully back. It seems like there are longer-lived changes in behavior of businesses and of consumers, and how that plays out into the rate environment, we're going to have to see.
President Kashkari, thank you. Neil Kashkari from the Minneapolis Fed.
Thanks for having me.
And coming up, Disney, Fox, and Warner Brothers Discovery betting consumers will cheer a new sports-only streaming service. I'm still wondering, do they have to do this, or is it a big blockbuster offensive move? It's kind of both, I guess. After a break, we're going to talk about the implications for media, for the sports leagues themselves. Stay tuned. Squawk Box will be right back.
back to Squawk Box. ESPN, Fox, Warner Brothers Discovery all saying they now plan to launch a joint sports streaming service this fall. The plan could pose a big new challenge to the traditional cable bundle. Joining us right now is Boardroom co-founder and CEO Rich Kleiman. He's the longtime manager of Kevin Durant, has investments in all sorts of pieces of the sports ecosystem. What did you make of this?
I liked it. I liked it when I first heard it. I liked the idea of there continuing to be optionality. I like the idea of super serving sports fans. And I think that it's obviously in reaction to what we know is inevitable with cable long term, but there's still a lot of questions to be answered.
So those questions in your mind are?
Well, one, is this, for them, is this going to be an opportunity for them to start bidding on rights together and to compete with the tech companies? I think also you have to build a brand, just to say that they're going to have the sports rights and they're going to create a new streaming service, they're going to have to put an executive team in place and build a brand. But I like the idea of it. They're still missing out on CBS and NBC. Warner's obviously talking to Paramount, so maybe that ends up answering that question. But I like the move, and I think for ESPN especially, I love the move.
My understanding, and I did some reporting on this last night, is that they all want to be bidding on sports independently. And the view is that if they were to start bidding collectively, all of a sudden, Lena Khan, Department of Justice, others, then all of a sudden this looks like a different deal to them. Then it actually looks like a merger.
Yeah, I mean, listen, I think that's a concern. I was reading a lot about what that concern could be down the road. But I also think that ESPN and some of these companies are still going to go bid independently and then be able to throw it into this bundle. Again, it's already an incredibly fractured streaming landscape. So I think giving this optionality, targeting this towards just sports fans, is what the differentiator is.
But how much of this is going, so part of the move here is to try to take sports fans that have already unbundled and get them back into some kind of bundle. But the other question is how much of this is going to accelerate the debundling of the current model, and then what that ultimately means, even to these companies, by the way, because they're going to have a smaller number of people ostensibly buying this package than might be on the larger bundle.
Yeah, but I think it has more to do with answering the idea that people are still holding on to traditional cable only for sports rights. And I think that optionality is what's great. I think what else they're going to add to this, or if this will strictly be a sports streaming service, is also something I'm interested to see. Again, you have to build a brand. You can't just put these things up with rights. So I think that's more in line with a reaction to cable, to be honest with you.
What happens just in terms of the pricing structure, which hasn't been announced yet?
They haven't announced it.
Yeah.
And also I think one thing I read was, even though they all three own it a third, depending on what their deal was and their rights setup was with each league through the cable broadcaster, then you'll see. So ESPN, for all intents and purposes, will make more on a distribution.
More of the revenue coming back.
Yeah.
But what would be, in your mind, too high of a price? What would be?
Well, it can't be priced with cable, because then you're getting cable and you're getting all the other channels. So I think it's probably somewhere in the $40 to $50 range.
And I think the conundrum, in truth, by the way, is once you start to add in an NBC Sports or a CBS, meaning then the package actually becomes like cable, and it's the same kind of pricing issue. My separate question to you was going to be about pricing of sports teams.
Yep.
Do you believe we are at an all-time high, and or did this keeps going? There was always a question about regional sports networks, which was really a huge part of the value prop. That's come undone. But the price of teams has not come down yet.
No, and I don't think it will. I mean, I think some leagues could slow more than others, but the scarcity is still there. The demand is still there. You see from the news yesterday how much focus there is around sports fans. And you understand the culture around sports. It's never been greater. So no, I don't think so. And there's so many people that want in.
When you think about the NBA,
yeah,
this is now the next big deal. You think that whatever deal they get this time, they're going to get an even higher deal a decade from now?
I mean, I would like to hope so. And at that point, I would hope Kevin was still playing, if that's the case, even though he'd be 45. But yeah, I mean, listen, I think the deal is going to be staggering, and I think it's deservedly so. And I don't see any indication that the culture of the NBA, the business and the globalization of the NBA is slowing down in any way.
Do you think there's enough scale now for an Amazon or even a Netflix? I mean, Netflix says they don't want to be in the sports business, but with wrestling and everything else, they're sort of in the sports business. That there'll be a moment where they're going to have enough scale that you won't need the classic linear channels to participate at all.
Sadly, yes. I think at some point, I don't think we're there now. I think as much as some people would like to expedite it, I think the reality of it is that there's like a learned behavior, especially from a large portion of society, that is not just going to jump ship overnight because of the announcement of like a sports bundle. But I think a lot of fans will look at it. A lot of people will look at it. I will look at it and go, am I even paying cable for the right reason now? Not as much to save money, but to be conscious just of what I'm doing, right? And I think the fractured nature of it is now you have to figure out what the best offering for you is.
If Kevin could score 30 points every night, and I take him to score over 25.
We're talking about gambling again?
And then in the fourth quarter, the team is so far ahead that he sits on the bench with 18 points, even though I know he could score 30 and help me. What do you suggest I do? Not bet on him to do
You should sound like someone that shouldn't be gambling.
What do you think the name of, what do you think, he could do 30, Beal had 50
The average
points.
is 30 every night.
I know,
Yeah.
but you can't count on it.
Well, that's gambling. You took the wrong night. I'm sorry.
Are you gambling in game, by the way?
Yeah, I'm sorry. I don't know
Yes,
what
I
to
do
tell
it all.
you.
It's fun, it's fun. No, sometimes. With the way I gamble in game, let's say a team is an underdog by 3 points and they're down by 15. Normally by the end of the game, they're down by like 3. That's because these guys are so good.
Then
so that's when you put the bet on when they're down 15. What do you think the name of this should be? If I offer you
he's a branding guy.
$10 million
This is a good question.
to come up with the name of these,
the
someone
streaming
just came
service.
up with Parlay. Parlay is a good name just because it's easy to say and it factors in a little bit of the gambling phenomenon. You like Parlay? You like?
I think Parlay.
He didn't like this. I like Wide World of Sports, but he says that may have been used before.
Feels a little old.
Yeah, it has been used before.
You don't have a good one, do you? You're
right off
branding
the top
expert
of my
and
head.
on the spot.
If you give me
and
five, all right, let me
charge all this money for branding, and you have no idea what to call it.
I got one. I got one. I got one.
I want to hear it.
The Sports Watch.
That's not bad.
How about fanfare?
Wait, hold on. Just admit right off the top of my head.
That
on
was
live
good.
TV.
I'm not paying you anything.
No, it might not be the one, but the Sports Watch.
He gets 30 every night, and he got 18 that
I can't help you.
Nobody can.
I'm doing well. You know that. I've been taking money out.
I want to call it overtime.
That is the name of another company.
Yeah, no, I know.
Boardroom? Oh, let's
I
take
would
it.
love
Boardroom.
Let's take it.
For a fee.
I'll give it to them for free if they want.
Rich, thank you.
Thank
for being
you,
here.
guys.
Appreciate it. Sorry for the really tough questions over there. I know you only get the toughest.
Can't believe it. Sits out the fourth quarter. Just over an hour now to the opening bell on Wall Street. Joining us now, Nadia Lavelle, Senior U.S. Equity Strategist at UBS. Good morning, Nadia. One of the points we made earlier was that compared to last year, people aren't nearly as negative on the markets, yet it's still doing very well. It keeps hitting new highs, even with rate cuts not on the horizon. It still seems to be melting up, maybe on earnings. Is that what we're seeing?
Yes, absolutely. You know, of course, the Fed and the direction of interest rates are important for markets, but what's more important for equities is really earnings and inflection points in growth. And we're seeing that. We're seeing economic growth and earnings surprise to the upside, and previously depressed areas of the markets are now seeing, some signs of life. And so we think that that's important for a broadening out of the market. We still continue to like tech and recognize that though the performance gap is likely to narrow this year. And so you need the other participations of the market to get upside from here. I mean, admittedly, I would say in terms of our upside scenario, we are looking for about 5,000 on the S&P 500, and we're close to that level. But the upside scenario does call for 5,300. The data is coming in better than I expected. But maybe to use a term of the Fed, more data is needed to get greater confidence that we're on path to that upside case. So do think that there's much upside, but we have to see how the data sort of unfolds from here.
So you do expect some broadening, Nadia, but we were trying to figure out a lot of different names. Now we're on, I think, the Fab Four, or no, Fantastic Four. It's not the Magnificent Seven anymore. Is it going to broaden out, or are you still in that arena with those great big cap tech?
We do think that, the mega cap tech companies can continue to perform well and outperform, but we are looking for a broadening out of the rally. We are using our risk budget to really get cyclical exposure to small caps. Now, I know the small cap has had a tough start to the year after the rally that we saw into year end, but we think that there's upside to small cap, particularly as the economic data is coming in better than expected. We're seeing recovery in the manufacturing segment of the market. Look at the ISM last week. And at some point this year, the Fed is going to cut. It's just a matter of time, and that should be overall positive for small cap. And so we expect the small cap to catch a bit as the year progresses.
Any change in leadership versus last year that you're picking up, Nadia, for investors?
So far this year, not so much. You're still seeing like the mega cap tech perform well. But you're also seeing some life among some of the more cyclical areas of the market. If you look at industrials, if you look at financials, throughout this earnings season, you've seen pretty good earnings from these companies. You're seeing that, industrials are suggesting that the bottoming in manufacturing is happening. You're seeing pickup in investment in terms of onshoring and infrastructure, and so that's a positive. The banks also are doing a good job in streamlining their business in terms of reducing headcounts, and so they also are catching a bit. So you're starting to see signs of that, but not just fully yet.
Great, Nadia. Thank you, Nadia Lavelle, Senior U.S. Equity Strategist at UBS. Good to have you on this morning. Final check on the markets, which have been a little bit of a melt-up, mini melt-up in the 3 hours where we've been on now, up about 67 points now, 84 on the NASDAQ. We'll definitely have a name tomorrow. Make sure you join it for the new Sports Network. Join us tomorrow. Squawk on the Street is next.
Good Wednesday morning. Welcome to Squawk on the Street. I'm Carl Quintanilla with Jim Cramer, David Faber at Post 9 of the New York Stock Exchange. Futures are trying to find their legs here as corporate earnings come in with some examples of solid guidance, and New York Community Bank bounces pre-market. Big day for Fed speak and a 10-year note auction. Romance begins, though, with upending TV sports. ESPN, Fox, and Warner Brothers Discovery set to launch a joint sports streaming service.
Plus, staff shares are tumbling. The company delivered weak guidance on continued headwinds it cites from the Israel-Hamas war. Ford shares appear to be popping ahead of the open. The automaker rethinking its EV plans, boosting its dividend, and offering better than expected, or a better than expected outlook.
Let's begin with ESPN, Fox, and Warner Brothers Discovery teaming up to launch that streaming platform. David was here working late last night, and I know you got more this morning.
Yeah, listen, it's an important moment in terms of the cable ecosystem, or the disappearance of the cable ecosystem in many ways, and a big step forward, some would think, in terms of at least what is this complex world that we're in here in terms of trying to get a hold of sports programming as a viewer and figuring out where it may be. The ultimate goal here for these companies is to create an app that allows, for example, a younger gentleman who cares about sports to access it without having to pay for the entire cable bundle. As we all know, of course, that is going away very quickly. I'll show you that chart that came up there briefly, a bit more to explain that. But overall, it brings together these three providers and all of their sports programming, which will cover a wide variety of sports. Not quite all of it, but much of it. They will have a third ownership interest each, but the revenues will flow through in a different mix, because ESPN, for example, with higher fees, paying more to the leagues, will get a higher percentage of the revenues, at least at the outset, it would appear. And so that's how it's going to work. So the overall entity itself, how much value will really accrete to it over time is unclear. You know, perhaps you get naming rights, perhaps there's gaming partners. So there will be some value for this yet to be named, to be launched in the fall entity. I am told pricing-wise, it'll be above 40, but not that much above $40 a month. But that does give you a sense as to what we're talking about here. It's not an insignificant compilation of a lot of sports rights, right? So it's not going to be cheap, but the idea again is to get that never, the one who would never subscribe to the bundle and or who falls off the bundle but still wants access to sports. Although if you care about, you know, your regional sports networks, for example, and your local teams, that becomes still an issue to some extent. They are going to have, what I am told, is a fairly high-profile executive. I believe they've already identified this person who's going to run it with what I'm told is a good track record from a well-known company. We'll see. But they're off and running. And Jim and Carl, it comes back to, and we can bring that chart up now from Moffett-Nathanson, what we've been talking about for years, but what has continued to increase in pace. That is, each quarter since 2018, the percentage decline in terms of the people who have either a virtual MVPD, meaning a YouTube, which now has 8 million subscribers, by the way, or the traditional cable bundle. And that percentage decline keeps increasing, not decreasing. And that is forcing all of these providers to figure out ways to keep these subs or find them in the new world.
Okay, so I have the full Comcast package, all right? And I have Peacock. What changed in my life? What will change?
If you're a Comcast subscriber, in other words, so you get your cable via Comcast, nothing. You'll still get all your sports.
Okay, so
because you're getting ESPN, you're getting Fox, you're getting Turner on Comcast.
Okay, so
and you're paying for them. You're also getting news, and then you're getting those shows that you like to talk about. The
fire,
Chicago.
as long as I have fire, you know, you have
the
to
fire and the murder.
Yeah, okay. Right now, how about my cord never kids who only have Netflix but really like sports? They have something.
That's the cohort. It's my 21-year-old son who, conceivably, when he gets a job and is out there in the world, says, "Well, I don't care. I'm never going to get a cable sub." But
you know
I
why?
love
Because
sports,
they don't
so
care
I'm going
about
to pay
Chicago Fire.
I'll pay my
Prime,
$44.99 a month for this new product or this new app. By the way, it's not going to bid on sports rights itself. That will still be each of the parents doing that on their own. It's not an entity that will. It's just aggregating and distributing.
Does the phrase Hulu for sports ring with you?
Yeah,
you like that?
It does.
It kind of reminds me separately of what Goodell said in a presser this week about the wild card game on Peacock that had lowered the audience by 10 years. And I wonder if ads are part of this, if there's a premium that they'll pay for that kind of younger audience.
It's interesting in terms of that demographic, but obviously ads will be an important part of it. And again, you know, don't get fooled by the one-third ownership because the revenues will be, as I said, flowing through.
All right, so
we'll see how. Listen, Jim, they don't know. They're taking a shot here. You know, the Charter Disney battle
Yeah,
in the
what happens
fall
there?
and what happened there and where they ended up with, that sort of started a lot of this process because it did destabilize the bundle even more.
Okay, but look, I watched you yesterday. Come on, with the whole story, except for I didn't think they had the whole story. They have no. Why did they have? What was the rush here? No name, no executive, no clarity. What was the gun to the head?
They thought it was going to leak. They thought it was going to
so
leak.
it's just that.
Yeah, and that's. I asked the same question, and the answer was we thought it would leak because you're right. There isn't, even though they have a short definitive agreement. Apparently, they don't have the long definitive agreement yet. And to your point, no name. The executive has been identified. They do have a pretty good idea on pricing, is my understanding. And so let's go with, we're guessing, but I'm going to guess like $44.99 a month, something along those lines. But you're right, Jim. It was felt a little preliminary.
The other framing headline this morning is the group gets together to fend off tech giants when it comes to sports rights. Is that part of the battle here as well?
A lot of those deals, these deals from 2032, and some of these deals last long.
They do.
At the same time, we've got Apple with lots of money that seems to like sports. I mean, obviously, Amazon, Chassis likes sports. It's been really great. So, I mean, there is some sort of three against those are better than one.
Conceivably, although again, the entity itself is not going to be bidding on sports rights. It will be ESPN still doing that. By the way, ESPN Plus, the plan, I believe, is still to introduce their own direct-to-consumer offering. What that will be or how it will differentiate from this or why and how that'll be priced. Maybe it's going to be more immersive. Maybe there'll be more betting associated with it, given that partnership they have, Jim. But it does raise that question. However, Max, remember, which was going to have a sports tier, you thought they're not going to have a sports tier anymore. There's no need for it.
Can this bring in more money to what looks still a tattered balance sheet when it comes to Warner Brothers Discovery?
You know, this is an attempt to try to keep subs and find new ones. That's all it really is. But by the way, at the same time, it could put pressure on the bundle because you could get more people leaving and saying, I don't need it anymore. And that hurts Warner Brothers Discovery with all their linear cable networks, that they get paid for. But the worry has been that, well, you know what, at some point the cable providers will just say, I don't want to pay for all this stuff. I just want Turner. I just want TNT,
I mean, that's it. I mean, how much do you want the whole NHL put together? Do you want the NBA put together? Does that matter to you? Now, David, what is Ellison's view if he got Paramount on Paramount Plus? He doesn't seem to care for it.
Yeah, I don't. Paramount Plus is a bit of a conundrum. If you talk to Bob Backers, the CEO of the company, he'll tell you they're on track and it's going to work. But there are plenty of people who have some doubts. We'll have an opportunity to talk to him.
You have him?
Yeah, I got Bob from the Super Bowl. And again, Paramount, not part of this, but remember, Paramount Plus does have you get most of your sports on Paramount Plus.
Right, that's what I'm trying to figure out where they are.
Also, you get a lot of the sports that NBC has on Peacock already, different than, for example, Max and what is offered there. But we'll talk to Bob. And Paramount Plus listen, that becomes a question. That whole Paramount deal,
we don't
or
know
the possibility of it, I just don't know, guys. I can tell you, I don't believe that Warner Brothers Discovery has any real interest here at this point. I'll be curious to hear their earnings call and whether they address it in the same way that Brian Roberts did on the Comcast call, for example. And the Redbird effort continues to sort of move forward, but it's complex. It's
And
quite complex. And then there's Byron Allen, which I don't really want to get into at all.
No, okay. Now, what is really the size of the people when you look at that chart from Bob Disney who really don't have it? Is it 100 million that this is untapped? 150?
I don't know the number
because
all I know is that number keeps growing as people fall off the bundle. And then the question becomes, what about news? What keeps the bundle? Why?
Well, Jim had this great analogy about layoffs the other day about playing Jenga. Yeah, you're trying to remove as many people without making the tower fall.
But look, and to be fair, that is from Amazon. When I was pressuring Amazon to say, listen, if you cut out 100,000 people, and they're like, well, actually the answer is very funny. Do you want next day or do you want 2 days?
Right.
We don't know.
But isn't the same thing relate to content?
I think it's a terrific analogy.
Yeah.
I don't know which piece of the puzzle makes it so that you want it or you want to get out. And I think that this is one of those things where I really want to get in the minds of the people who never had cable. Do they say suddenly, $43? No, I'm not paying that extra $43. I'm going to Chipotle. But the trade-off here.
I know. You're right. And even then, you may not get everything you're looking for. You know, there might be some game if you're that you're not going to get. But I get it. Completely understand why they would be trying to do this. You've got to try and keep the subs and/or find new ones if you can to support these networks.
Is it that dark?
Is it that?
Is it existential for these guys?
Well, for
kind of.
No. I mean, not existential. No. I mean, they've got a real issue. When it comes to general entertainment networks on cable, it's existential.
Right.
When it comes to news now on cable, you have to have some real questions.
See, I didn't ask if it's existential for us.
Oh, I figured. By the way, it's always existential for us. We're at that age.
Reminds me of the Reuters piece yesterday, also talking about content, citing, I think it was 17 unnamed media executives that were in the middle of a great contraction in content, that we moved our way through the strike, and a lot of those projects that got pulled off the table are not returning to the table.
Well, but look, my problem with all this is, I told the weekend, the regular content, linear content, is not there. But the NFL, how much of this? I mean, the NFL's not. What we have? What Monday night? We have Monday Night Football. What do we get here for NFL? Because NFL is what is driving. The NFL is what's watched.
Yeah. You get a lot of NFL here.
What do I get?
Let me look. Let me look at the release here. You get. Oh, it just says NFL.
Oh, all right, done. Where do I send the check?
I thought they actually had. I mean, yeah, you don't get it all, but you get.
I want NFL through. I want to go to DraftKings and get NFL. You know.
By the way, if ESPN does figure out a way to do that deal with the NFL for where they would take the NFL channels and put them into ESPN for an equity stake, then you get even more, conceivably.
That would be amazing if they got that.
But I don't know if they'll get that deal done. That depends on figuring out a value for those networks from the NFL, and then ascribing a value to ESPN and everybody agreeing. So
well, David would ask me eventually, which is why is Disney stock down and the others?
Why was Disney stock down and the others not?
I don't think that people know the economics yet. I think the economics look like one third, and if it's not the case, then Disney shouldn't be down.
It's not. It's
Then
one third the ownership of the entity, but not the revenue flow.
Well, I mean, Disney reports tonight, so it's you could argue.
And Fox is out this morning.
Yes.
Lachlan's already made some comments about this.
Do we want to listen to the comments from Lachlan?
Well, I don't know.
Let's take a listen to Lachlan, Fox's CEO, talking about this new partnership.
This new and unique digital distribution platform is focused on sports fans outside of existing pay TV offerings. Upon launch in the fall of 2024, the platform will offer a broad suite of sports, including those from a combined 14 linear networks that broadcast sports today. The inclusion of our networks in the platform is consistent with our strategy.
There you go. That's Lachlan. They had something like this in Australia already, apparently. Yeah. I don't know, it's called KO. Yeah. And they brought together a number of providers there. So there was a template for this idea.
Well, just to go back to, we work for Comcast.
Yes, we do.
If Peacock did not get the people to stay after they took the Chiefs Miami game, does that say that there's a power shift here, that Comcast is going to have to go to this group and pay them extra and have it on Comcast?
I don't believe so, but I don't know. And there are still a lot of questions about the direct consumer offerings, including Peacock, and their viability, whether
Because
they can
of the
ever
$3
actually
billion.
generate real cash. Yeah, of course. And Paramount Plus also. And that does lead to these whole questions about consolidation. Really, the question there being more Comcast and Warner Brothers Discovery, of course, not Comcast and Paramount.
Ooh, look
That's
at
not
Spy.
happening. As I said, Warner Brothers Discovery and Paramount's not happening.
And I know that a little far afield, but seems to intrude in everything. Why would the FTC like this? It's going to raise the price for.
It's not change. I mean, but it is
a collusion of three networks.
It's not collusion, though. It's just it's convenience.
Okay, good. I just feel like that.
It's convenience.
They're always on the lookout.
And again, they're not bidding as an entity, and
I don't think she likes you talking to me.
No, I know.
I mean, we may be colluding for all I know.
Lena, yeah.
Not by can or no. Just, when you see good antitrust cases,
See if we open up at 497183.
What do they do with it?
Wow, that's worth millions of dollars.
I feel naked
right now.
All right.
No, but David, one last question.
Jim.
Which of these three actually said, listen, we got to get together?
I believe it sort of began with Fox and, I mean, they're all talking, and I think Fox and Disney sort of started a conversation and then went to Turner when they felt like, hey, there's no issue here in terms of antitrust. Let's get a third.
It's a fascinating story.
Yeah.
It really is. I mean, look, I think that people at home might think, geez, we're imbued with because we're in this business. But no, I think that this is, when I saw the market chart, that was really the way to start it, because look, I mean, in 2016, when the ESPN was 100 million subscribers, and the world is just, it is seismic for our industry.
Yep.
News. You really wanted to bring up news, huh?
Yeah, some news. We got a lot more news. We got a lot of movers today, Jim.
Well, you have to watch us.
A lot of movers today.
We're indispensable.
Don't you worry. Thank you, Brett. Don't you worry.
One of those movers, of course, Snap today, down 30% pre-market. We'll get to that. And Jim's right. We'll talk some Boeing, CVS, Target, Ford, Chipotle, Tesla, Yum China, Roblox, Hilton, and more when we come back.
Tesla. We're almost back to the 200 on the 1 hour. I didn't expect it to be that fast. I had 173, 172.78. We hit 175. Amazon 170 target to break.
Snap is getting crushed in the pre-market. Revenue and guidance does disappoint the street amid stiff competition on the ad sales front. This is what Evan Spiegel had to say about daily active users on the call.
If we look at North America DAU in the fourth quarter, that decline was more, mostly an artifact of rounding. We're not expecting a further decline in North America in Q1. I do think overall, though, there is an opportunity for us to invest more in growth in North America and Europe.
EBITDA forecast, Jim, the loss is almost double the street.
Yeah, I was looking at what they have to pay for their data center business, and they claim that they're getting the cost down. I hope they do. This big deal with Google usually had. Look, I read the call, and I'm a big, now I'll read 10 calls every night, and this was the worst call. Why? Because They say they're doing incredibly well. I mean, there was no mention of how poorly they're really doing, and there was a critical moment on the conference call where an analyst said, "You guys, when are you going to get scale?" And correctly, he said, "We have scale. We have 800 million viewers." The problem is this: you have a person who's 11. That's not your core audience. That 11-year-old is not going to buy a Tesla. That 11-year-old is David, is not going to the supermarket and buying Lay's potato chips. That 11-year-old is playing Roblox. We saw good numbers there. But, you know, you can't make a business anymore on what a 12-year-old is going to spend, how much they're going to spend on Colgate. They may at that very moment start thinking about Colgate, but by the time they get to 18, they're buying on Amazon.
And they're not buying anything? They're not going to Temu or something like that and buying something there?
Oh, I bought some stuff from Temu for my wife. Oh, my God. She said, "Did you get this? This stuff is from China. I'm not wearing this on my body." I said, "Well, yeah, but it was like $12." She says, "Oh, well, then fine." I mean, I tried to get Temu because I wanted to see how much the Chinese communists want to know about me. And at the last minute, I pivoted and bought it from Amazon because I decided that they want me to buy Baba.
I'm saying, look, and you think whatever it is you bought from Amazon wasn't made in China?
No, I directly bought from Temu from Amazon because I didn't want Temu to know everything about it.
Oh, I'm sorry. You did buy
I
Temu,
bought
but
some
you
goods
used
from
the Amazon and said,
right. I bought some goods from Temu, and they distinctly. The moment I got them, I thought of one thing: waste management. Because they went right into the landfill and overlooked stuff.
So volumes will be higher this month.
Yes, it is just a
so
remarkable.
sad.
Jim Fish, I mean, I'm telling you, Temu, waste management, bingo.
What percentage of overall imports of the last 20 years have ended up from China have ended up in a
Have you ever been to the landfill? The landfill?
Yes.
It's a sight to see. It's everything that China makes. It's a little bit of China right next to them.
Well, at least they used to take some of our plastics back. Now they stopped doing that a long time ago.
No,
Yeah?
they make coal
They
plants.
used to take their plastics back.
They are coal buyers.
We'll get Kramer's Mad Dash and countdown to the opening bell in a minute.
Apple up today. PayPal. Amazon. And Meta's Meta's up too. A little bit. They're not from yesterday. Meta. Three-day rule on Snap. Bad earnings.
CNBC.
We got 3 more minutes till the market opens.
Futures holding in there. We're going to get to all the corporate results today. We'll get Disney tonight. A lot of Fed speak. 5 at least with Kashkari already on squawk, and this 10-year note auction after the 3-year was received pretty well. We'll get that opening bell in just about 3.5 minutes.
Be watching Baba right at open here. We've crossed 63 on the 1 minute. Two more minutes. Got a double top on IWM, QQQ, boing. I think we're going to open up 20 points on the SPX. I think Bob's going to be a good little trade here. Right out of the gate. Today's Wednesday. So we'll do a fast scout on the $80 strike. 80 or, yeah, so far the 80. There we go.
All right, let's squeeze in a mad dash, and then we'll have an opening bell.
Quickly, when Fortinet reported last summer, it struck everyone was frightened because Fortinet stood such a slowdown. They're back. It's big. Every cyber stock is now going up. Because Fortinet better than fear.
Let's get the opening bell here in the CNBC Real-Time Exchange. The big board, it's Florida Bank Holding Company, South State, celebrating a recent transfer to the NYSE from the NAS at the NASDAQ. Aravent Biopharma focused on the unmet medical needs of cancer patients. Jim, I wonder...
September 8th on the SPY.
If you've been impressed the way we've held in there after the worst couple days for treasuries in a year.
Look, I think that there's a 10-year today, so I don't want to be precipitous. It happens to be a very big deal. There's $42 billion coming, but it's been holding around 4.1. Interest rates are not. We did have a spike, and the market just said, so what? That has not happened in a very long time. There's actually only a couple periods in the 90s where you could still make money when rates went up. So this is, I was saying last night, this is kind of a remarkable moment, frankly. I mean, we have some companies that are doing so well, and they're leading other companies, and the sectors are amazing, industrial, healthcare.
There we go.
These were ones that should have been hurt.
Baba 76.
To be so bold is that a lot of people who had to get out have gotten out. I don't see sellers at higher levels. I mean, look at the trajectory of CAT from 208 to 330. Where are the sellers? Yesterday was GE Healthcare. GE Healthcare had been pushed endlessly by the shorts, down from 72 to 66. Book 81 on a good quarter. It's like the sellers just kind of evaporated. David, were the sellers vaporized? What happened here?
I don't know, Jim, what happened to the sellers. So
Where are the sellers?
I don't have an answer for you.
I mean, where were the sellers? Disney, 89 to 99. Where do they go?
Well, I don't know. Disney is actually down. It's following through on that sort of
You
turnaround.
killed Disney.
I didn't have anything to do with killing Disney. We'll get the earnings from Disney after the bell tonight. We will hear from Bob Iger as well. I think he's also going to sit down with Julia Borsten
But everyone
for an
seems
interview
to be
after
ready.
earnings. So
No, I know that'll be good.
We'll get more color there on obviously this new partnership that we talked a lot about at the top of the show, and future for ESPN Plus, and more importantly, you know, get a sense for the parks, the consumer,
absolutely,
and Disney Plus.
Well, there's a very good website, by the way, interesting website that Parry.
Oh
Nelson
yeah,
Peltz.
and obviously the proxy fight with Nelson Peltz.
Let me give you an example, Carl. For instance, New York Community Bank, how the regulators
God,
let
darn it.
that, the worst bank in New York, buy the default signature. I just understand how they did that. I'm going to investigate them. I don't have subpoena power. But I do point out that immediately the analysts are out saying, you know, you should buy on the weakness Huntington Bank. You should buy Comerica, Morgan Stanley. And they're right. I mean, last year we were all running from the banks because of what happened. Now people are saying buy the banks. So I just think there's a lot of reassurance. There's also, you'll get a McDonald's. McDonald's will say, look, the consumer's weak. And then you'll sit down, you listen to Chipotle last night, Brian Nickel and Jack Harkin. No, the consumer wants value, and they want freshness, and they want fewer ingredients. And McDonald's isn't resonating for them, which is really amazing. It's finally happened. I think we're at a tipping point where people actually care about what goes into your body.
The Chipotle comps are pretty amazing.
Yes, they
8.4. Street was looking for 7. Operating margin up 140 basis points to 25 plus.
Brian Nichols, amazing, and they do have this labor. When your sales go up, obviously labor costs become less of a percentage. Not even worried about California, but there is, and avocados are down. But this is a company that is, I'd say, this is
Baba Ye.
by far the best run restaurant chain. Now you want to contrast that with Yum, which did have some problems on some of its different divisions.
You got out of it already?
I shouldn't say some, and they had problems on a couple of them, but at the same
I
time.
was going to grab it at 88 and I just missed it.
How about Yum China?
Wake up to what? Oh, Yum China.
Double B.
Oh, I have some good stuff on Yum China. Apparently, the KFC in China has.
I'm going to go ahead and take my profit here too.
Oh yeah?
Yeah, don't you love that?
No, I didn't
Who
know.
knew? Here, Yum China soars. As economy drives consumers, they have Yum China. The numbers where they're incredible. They have a lot of stores. But these guys offer.
I think we could go higher.
I couldn't believe how much.
It's a pretty
how
good sell-off.
inexpensive. I mean, geez, they get like a couple of bucks.
There
you
we
get a
go.
good meal. So
Plus a little div hike and buy that.
Take it to the 200.
I just think that Yum China. I felt badly that I didn't spend more time on Yum
China.
Because it really is good. They have 14,000 stores. There's a lot of stores.
You got a file on look at all
China.
those files.
What do you-
Amazing. On Uber, what are your thoughts?
Look, I think Uber should be
stock
up.
is
The
actually
stock-
down.
The stock ran up.
2.3%. Here's your
The
file.
stock ran up.
There you go.
The stock ran up.
They beat. I mean, they beat on EBITDA. They beat on a lot of the key metrics.
Yeah.
That said, perhaps the expectations were even higher. Easy
The
to say that.
expectations were too high, but I thought Darren did, because I thought he did a great job on Squawk. And
Boy, there it
I
is,
like what he
137.
did, but he is classically not promotional. I say,
134, I'm
don't worry
done.
about it. Good quarter.
EBITDA guide 1.26 to 1.34 billion versus expectations.
Oh, good.
Capital return, yeah. They also continue to cut headcount. Fiscal year 23 headcount down 7% year over year.
Well, and look, the stock, yeah, look, sometimes the initial reaction is not that good, but I think that Darren tells a great story. I'm not worried about that one at all.
Speaking of headcount, how about story in the journal? Tech layoffs are coming for that sector as they reset
Beach trade.
AI. They mentioned DocuSign. There is a story on the tape this morning about Tesla staff being asked about which workers are crucial amid some of these performance reviews.
I still am reeling from the idea that a court found that. I know that.
So that's called a gap down trade. We got earnings coming out on Baba. And we had all that good news about China yesterday. Xpeng wants to get his faculties together. So when he comes in like that, something's going to be done. So I come in here this morning and see this earnings play on Baba. I'm going, what the heck? Looks to me like a little overdone. So we held support down here at the bottom. My fingers weren't fast enough. I could have got this thing at 88 cents at a double bottom down here. But we have higher lows if you use the body of the candle. Higher low, higher low, higher low, which makes an ascending triangle or a good upward wedge. And then you got three white soldiers coming out of the gate here. What'd I do? Oh yeah, Baba. Whew. God, I thought I traded SPY again. SPY pulled back to the VWAP, so it's got to stay bullish by being there. I was pretty much close to resistance. I said 49.7183, and we're above it, so that now becomes support. PLTR. Bingo.
That's to NVIDIA. It's lesser sent to Lisa Suet.
Oh man, there goes 156 for Baba.
Left out of this
Sheets.
last 24 hours, which were NVIDIA and Lilly. Lilly, the analysts were saying, why didn't you give us more about this NASH trial? We talked about 6 million people who might die from this disease. So, because we just got to phase 2 yesterday. I mean, come on. Lilly is another stock that was victimized. It was up 40 and people took it down. NVIDIA, there was a spread the wealth campaign yesterday to other sectors. Merck is now one of the best performers. I knew care
Yes, it is. Merck is one of the best performers this year. Obviously, Keytruda continues to be such a key drug when it comes to treating cancer.
So there's a great variety of stocks that are working, and that also just plays. Look, I don't like the broadening term because when we were doing well when there was FANG, but wow, you find that you'll have the analysts, the long knives out for David Gibbs on Yum because of Pizza Hut, right? And then then the buyers say, I don't care about the long knives, I'm buying the stock. Another good example, when I was out, when I was out in California, everyone says that Karen Lynch is beat, and I sat down with Karen Lynch, the CEO of CBS. I said, are you kidding me? She's a killer. This thing's going to be something to buy. But then there was this Jim, CBS going to get crushed by Aetna or whatever.
Yeah, and that's on the guide cut for the full year on profit and cash flow.
I think
some of these medical costs.
They did warn about medical costs. I mean, we saw what happened to Humana, but these guys seem to have managed it far better.
Humana was horrible. Humana offered a package that was completely unnecessary.
Right, that was obviously Medicare Advantage, but
and that was that Hail Mary to Cigna. Give me a break. That was terrible.
The other names, Jim, 9-month high for Target today on this headline that they are considering perhaps a membership program like Amazon Prime.
You can't beat a membership program.
Gordon Haskett goes to buy on them.
Yeah, so that Target's a very cheap stock at 17 times earnings. I'll give you one that I think last night, a derivative that was really important. There's a company called AZEK, which they make DEC, very high-end DEC. I use it. It looks like the real deal, okay? And their numbers at Home Depot, boom, really strong. I think Home Depot is a winner ahead of their February.
Stephanie's liking that one.
Because the professional contractor is back to having 7 weeks of backlog, which is very good news. And the professional tends to shop more at Home Depot.
Although not at VF Corp.
No, Brackendow's got his work cut out. Brackendow's got his work cut out from them. I think they need to do a deal. Bracken typically is smarter than anybody. He did great. He's done great things at Logitech. He was at Procter & Gamble before. I don't want to give up on that company, but that's he got a bad hand. You took the bad hand there.
Well,
yeah, he's showing it 2, and he's got 4.
Hasn't turned it around yet, has he?
Well, he just got there.
All right, I just said he hasn't
turned it around. There's David with the short leash. Let's get rid of him. He's been there for at least. He's been there for what? 106 days.
Never get rid. I mean, just the name alone, I got to keep that guy around. Such a great name.
Brackendow. I know.
It sounds like the company.
Yeah.
I went to Brackendow.
Exactly.
I'm long Brackendow. I got the Brackendow. I got the $39 a month
What'd you pick up down at the Brackendow?
What I got?
Yeah.
It's a treasure hunt.
Was it? Oh, it's a treasure hunt down there. Speaking of companies that just have never turned it around.
Oh, hold
what
on,
about?
but
No, we've already talked about
Charter?
it.
What?
No. Well, Chris Winfrey's had a little trouble there. Snap. Look
no,
at a
it's
5-year
Snap.
Snap.
Then
Like
you
when do
got-
you just? Would anybody buy this thing? Like, could he just
you know,
put
I
it
thought
out of
about
its
that.
misery?
I thought about that. Who is going to buy Snap? And then I tried to think, okay, who knows less than Evan Spiegel? But I couldn't come up with anybody.
Just like look at a five. I mean,
No, it's
a painful trouble. By
David,
the way,
they're doing great. You just are looking at the stock.
They're
doing great.
Meta, which is so much larger,
Oh my God,
you can't
Meta's
even
so good.
calculate it,
Meta's
is
so
still
good.
growing faster and yet has a lower multiple to free cash
30%
flow.
growth. 30% growth for Meta.
Looking at some of the numbers here.
No, I feel bad.
The
Let me just
revenue
say,
growth number is
I'm gonna
so
say
far
it.
ahead there.
I'm going to say it. I'm going to say it once, and that's the only time. Evan Spiegel, nice guy.
Oh boy,
That hurts. That
you
hurts.
you nice guy him, huh? All right, Evan.
Jim, we haven't touched Ford.
Oh,
That's going to be about a 9-month high, or maybe 6 to 9 month high.
Okay, so when Jim Farley came in, oh, by the way, Adam Jonas with the finance
Yes,
call.
yes.
Butch and Baba again.
You know, you guys, Ford versus Ferrari, Ford wins. And that is no.
If we touch the 21
it was like written by, like,
on the
somebody
1 minute.
America Friends. I don't mean that. Backward, that's fine.
Or the, well, there it is right there.
You know, there are only a couple guys in this business to make it worthwhile for us. And Shaq and Barkley are Ives and Jonas. Now, I will say this. When Jim Farley came in, he told me, we're not going to make vehicles that we don't make money. Which means the second generation of EV, ICE it. Oh, I like that. ICE it. Did you get that? ICE it.
Well, you do have this times piece, how Ford's F-150 Lightning, once in hot demand, lost its luster.
Lost its luster.
They'll sell it.
Okay, SPX is coming to support here.
And that was the end of the pickup.
Last night was really about hybrid, the greatness of the hybrid.
SPY has to hold, right? Well, didn't hold the VWAP. We could go to the 200 pretty easily.
Go to Costco together.
Oh yeah.
So that's probably where I'll look at it.
We'll go to Brackendow. We'll go to Costco, and like you'll crush it.
I can't. When did
And the Baba's down to $1.
No, it'll never happen.
Yeah, you're right.
The 76 strike.
You won't believe it. My dog food for 7 years now.
Really? You can, well, I have nowhere
Right
to
back
put
to
it.
support.
Oh, that's right. He's in an apartment.
Yeah.
Oh, you got to have one of Lisa's houses. We'll put one of Lisa's
I
houses.
do. Can I rent one just to?
But
store
Ford
the
Motors
Costco
we
dog food?
got the special. Now they have $5 billion that they're going to lose on EVs. That's the end. And Jim understands the software business is very good for the pro. I'm putting a stake in it. I'm saying Ford bottom, but Toyota. We don't talk about Japan.
No, we don't talk about
In
Toyota as much.
1989, they were kings.
And they're looking pretty good again. No, not bad.
They are.
Over in Japan. Economy's growing.
What do you say about that?
Toyota's feeling good about their hybrid strategy right now.
The enigma of Japanese power. Wonder how the Chinese feel about it. Hey, they put the butcher in
Okay, I
charge.
got it at $1.
The new SEC guy in China. They call him the butcher. Well, I mean, yeah, I think he's a butcher for sellers. The problem, of course, this is what always gets China in trouble. The numbers are bad.
Baba was higher, then flipped down on a double beat.
I know.
Got a buyback in there. They're cutting 20,000 headcount.
They
Speaking of that.
got to shoot some of the sellers. That's just 1 or 2 sellers. They shoot them, and that's done. You sell after they shoot a couple sellers? I think you hold off.
Come on,
Did
give
you
me
see the
90. There we
execution?
go.
Go back and look at Amnesty International. That's where I get my information.
What time period?
Well, this was during the bottom. I got the 2015, 2016 bottom and looked at the executions in China using Amnesty International. I think they formed the bottom. It was either that, David, or it was that reverse Head and Shoulders.
I will take a look. I'm still, call me skeptical that they were actually killing people for selling stocks.
Well, I just tried to
Okay,
have white collar. Okay, will you give me the damn
willing to
white collar
accept that.
executions according to Amnesty
No, I
International?
think that they have a system that is different than our own and is, yes, more
There you go.
vituperative perhaps in
Yeah,
terms
well-
of how they treat their participants in the capital markets. But I don't think that they're stringing people up for, maybe I'm naive.
Well, all you have to do is, I guess you go to Tucker Carlson. He's just interviewing villains and dictators.
He's my go-to. Isn't
right?
he your go-to too?
I had to
Carl?
mention just because I thought it was.
Yeah.
I just didn't think it was what I would have done at this stage of humanity.
I think it's fair to say, Carl, that
For the
he's not a
numbers.
fan of China's.
Right.
I'm coming
And in
around.
fact, he's advising what he hopes is the incoming administration to go with the 60% tariff. when he is Treasury Secretary, what are you going to be?
Stop it.
Or
Stop
Fed
it.
chair?
It was discussed at home. Don't do that.
I think Treasury Secretary.
It was discussed
That's
at
what I'm
home.
going with. I'm sure it was.
It got to the boss.
It did? And
yeah.
boss nixed it?
The boss.
Even if the call comes and
the
says,
boss
we'd like
said
you to serve?
that I keep hearing that David said that you're going to be involved in the next administration, and let's just say I hope that David is misguided, and I said I have no comment.
Why? Give her an opportunity to buy some new real estate.
David makes, it's what I make fun of his dog.
Yeah.
He makes fun of my wife.
No, I'm not making fun of her. She's a magnate.
No, I said life, not
life.
No, if you make fun of my wife, we're just. Here's what happens if you make fun of my wife. Okay, I'm just like, hey, it was really great to see you. It's been fabulous. 25 years, you're really great. Okay, that's what we do. Because you see, the first time around, never mind.
I would never do that.
You know,
I like your wife.
Good. Now, Elf is down. That is.
I was going to ask you about Elf as it pertains to the consumer, and then Hilton, Jim, which is at new highs. After this beat.
Well, I mean, look, I think Elf is just the shorts working it because Elf was a great quarter, and Hilton was not that bad. Look, travel's doing incredibly well. People like Marriott. What's incredible is that Estee Lauder lost a lot of share. They might deny this to Elf, and yet now Estee Lauder's down, but they called a bottom in China. Most think it was Hong Kong. Elf was, look, you want to sell Elf, that's fine. Look at the chart. I mean, the stock has run. #1 in Target, by the way. One of the greatest performers of all time, by the way, Elf.
SPX is retesting right here.
Yeah, how's that doing today?
Not well. It turned around. It was up. They got a Moody's downgrade. I mean, okay, great. Long-term issuer BA2 now. They had a conference call. They continue to reassure on obviously deposit stability.
Right.
But they're just coming after it, Jim.
Well,
That's really what it's about.
I went
here.
back and
83 billion up from year end in total deposits. Total insured collateralized deposits 72%. Total uninsured, excluding collateralized and internal deposits, are 22.9 billion. Over 10 billion of reciprocal deposit capacity, and on from there.
Right. Did you?
That the question's been asked. They continue to describe as fine or stable their deposit base, and yet we just have this pummeling of the stock price, which at least you can say, we got to follow this more closely. Market cap wise, there's not that much left here. Will it have a systemic impact? Hard to imagine it would.
All right, so how did they get the bank? If you take a look and go back to the original research of when they got the bank that crushed them.
Signature.
Yeah.
The assets from Signature.
The Fed was like, okay, fine, you guys have it. Meanwhile, they had terrible commercial real estate.
Yeah.
I mean, someone dropped the ball at the New York Fed. I hope it wasn't Josh Frost. I mean, is doing the tenure today.
No, they were not. They were clearly not the proper buyer for those assets.
Oh, okay, so you say that. So the people who made the decision, weren't they capable of looking at the New York Community Bank back? I was saying that this bank should be sold and sold and sold, and I was worried about the dividend before they did so.
I mean, the JP Morgan downgrade, there are two of them, but the JPM one asks why you would let the chief risk officer go and not say anything, given the changes at foot.
They have a new executive chair who hosted this conference call. We're going to have more on this. We got to continue to monitor
I wish them luck, but anyone else deposits there, please do not worry.
As we go to break, let's watch bonds. As we said, be a busy afternoon for Fed Speak. Kashkari already joined the gang on Squawk this morning. We'll see if the 10-year manages to hold this four handle right now by about 7 basis points. Back in a moment. Harry.
Bob is at 106. I'm up. We're at 96. I want to see if I can get back to the 200 today on Baba. I got it at $1.91. Snap, I got 10.21 for support.
but it seems like activists still cost cuts, that maybe there's unnecessary overlap, that things need to be really clearly kind of like defined.
It's a really good point, because we think back to last year, about a year ago, we were having a similar discussion with an activist investor push, and initially the cost-cutting plan that Bob Iger put forth kind of, kept, the masses at bay, foreseeing just trying to find changes at Disney. Right now, a year onwards, there was these $7.5 billion in cost cuts enacted last year. The question is, of course, is that enough? Could they do more? And as you highlighted, there are these other questions about, would Disney be better being run separately with a couple of different spin-offs here, or keeping it together? And one of the things which I think is important to highlight for Disney is historically how well the company has been able to build a flywheel.
Ooh, aluminum's down.
Generate one part of the business is then monetized across
Lumina.
several different areas with big feature films.
Coin back
to
down.
Rides at Disneyland.
For double bottom,
theme cruises
triple
as well.
bottom.
So there's definitely still a lot of synergy based upon the way they monetize their IP and bring that out in a different number of different parts of the business. But it will definitely be interesting to see if even after making all the cuts the company did last year, if there is perhaps room for further improvements.
Come on.
Okay. All right. What would surprise here? What would be a big, positive?
You got room to fall more.
For the stock. Obviously, it's underperformed. A lot else in this market now. What do you think would be kind of the shock, good news?
So in terms of shocking good news, I would circle back to the streaming portion of the business. This has been really the biggest challenge. We think back to when Bob Iger returned to the company. A huge reason for that change was the fact that streaming losses had ballooned. They were $1 billion and plus in a single quarter. So seeing more improvement than expected, if we just remember where we were last quarter, lost about $370 or so million. If they have extra improvement there, that will definitely stand out. And then also on the subscriber growth side, we're coming on the backs of a particularly strong round of earnings from Netflix when they added in 13 million subscribers. So seeing if Disney can replicate or come close to delivering strong numbers there will definitely be a difference maker for the company.
Okay.
Go get my coffee and be right back.
Jim, thanks for the perspective. Nice setup for into tomorrow's or tonight's
We got a triple
report,
bottom here on
Alex, let's do some trading. Looking at the options.
Baba.
You got two trades. One is very earnings specific, short term. Another one is looking at the long term. Let's go to the kind of earnings specific trade here for tonight.
Yeah, so expiring this Friday, so the Feb 9 expiration. Looking at an iron condor. Dollar-wide strike availability in this weekly options cycle. What I looked at was the stock at the time, and it still is trading close to about 97.5. Well, there was no 97.5 strike, and I wanted to do something kind of in the straddle family with risk definition. So I kind of synthetically created it by selling a 97 put and selling a 98 call. So sort of synthetically creating that 97.5 straddle. Now it's a little bit different. It's a dollar-wide iron condor, but nonetheless, you're collecting a pretty chunky credit for that. Now, because this stock's been a little bit more beaten down, now granted it's rallied about 25% off its lows, it's been in a 3-year decline. Your guest talked about some of the focuses that they've had and things that could lead to potential optimism in this stock. I looked at kind of giving this some attitude to create a risk profile that takes no upside risk. Now, you can give back all the gains and break even to the upside in this case if done for a $3 credit, but there's no theoretical upside risk. So $6 wide put vertical, $3 wide call vertical, kind of surrounding the current share price. So the 97, 91 put vertical, 98, 101 call vertical, $3 credit. Because it's a $3 wide call spread, $3 credit, theoretically no upside risk. Break even to the downside would be 94, and you'd have $300 in risk. So this thing does best between 97 and 98. See that dollar wide sweet spot where it can theoretically make as much as $300. But most traders would put this type of a trade on prior to the earnings, see what happens post-earnings, hope for kind of an underperformance of that market expectation, volatility comes in, and then if the market cooperates and you'd look to try to buy this back or offset it for a debit less than you sold it for. So it's more of a capture the volatility collapse, hope for a small move.
Okay, all right, so betting that Disney kind of stays a little stuck. There's not any big shocker in this a report that
Or
seems
if
like
the shocker happens, go to the upside.
Okay, there's a little bit of bullish bias into it. All right, nice. Longer term, what's the best play? Like if you want to just kind of position for a general recovery or whatever kind of the chart favors at this point.
Yeah, I think it just depends on the individual investor, of course, but many, I think this is a kind of a stock they put in that value camp, and they're maybe looking to accumulate shares or maybe already own shares. But say you're in the camp that you're looking to accumulate shares potentially into some weakness. And so one way to do that, or to attempt to do that and be paid while you wait, is to sell cash secured puts below the market. And then if there is that sell-off, you're potentially assigned or put the stock, and then you become the shareholder, which was your original goal, of course. So went up to the March 15th expiration, so a little bit over a month from now. So that's super long-term, but it's in that long-term mindset of potentially becoming a shareholder and an investor in this name. Now, this was actually trading for a little bit over $1, but makes the math easier to talk about. $1 credit would be an 89 break even. And then, of course, you'd be exposed for that same risk that being a shareholder at 89 would give you, which is you have $8,900 tied up in this position. That would be fully exposed, of course, if Disney went down to zero. But I'll let those at home decide what they feel the probability of that happening is in short term. It's neutral to bullish because, well, if it goes down, that's where your risk is. And, of course, it's neutral because the stock doesn't have to actually go up for you to reach max profitability. This trade, the max profit is the credit received, so $100. But really, in that mindset of potentially becoming a shareholder, I always think, hey, you're basically paid to potentially have happen what you wanted to happen, which is that you would put the stock at a lower price.
Okay, all right, makes sense. Like it. So some little downside in Disney, thinking that maybe, you know, the worst, absolute worst possibly is over. That's not going to break down much further. Down 1.5% today. So maybe it's got a little bit out of its system ahead of the report. Thanks, Alex. All right, we're in hour 2. When we come back, let's talk some tech. Get ready for ARM Holdings. Another report for Intrant from last year.
Meta's still looking good.
Space. Should be a fun one. We'll get ready for it next.
Well, this is the last support right now for Bubba.
Ameritrade is now part of Schwab, bringing you an elevated experience tailor-made for trader minds. Go deeper with Thinkorswim, our award-winning trading platforms. Unlock support from the Schwab Trade Desk, our team of passionate traders who live and breathe trading. And sharpen your skills with immersive online education, crafted just for traders. Also, you can trade brilliantly.
Welcome to Schwab Network.
Daily live exclusive content tailored to today's investors.
Broadcasting 24/7 from our studios in Chicago.
And from the heart of Wall Street at the New York Stock Exchange.
Up-to-the-minute market insights.
Example trades and
Not looking too
stock-specific
good.
analysis featuring the smartest minds in the business.
No politics.
No noise.
Analysis ahead of the biggest events for the economy.
From bell to bell and beyond.
Watch live
and on demand.
24/7, 7 days a week on schwabnetwork.com.
And on all your favorite streaming services.
Available anytime, anywhere.
On any device for free.
Schwab Network, empowering every investor and trader.
Every market day.
I got screwed on that one.
Empower your portfolio with the Schwab Network. Available anytime, anywhere, on any device for free. Schwab Network.
We could hit the 200 still in the hour.
All right, we're in hour 2 of Morning Trade Live. We got a lot of earnings still ahead of us. Let's talk some intraday action with Ben in a moment here. We're also going to get into a little preview ahead still as we're thinking about companies set to report. Arma Holdings is our morning trade. Equities right now have lost the Russell, small caps declining, but that's pretty much the only real notable action. Not a lot of news flow today. A few Fed speakers peppered into the mix, but nothing terribly market moving on the calendar. So we'll continue to talk stocks. We're going to take a look at charts in some companies coming up, so we're also going to be deep diving into Uber. So a lot of stock specifics on our plate, from tech to consumer and a little gambling with Win. And take a look at the China connections there, and a little sleeper AI play in one of those charts. So a lot ahead. Company specific wise, Finn Lichtenstein, futures host, sir. Big market picture this morning. I mean, other than that Russell fade, there's not much going on.
Yeah, this has become quite the pattern, right? Where the Russell does not want to participate necessarily along the same line to the other three majors, but also a bit of a chop, right? We're kind of just grinding. Even as I look at the market today here, we've got a new intraday all-time high. We've come off that just miss of 5,000 by about 3 ticks, I think it was, in the S&Ps, Oliver. And for the most part, you know, I think a win for the bulls. We talked about earlier this morning on the Future Show, Oliver, how us as analysts, we've been kind of splitting hairs here, talking about Fed rate cuts, the data and all, but the market all along has really just been focused on the fact that we hit peak back in October, and since then it's been off to the races.
Yeah, S&P so close to that 5,000. I mean, this Russell's just, man, it's a wild bull. You know, get into the ring and good luck holding on. Every day, it's up and down, up and down. It's like the haven of volatility. If you're looking for volatility, you got your small caps.
Yeah, it has been an outlier to say the least. And I think while the bulls would like to see that broader based participation, again, getting back to my point earlier, it's obviously not a necessity, right? The market's managed to continue higher without small caps joining in. We've seen even strength in the dollar recently, back above 104 to 104.50 area, back to middle of November. And that didn't even derail the Dow, you know? We've got mixed activity in terms of some of the tech names, but the NASDAQ's been, again, shrugging off the negative, focusing on the positive. The one that has been struggling here, you can see, which has been the Russell. And this is, you know, kind of like a lot of the other products that we look at, like crude oil, the dollar, gold, on the bigger picture as well. This has been very much range bound and contained here, which in many ways, maybe that's, you know, kind of why we're seeing some of the optimism for some of the tech names and some of the large caps, for example, right? If there's not a lot of opportunity here in small cap names, then that kind of drives that enthusiasm for some of those other areas.
There's not a lot
PLTR
of
still looking good
in charts right now outside of some of the big tech stuff. In the NASDAQ and the S&P. Russell, no trend there. At your point, pop and sideways. Gold, pop, sideways. Bitcoin, pop, sideways. Crude, drop, sideways, right?
I will.
Yes, I'm in the Baba still, but I'm worried about it.
If you want to talk about trend, look at the exact opposite of what we're seeing in the S&Ps, which is bottom left to top right. Pull up beams.
You have a few at 50 cells, shit.
Commodities have been struggling.
Yeah, I mean, and you mentioned gold, range bound.
It's bored better than I got.
Range bound as well, which again,
it needs to hold this support.
Stocks, right? Nobody wants to see crude above 85, around 90. No one wants to see it below 60. But this.
It's not looking too good. I say it has to hold 73.60. Right here. You can't go much below it. Damn it. Well, I really wanted that to hold. We're at the 200 now. So I'm going to just hold on to it for a second. I could spend another 1,000 on it. Break the 9.
Because their R&D spend continues to ramp up, especially for some of the areas of the business that we kind of talk about on a daily basis here. AI, artificial intelligence, they're building out intellectual property around CPUs and GPUs and trying to sell those licenses to some of these chip makers and things of that nature. And then also their automotive business continues to ramp up at a very rapid pace as well. So I think we're going to get a lot of insights when we get this earnings announcement, because it's kind of like the Qualcomm. It has its hands in pretty much every industry that utilizes chips, from analog to some of the advanced chips that are out there, even the networking chips that are out there. So I think this is going to be a very good report. Once again, that IV is fairly high, but that's because we just don't have that much data post-IPO when it comes to this company.
Okay. So looking at its connection into broader themes, it seems like it could be somewhat attached, but just kind of riding the wave. If the wave is big, they'll be there. They're not exactly, the earthquake that's causing it. They're not the disruptor underneath the surface like NVIDIA.
Yeah, and that actually could be the risk. So if we do see guidance miss the street's expectations, they could actually see a pretty significant sell-off here. A lot of this move and this momentum, once again, is kind of piggybacking off of the main narrative of the semiconductor space when it comes to artificial intelligence. Now, they do actually have some partnerships when it comes to NVIDIA, and they are working with some of the big players within this space, so they probably will see a little bit of a tailwind from that, Oliver. But once again, their top-line guide for last quarter did actually miss the street's expectations. We saw it sell off going after that print, and so that is, I think, is going to be the biggest risk. When you have a new stock like this that's IPOing, a lot of analysts are really using anecdotal data in order to try to come up with estimates, so we can have wide-ranging estimates, and disappointments can come because of that fact here. So I think the downside risk is really significant, but they have been able to
break out
on their conference call. They have been able to put the right news pressers that are out there regarding their updates to technology, and I think if they can show that when it comes to their financials, they might be able to maintain, if not even move to the upside post this report.
Okay. Look, it's been pretty good, despite the chop on the last earnings. To your point, things been grinding back, but it's just kind of hard to know with this.
We got to break the 21 EMA and cross the 9's got to cross the 21.
Lift
or that's the SMA.
Overall in the market, I mean, that earnings
simple moving average.
Right in the midst of that whole November upswing in the market around big Fed, expectations doing a 180. So it's a little bit tough. Maybe this is one where, earnings provide entry opportunities if the broader backdrop is favorable, because it does seem like profit-wise, they're still fairly far behind some of the more stable chip-connected.
Yeah, that would have been a good buy there.
Yeah, so on a gap basis, they're
50
still not
cents.
profitable at this point. I mean, they're going to have to improve their operating margins by about 15%,
That'd be up.
almost 20% in order for them, all else being equal, in order for them to be gap profitable. But on an adjusted basis, you are right. Now, I would say this company, if you look at it from the financials, is actually priced higher from a fundamental standpoint than NVIDIA is. And that's going to be, once again, that big hurdle, the expectation that they're going to have their hand in this space and they're going to be able to expand their AI capabilities here. They're going to have to be able to show that in this earnings announcement, because why pay a lot more money for a company that really isn't gap profitable and actually from a cash balance standpoint continues to utilize it for R&D, where you can own NVIDIA, which has had a decent move.
SPY broke out, boom, boom.
What it's trading at right now is only around like 31.
SPX, boom, boom.
Multiple, which is considered to be reasonable in the semiconductor space right now.
All right, yeah, fair enough. Okay, good look at the fundamentals in the market's assessment through the chart and the valuations. Going into the support. Thanks, KG. Let's do some trading with Scott Bauer, CEO of Prosper Trading Academy. Scott, what do you think? ARM numbers good enough to hold up on its own, or is it contingent on kind of what the broad market sentiment does?
Yeah, you know, as Kevin mentioned, it's a total crapshoot. We really don't have any history to go on here whatsoever, and it's a coin flip.
Be careful with that Baba trade.
Situations like this where I can't analyze charts, I can't really analyze fundamentals. So all I can.
I still want it to break the 1, 2, 3.
Where can I try and get some value from this?
Yeah,
and
where?
So I look at this and say, yeah, there's probably a lot of downside here, but if you look at the option skew is out of this world. It is ridiculous on the upside to the call side.
Oh.
It's about twice as expensive on the upside calls as the downside puts. I mean, it's almost like we were back in the GME and the AMC YOLO area where people were just clamoring for calls any way they could get them. So what I'm doing, because that skew is so ridiculous, and the upside call spreads are so cheap because of that,
On ARM.
I'm actually buying a $10 wide call spread, 75-85 call spread that expires this week. I can do it less than $2, maybe around $1.75 or so. So this pays out if there's a big move to the upside. If there's not, I know what my risk is. I can only lose what I pay for this. But again, the only reason I'm doing this is because the value is there. The reward to risk is there on this thing. I honestly don't have an opinion up, down, higher, lower, bullish, bearish on this one. So I'm just looking at a trade that brings me potential value.
Okay. All right, so manipulating some of that call skew, it sounds like.
I mean, it's ridiculous. The higher you go, this is priced out almost like a commodity would be, like a corn option or wheat, where the upside calls get more and more expensive from a volatility standpoint. That's what is going on in ARM right here. And you know what? If it's a bummer of a report and it's a downside, okay, my 175 is my risk. If the call skew hold, if there's a big upside move, that 175 can expand out to $10.
Nice. All right. So it's a pretty good opportunity then to take a bullish position, because you can hedge yourself out using the folks who are extremely bullish.
Exactly. So I'm letting them have their really, really expensive, calls from a volatility standpoint, and I'm buying some calls that are still expensive but much cheaper from a volatility standpoint.
All right. Makes sense. You got to get a little bit of upside here, $2.50. Get some hedge and comfort around the low 70s too, so you don't have to totally smash this out of the park. Good eyes on the call skew. Good eyes on the options ball. Like the trade.
It'll be interesting to see how this plays out, because again, if all your viewers, the listeners are looking at this skew, you can look at like a 10% out of the money call versus put. The call is priced more than double, more than 2x what the put is.
Wow, that's a lot of bullish optimism for a stock that was super choppy last earnings.
For sure.
All right, thanks, Scott. Good eyes, good trade. Scott Bauer, CEO of Prosper Trading Academy, ahead of ARM tonight. When we come back, let's get some more details on Uber. We're joined by former chief business officer at Uber, Emil Michael, comes back to us. for a deeper look into the numbers. Stick around as we talk ride sharing and its dominance over Lyft.
Amazon at the 200. Let's see how this snake works on my Baba.
Chairman and CEO at DPCM, former Chief Business Officer at Uber. Emil, I think the last time we talked, you described Uber's performance as stellar. Would you describe this earnings the same way?
I would. I mean, they're clocking in
Snake breakout, pullback. We got to see if we want to break resistance, and that's just above 74 bucks
EBITDA,
on Baba.
At record highs. You're looking at a multi-billion-dollar EBITDA year ahead in 24 if this performance continues, and 7% lower headcount at the company. So, pretty interesting stat that I didn't expect, and it deserves the $70 that it's at.
Tell me more about the stuff you didn't expect.
So on the upside, I didn't expect them to actually reduce headcount without a big sort of reduction in force. Dara had said that he was going to keep headcount constant, and actually it surprised the upside that their capital costs are lower by 7%, which shows some real leverage in the business. On the downside, the one thing that was surprising was that the revenue growth on delivery, Uber Eats, was only up 6%. So that actually dragged down the company's average a little bit more, and that was surprising too. But overall, the surprises were pretty fantastic.
It seems like to me, like a couple of years ago, people were talking about how kind of the ancillary businesses, the freight and Uber Eats, were going to be the big kind of shining star and the saving grace. Kind of seems like it's just the classic core ride hailing that's really dominated. Am I wrong?
No.
No, the classic core ride hailing is the vast majority of Uber's sort of success today. Freight, Uber Freight is definitely the opposite. It's shrinking, but it's also volatile and depending on freight prices, but it's still a relatively small part of the business. I think the one thing that I'm sure Dara's going to look at in the coming year is the big revenue number in Uber delivery, which is Eats. That growth slowing, especially if you compare it with the DoorDash that I think is going to be showing upwards of 20% growth, while Uber Eats is only showing 6% growth. Now, Uber's Eats is global, DoorDash isn't quite global, so that may be part of it, but I'm going to look forward to see this week on DoorDash earnings what's going on there. But rides is the thing.
Yeah, mobility 29% growth, delivery 19%, still both double digits, but rides definitely surprising and continuing to show a lot of growth. How much is competitive advantage? What are they taking market share from Lyft? The stock market certainly seems to be suggesting so.
Well, so you were just talking about the gross bookings numbers, and I was talking about the revenue numbers. The reason they're different is because a lot of the laws in New York and other places on minimum wage for delivery and so on impacts revenue, and therefore you want to look at that number where Uber Eats only grew 6%, but gross booking, but for rides it was about 20%.
Yes, good point.
I see what you'd say here is. You kind of look forward and you say, well, what do they have to do next against Lyft? And kind of, if I were Dara, I'd want Lyft around, limping along. The difference is 99% of the profit's going to go to Uber, even if Lyft hangs around at 25% market share. It's just because the economies of scale.
Okay.
So that's that. Them hanging around and not taking share but making more of the profits. That's what I'd be doing if I'm Dara.
Got it. So this is almost kind of a year of efficiency in their mind as well, like we've seen elsewhere. Is it obvious how much more there is to mine there? How can they make it even more streamlined?
If they do this year what they did last year, which is just hold the line, and in any company there's natural attrition, people leave, and they reorganize to fill those holes without really filling them with new people because their operations are getting more efficient. And this is not to be cruel to the people who leave jobs and or unfortunately get laid off sometimes, but it's to say if they could do more, the same or more with less people, 7% less in 23 than in 22, another 7%, that would be enormous leverage on this business because it does so much revenue.
Okay. Going forward, Uber's dependence on the state of the economy. Obviously, right now we're hitting above expectations. Dara did talk in the call about what they see in the strength of the consumer. Do you view this as being a premium product? What does it look like if things slow down? Is that a worry? How will Uber respond to such a situation?
Uber's been pretty resilient in economic, slowdown times and economic boom times, with the exception of COVID, where the rides business got decimated, but the Uber Eats business really took off. So it's got a lot of resiliency in this business model relative to the macro climate. I will say this, that rides have gotten more expensive to the consumer. It's at least tracked inflation. And if there's some weird sort of change where inflation continues but wages don't rise, maybe in that case you see something happen strange. But even if you have a little bit of a material slowdown in 24 from 23 on economic growth, I think you'll still see Uber rides printing 20% year-over-year growth. One of the statistics I saw was that they grew a smaller number of platform numbers but more trips, which means people who are already users of Uber are using it more every month and every year.
It's a great
so
stat.
They're deepening the usage over time, which is a really important stat to look at in a positive way.
All right. Seems like the profitability elements too. We crossed that bridge. No going back.
No going back, except there's one weird thing in Uber's financials. It owns a lot of stakes in other ride-sharing companies around the world. And so its actual net income fluctuates based on those other companies' stock prices, like Didi in China or Grab in Southeast Asia. So, you could see one quarter where they go negative, but their actual, and that's why it's important to look at cash flow, their net cash flow, and their net cash flow. There is no going back to negative on that. That is for sure.
All right. Emil, thanks for the conversation. Always great details and awareness of the numbers. Appreciate it.
Good night. Have a good day.
Thank you. You too. Emil Michael, Chairman and CEO at DPCN. All right, Uber doing a lot of things right here. The shares giving back a little bit after a huge run. Not much to say there. Coming up, let's look at some charts and get technical.
Just ain't working.
3 very interesting businesses as we continue our earnings discussion. Wynn Resorts has been trying to rally the last few months despite Chinese weakness.
SPX, boom.
PayPal, which has had a real tough couple of years. And also a fun AI-connected trade, Monolithic Power Systems, semiconductor winner, a little overlooked, all with earnings.
Boom.
This week.
Knock, knock. Number one broker here for the number one.
I love
hitmaker.
trading this baby.
Thanks for swinging by, Carl.
No problem. So what are all those for?
This lets me adjust the bass, add more guitar, maybe some drums.
Wow, so many choices.
Yeah, like Schwab. I can get full-service wealth management, advice, invest on my own, and trade on Thinkorswim.
You know Carl is the only front man you need.
Oh, I gotta take this, Carl. It's Schwab.
5,000 strike.
Have a choice in how you invest with Schwab.
Every morning, every trade, always live. Expert earnings analysis, in-depth technical insights on every changing trend in markets. Available anytime, anywhere,
boom,
any device for free. Welcome to Morning Trade Live on the Schwab Network. I'm Oliver Rennick.
Get each and every angle, the whole picture. Everything comes full circle on Trading 360. Catch us right here at the New York Stock Exchange on Trading 360, only on Schwab Network. Download the Schwab
Definitely
Network
broke
app
resistance.
and join in on the latest market trends. Available anytime, anywhere, on any device for free. Schwab Network.
Accelerate your market knowledge and shift your perspective into full gear. Real-time example trades, a full hour of trading insights.
I'm Tom White.
I'm Kevin Hayes. Catch me on Fast Market.
Jimmy's going to be looking at puts.
Fast Market, ready for you, ready to go at 12 p.m. Eastern on the Schwab Network.
The 49.75.
And also a chip maker that's overlooked, Monolithic Power Systems. Ricky Cat J. Horn. Here looking at the numbers for tonight. Wynn has had a decent couple weeks here, despite Chinese stocks being under a lot of pressure. What are we looking for in this report?
It has, and of course we expect like some major recoveries in Macau, but we already heard from some of these names where it didn't seem like it was enough to hold. Where like I can acknowledge the fact that like year over year comps right now as far as Macau revenue is expected to seriously come back, especially as far as actually its adjusted earnings expected to come in actually over $1 a share versus the well over $1 a share loss they reported just a year ago. So we're seeing all in all improvement, but the stock has also been
I'm watching it here.
We were declining pretty
49.75s.
Now we're rallying, so we're setting a very different stage into
To get a lower high.
This company is interesting because over 50% of its revenue comes from casinos. So for that reason, casino strength is expected to really aid their top line this quarter. We've seen various food and beverage sales as well as casino offerings be really, really strong throughout the quarter for Wynn. However, this name is also grappling from the fact they've had really seriously increased operating expenses, which could also weigh on their bottom line here. But the emphasis on some of their development projects, including like entertainment amenities and strategic marketing campaigns, are seen as a really strong way to gain this customer acquisition, because they're just fighting for right now what is pretty tight share in Las Vegas. And there was overall just some labor issues in Vegas over the quarter, but then
3:30.
I think the recovery story in Macau is more important, and of course how casinos are faring and sports betting. This company has sizable betting to the online world of sports betting. So I can imagine they have a pretty busy weekend this weekend.
Absolutely, everybody, especially after there was some drama on DraftKings business plans. All right, so
there we go.
Still
Baba.
got a big China connection, obviously, so it does kind of depend there. But it's looking better than the China stock. So I think we can omit, the portion of the revenue still.
Oh, my.
Stateside here, Rick, because this looks distinctly better than most Chinese charts, which are bouncing and then coming back down.
Get back to the 200.
We can see here that we had a nice turnaround in this name after a bit of a decline. We can see that we had some sideways movement for a while, centered around our volume profile point of control. This is the area of heaviest trading, around 108.40 or so. But we gave up that area, trended downward for quite a while here, put in some yearly lows shortly after our last earnings, but now we're up about 23% from that point. We had a nice breakout too. We can see that this green line here, 97.50, was a point where we topped out several times, broke out with some energy yesterday. That's what you want to look for, is these repeated stopping areas that you can draw a horizontal line across, and then you look for a break beyond that point. So we got our breakout. Today's a little bit of a question mark, though. We had a bit of a dip after the open here. We've recovered, but we're still forming a red candle on the day, but we're also still above our previous close. So now we got to consider RSI here, trending upward, making some new relative highs with price. Things are looking good in terms of that. We'd want to see a push into that overbought area. That would be a sign of strength here. We can also see, looking at our moving averages here, the situation is improving. We're above all three of our exponential moving averages that we follow. Yellow 21-day, orange 63-day, purple 252-day. They're all trending upward. Our purple 252-day was sideways for quite a while. It's starting to just modestly trend upward here on the back of some of this growth. So now we can see some places to look for support and resistance. Let's do support first. The old highs, 97.50 that I highlighted earlier, this green line, that would be an area where you would look for a potential retest. You would look for a retest, then a bounce, if you were bullish at least, or you'd look for the support to waver and collapse. If that does happen, 21-day EMA, right in line with our trend line near 95.70. Then we've got our two other moving averages shortly below, and a volume node here that suggests this is a supportive area here. To the upside, let me
I need it to drop a little bit more,
because we've got potentially cup and handle pattern. We've got this long kind of basing shape here. We would look for a retest of this resistance area, 102.79, this old high that we had, a brief pullback, and then for things to take off again. So that's kind of the thinking behind the cup and handle type pattern.
It looks like Wynn's the most bullish it's been in a while, frankly. I mean, the chart looks about as encouraging as it has at any point in the past year, because at best it was kind of sideways, a few bounces, but this is the first time we've had real meaningful trend and potential breakout with yesterday's rally.
The trend is shifting to the upside.
The trend is your friend.
That we look at, especially our moving averages. We've crossed above all of them. They're all trending upward. That's one way you can use to assess trend direction.
Exactly. Moving
averages. I got 70 cents.
Support. RSI pretty well bid, and then
on Baba.
I think people want to try and dabble in some of the China stuff. This is kind of a way to get access.
We're at 64.65.
Without being totally committed and levered to China alone. So I think that's kind of interesting too, as a trading perspective.
We've got lower lows here on SPX.
This chart doesn't really, we'll see what the chart master says, but it's been a rough couple of years.
It has, but it's also the same for Block, and it shocks me, frankly, because of how useful these companies are in our everyday lives. But I guess it doesn't really matter when your chart looks disappointing, which it has for the better part of the last year and a half at this point. But we are expecting to see some degree of recovery in net income at around 1.3 billion expected from this quarter. That would mark growth from 920 million posted a year ago. Revenue also expected
Get
to
out of
climb
here with
ever so
$100
slightly at about 7.9 billion expected, up from 7.4 billion last year. But they did just announced plans in January to trim about 9% of their workforce as part of their overall restructuring plan, which their CEO Alex Chris said is being done to right-size the business and gain speed to deliver for customers to have right now the most options available, while also the company then prioritizing
There's the
its
first
growth. So
support.
they're trying to focus on the customer basically, while also not
And the
becoming too
second.
lean, obviously. They did announce this reduction on top of what was the 7% layoff last year. It feels like they're just the latest company that has now this sort of theme going in January, but nonetheless, PayPal is looking to keep some of its recent momentum going.
What happened, honey?
So, even their good news isn't necessarily read at their overall company perspective. Growth prospects in this name have been just fairly disappointing, but I will say, as far as merchant reach, PayPal has major customers,
Squeeze,
like
Bubba.
Amazon, for example.
To the
And
upside.
Venmo is hugely popular among for peer-to-peer payments. So it's their system is so massive, even when you compare it to Block. I'm just surprised that it's just
Better
not
get out of
like
this thing.
reach for. I mean, fintech is
That was
so
a big gap up
disappointing.
right there.
The CEO too kind of shot themselves in the foot a little bit with the whole shocking announcement. Things are gonna have some big shock the world moment. It was like, all right, this isn't that shocking. Okay, so where are we at here, Rick?
Surprisingly, it's actually kind of a similar read to our last chart of Win, but it's actually not performing quite as well here. Similar thing. We had sideways movement here, a little bit different because we had a downside breakout after earnings, but we went right back to where we were before. You can see, once again, similarly, we had a volume node develop in this area, then a long slide downward that took us into the yearly lows, then a resurgence that's taken us above two of our moving averages. And this is what I mean when I say it's not quite as strong here, because purple 252, we're still a good bit below it. It's still trending downward here. But like I said, kind of a general similar read here. We've got an upward channel to consider. We had an upside test and a downside test, but kind of went back within this range here. We crossed above our volume profile point of control and our two moving averages after struggling around that 21-day EMA for a little bit here. But check out RSI. We can see kind of a triangular pattern recently, maybe a test to the upside today though. We're kind of invalidating the shorter term trend line here after bouncing around that 50 midline. It's seeming like perhaps things are solidifying a little bit in favor of the bulls here. If that does happen, look for a breakout beyond this red line here.
Think about getting
our
out of this.
Gap highs that we had after earnings from July. So that would be a
450.
key point to break out above.
Unless I get a
That's
good
also
knife.
pretty close to the upper edge of our channel. I just made a
Well, it
trend
could
line,
happen.
copied it, and put it across the highs to give us a potential resistance point. Then we've got our 252-day EMA just above that as well. So between 66.50 to 68 would be kind of a resistance zone to consider.
Okay.
To the downside, moving averages, volume profile, point of control, trend line between 60 to 62.
What I like about this chart is that it's very PayPal specific. It's not really like much else in terms of being beaten down, bouncing back. Kind of looks like that Win chart in a way. But the big moves here have all been earnings related. The big gap down was earnings from May. The other one that you point out that now is kind of providing that upside resistance level, also earnings. Then the bottom, earnings again. I mean, this thing is like, if you can figure out what's going to happen on the earnings, how the market's going to receive that, you're going to get basically the next 3 months of trend, or at least big moves, because it really does kind of set the tone for the stock. I guess it kind of speaks also the uncertainty around kind of the business model right now when you do have such earnings-driven volatility. Last one for tonight, Monolithic Power, which is a pretty fun chip-connected trade, semiconductor stock. Some have argued is going to be a big player in the AI world, but it's also a big auto-connected stock.
It is, and so this is a fun one. I appreciate the narrative that is all things semiconductors that aren't AMD or NVIDIA, because we talk about those enough. So this is actually really interesting, because Monolithic Power Systems does have this vast exposure to, I mean, all things like GPUs, CPUs, will also AI GPUs expected to be a huge win for them, obviously for the foreseeable future. They did just launch a wide range of power solutions just during this quarter, including power modules, automotive sensors, EV kits and EV boards, and motor drivers and motor controllers, inductors, and beyond. So again, with this name, what is their strength is also their weakness, though, because for that reason, a slowdown in sales for these advanced driver systems expected to be a headwind for this upcoming report. And digital cockpit products are also likely to have dented their overall revenues. They're also facing some client delay orders right now, and said that the lack of geographical diversity has been something that's been an issue for like their supply chain, which is kind of interesting. So overall, top and bottom line, both expected to fall pretty substantially year over year.
Should have got out of
For
there.
this upcoming quarter, I was breaking down like the way that they obviously generate revenue. We're expecting to see some pretty substantial decreases in overall sales from their automotive verticals, as well as overall revenue from their storage and computing verticals, both expected to drop pretty substantially. So that is has been an area of strength, but then right now in terms of the trends changing, they're just trying to figure out how to like stop the bleeding of the automotive space continuing to weigh on every company with exposure. I mean, On, for example, but actually On had a really nice report, so maybe lowered expectations, any sort of beat is a huge win.
Yeah, the market has given the semiconductors a much longer leash than the auto companies they're connected to.
No kidding.
But still, it's going to mean a lot of negative prints on this report. So they better have a big guidance. They better have a big commentary about their GPU and their AI connections. Rick, chart breaking out. I mean, it's a good day for chips here, up 1.5%.
Well, that's a question mark once again here. You know, a monolith means a large structure, or not a structure, an object carved out of a single piece of very large stone.
Yeah.
And it makes me kind of wonder if we're seeing some cracks in this stone here, because we've tested this resistance level multiple times. We just haven't been able to get above it yet here.
2320 hit my resistance on PLTR.
Until we had this last earnings event that kind of cemented things to the upside more. Now we've got kind of this ascending triangle type shape, kind of a wide-ranging shape here, but the concept is the same. Uptrending support, horizontal resistance at the highs, and the candles are interesting on this one too, because you can see right here, you know, a couple of weeks ago, we had a bearish engulfing candle. We had a small green candle. The next day we had a large red candle where the open from the close completely encompassed the previous day's open to close. So bearish engulfing. Then we had that crucial follow through the next day to the downside, retreated to support near the 597 level. Then we made our way back up, recaptured our moving average. Now we're seeing a similar situation develop here. We've got another bearish engulfing candle that formed yesterday. I kind of covered it up there on accident. Let me redraw that. And now we're kind of within that previous day's big red candle. We got to wait and see. We need that bearish follow through to the downside. But with markets making all-time highs today, you know, we could be in for a push to the upside. RSI, triangular, look for a breakout to the upside to invalidate that. Look for a push above those previous highs.
Sounds like the immediate term last couple days for Monolithic Power has been somewhat negative for the chart, as it's been chopping around up here, kind of unable to really punch through past 650. So it could be a report that needs some support, that needs some good data, some good guidance for the stock. Nice, I like the charts. Good stuff. Rick Ducat, Jenny Horn. When we come back, market meetup time, we'll talk about a rally underway. The NASDAQ is cranking, big tech is working, chips are up 1.5%. We'll also take a look at the developing stories and earnings, including a pop in Emerson Electric.
I remember when I first started flying and we would experience turbulence, I would watch the flight attendants. If they're not nervous, then I'm not going to be nervous. Financially, I'm the flight attendant in that situation. The relief that comes over people once they know they've got a guide to help them through, I definitely feel privileged to be in that position.
Trading the trending names every day. It's Fast Market. Ready for you.
Netflix. Netflix about to hit resistance 566.23. I'm back to even on my SPX. I was up $100 contract, but it didn't sell.
Just a buck away from the highs of 106. So pretty big winner, kind of a surprise winner too.
Yeah.
Yeah. All right. Good eyes. Thanks, Renita. Good look at the stock. Shares ripping 11%. Market's ripping too. We got a big rally here happening as the S&P gets to 5,000. Flirting with it right now. Nasdaq up 1% plus. More of the big tech trade. George Tillis and Scott Durfee with me here this morning for a little market meetup chat. Big 5,000, Scott. You think that's going to bring people in? They're going to hear it on the news and say, oh, how do we get to 5,000? I got to buy some stocks now.
Yeah, 5,000 is definitely going to be an attention getter throughout the market and the markets in general. There's just no question. That's a number that, as investors and traders, and I'm going to say it, we've been watching for a little over a year now, I think. And so, as things are starting to line up, we're getting good earnings come through now, mostly driven by margin rather than sales, but we're still getting good earnings come through for a lot of big companies right now. The Fed's kind of quiet, but we know what to expect. And so, yeah, I think that this 5,000 is a monumental, obviously, an important mark and one that traders and investors are definitely going to be paying attention to.
Yeah.
George Big Tech powering up. Meta's up another 3%. You got winners in Netflix, Nvidia, Microsoft this morning. I mean, it just seems like it's pretty clear this is the path of least resistance, until we're acted on by some outside force. And really the only threat has been big inflationary numbers, but, those haven't been around lately. The other is the market's concern around the regional banks, but all the evidence seems to be that is stock specific. So what's stopping us here?
Well, that's the thing. I mean, from an endogenous standpoint, as long as profits are still in maintenance mode, in other words, they're still being maintained and earnings growth continues, that's very positive. I think the 5,000 level is really a psychological level, to say the least. A couple things. I think the regional bank issue is a manifestation
Knife,
of a
baby.
challenging commercial real estate environment that's been building up.
That's a big candle right there.
Since the post-recession,
Could have been my
if you
exit.
will, back in 2008, the Great Recession build out. So I think there's a lot of excesses there. I think the Fed is very aware of that. And in fact, I think they're okay with it, to tell you the truth, because if you look at the banking system, there's just too many banks. I think consolidation essentially is what the Fed wants to see eventually as time goes by. But again, I think that will create a negative situation for the overall equity space. And I'm also looking from an exogenous standpoint, China. I think there's some challenging things going on over there, especially with the Fed, kind of pushing off the interest rate cuts that we're all expecting, and that's creating a situation where China has to decide if they're going to perhaps devalue their currency. I think that's a risk out there we have to consider as a possibility, and their equity markets are not performing very well. So, overall, I think the equities themselves are a little bit overbought at this point in time, but they could certainly move higher from here. So, maybe some hedging or delta neutral strategies.
We're at 450 right now.
Essentially something to consider at this point in time.
Okay. VIX has been kind of creeping as stocks go up. We have seen a little bit of exorbitant kind of call buying and speculative behavior, but valuations still below where they were during COVID across the market. So even the big liftoff in tech, there's still companies, many.
Can you imagine another big fat
pretty
candle?
well depressed. So as long as the economy doesn't break, Scott, it seems like even some of the stuff that's been lagging might get a chance to participate.
I think I'm going to take profit
that's
here.
kind of the idea, right? We
could
hear
drop
the
more.
term all the time, a rising tide lifts all boats. And we would expect that to be the case. Even those that seemingly are struggling, are seemingly not able to put everything together, like they would like.
Hello,
to
Zona.
as companies, we know that, again, a rising tide will lift all boats. And I anticipate that we'll continue to see that. I think we're seeing that now. I think that we'll continue to see that. Now, notwithstanding, we will still see those that are not able to, muster up to the expectations. We will still see those struggle. But those that are just kind of on the cusp, right on the cusp of breaking through and making things happen, we'll see those start to lift up, I'm sure.
All right, yeah. Russell trying to get back in form to that point here. Now within 0.25% of positive for the day. We'll see if the big giants can drag up the little guys. Thanks, George Tillett, Scott Durfee, closing it out here on Morning Trade Live. Trading 360 with Nicole Petalides is up next. See you for earnings, a bunch of them this afternoon.
Schwab Bank Investor Checking, the checking account built for investors. Named highest in client satisfaction.
Work it, huh?
p.m. East.
Oh, there we go. Okay, this is support line right here. I'm going to take profit. Sold a little bit at 540.
Unrealized gains from reevaluations of its equity investments, according to
Uber.
the press release. Now, the company's revenue for the quarter was up about 15% year over year. Gross bookings was up about 22%, and their CEO did say 2023 marked a year of sustainable, profitable growth for Uber. Going on to say the shift to consumer spending from retail to services has been a boon for the company. They continue to see this consumer strength as it relates to services, benefiting the stock into the new year. And so they did now say for the first quarter of 2024, they expect gross bookings to be slightly ahead of what the street had been calling for on adjusted EBITDA. That also was slightly higher in terms of their goalposts they gave than what the street had been expecting. Their monthly active platform did also reach about 150 million users in its fourth quarter. That was up 15% from last year. So stellar growth, and they continue to be like the poster child for the path of profitability, and once you're there, it really paying off.
All right, thank you for that. And then we continue to follow the story of New York Community Bank and how that is evolving. You have Moody's downgrade to junk, a lot of pressure pertaining to this name, though today with a slight up arrow.
Right. I mean, after seeing about 60% of its value lost over the past couple of weeks, it looks like it's attempting to reinsure its investors about its deposits, its liquidity, and its governance following what has been a week-long volatility event for the stock. Like you said, we saw Moody's cutting its bank's credit rating to junk. We did also see the fact that Tuesday night, following the Moody's downgrade, showed total deposits were up since the end of 2023, and then its total liquidity was around $37.3 billion, which exceeded its level of uninsured deposits. In a separate announcement, though, Wednesday morning, it did say that they had appointed Alessandro Danilo to its executive chairman. He previously did serve as the CEO of Flagstar Bank, which NYCB purchased at the end of 2022, and he did say that this is something he has experience in. He did go on to say they have virtually no deposit outflows from their branches, and said they'll be laser focused on really all things their real estate concentration. Now, their number one priority is now building confidence with its deposits and its liquidity. So that's definitely something I'd say the street needs confidence restored in this name that has been brutal to watch over the past several sessions.
Yeah, I retyped it. I see it's down 10%, and that makes a lot more sense here, as you noted, how it's been walloped. I mean, just even month to date, down 41%, 6 months down 71%. But liquidity is ample, according to the company, to your point, seeing obviously those deposits holding on, so that's good news, at least there. Jenny Horn, markets correspondent, thank you for both those stories. Appreciate it. Let's get some insights to the news shaping the markets. For that, we welcome in Scott Ladner is with us, Chief Investment Officer at Horizon Investments. Thank you for being with us. Should we start with what's going on with New York Community Bank? I mean, are we worried about the trickle effect for commercial real estate in particular? This is what we saw last March.
Yeah, it is, and so like the timing, the timing is a little bit challenging, but we do think this is probably an idiosyncratic thing. I mean, the troubles of commercial real estate are pretty well known. Janet Yellen, in fact, was asked about it yesterday in her congressional testimony. I think her answer was pretty telling. I mean, she was kind of off the cuff in her response, and she said, yes, listen, we think that there's going to be some more failures. We think there's probably going to be a couple more firms that are challenged, but we don't think this is systemic. And we also don't think it's systemic at Horizon. The fact of the matter is that commercial real estate comes with a huge equity cushion. If you want to buy a $10 million building, you need to show up with $4 million in cash to start with. And so the banks, that hold these mortgages, and hold these notes, there'll probably be some that are going to be challenged, but it's probably not going to be enough to cascade and really affect the entirety of the financial system.
Would you be interested in buying regional banks? As an investor, are you interested in that group, or you stay away from that group?
We think it probably makes a little bit of sense to stay away for just a little bit longer. Unfortunately, the game theory part of this is you shoot first and ask questions later, right? And so the person that panics first wins if there is going to be a really serious problem. And so if somebody's willing to do the work on individual names and figure out that this bank is going to be solid, that bank's going to be solid, probably better. I probably wouldn't play this one through an ETF structure.
Understood. So what are you thinking about the Fed these days?
We had thought that they were going to start in March.
Really?
I think Mr. Powell disabused us of all of that, and so May or June. I'm not really sure it matters that much whether it's May or June where they start, but it's fairly clear they need to start lowering rates. They don't want to have conditions be even more, even tighter than they need to be. When we have a growth that is slowing down some, employment is still really strong. But they all know that these things act with lags, and so why would they need to keep financial conditions even increasingly tighter as things are starting to slow down? We don't think that they're going to want to do that. So they will probably start second half of the year, and that's probably going to be the time we're going to want to play some small caps, some of the broadening aspects of things.
So not concerned about inflation coming back, really?
No, certainly not over the next 6 months. Now the fly in that ointment though is going to be the revisions to CPI methodology we're going to get on Friday morning.
Yeah, Friday.
Right. So Governor Waller said that this matters to him. I'm not sure why it should matter that much, but if he says it matters, then it probably does matter. And so this is something that we're going to be watching. But at the end of the day, the path of inflation is pretty obviously down. We have goods deflation. We have AI and technological progress that's going to push prices down across the board everywhere. So we think services is coming down, and we all know the story is for housing over the next 6 months based on more real-time data. So the inflation picture for us is pretty well understood. I think it's fairly well understood with the Fed as well. We just think they want to wait a little bit longer.
Right, understood. I mean, and what about the economy and any other things that we may be leaving out that you're watching closely?
We think that one thing from a framework standpoint, just from a bigger picture standpoint, one thing that folks generally got confused about over the last year to 18 months was thinking that we're in a traditional business cycle. And so, the calls for recession have been rampant for a very long time, all of last year. Everybody thought a recession was around the corner. And that's because these leading indicators that always preceded a recession were flagging. Things like the SLUs, things like bank lending, things like inverted yield curve, like all these things that always precede a recession, we're signaling that a recession is around the corner. But the problem is those things only work if you're actually in a business cycle. With the ups and the downs. And we think what the better framework for understanding this economy over the last 18 months and probably for the next 18 months is more of like a war and then a war recovery.
We're going up here to a 1, 2, 3 again.
With massive fiscal spending, with supply chain disruptions. With
this is a downward
all the things you get in a
megaphone pattern.
As those things normalize, which they have been, that doesn't necessarily mean you have to have a recession. It's just not this sine wave thing that we're used to in a business cycle. It's more of a war and war recovery. We think that framework is going to give a lot of clarity to folks over the coming year.
So now
So I'm
for
gonna get ready
investors,
for
I'd love
puts
to hear your
again.
advice. I know you talk about the consumer resiliency. You don't seem to be particularly concerned about consumer debt and credit card balances, money supply. So you noted a few ways to position a portfolio. You looked at some T-bills, or getting them out of T-bills and cash should be a priority. So what should they be putting their money to work?
So we do like U.S. stocks better than international stocks, with the exception of Japan right now.
Okay.
Japan for us is fairly interesting. U.S., look, it's kind of boring. It's still tech. It is still the top of the market. Small caps will have their day in the sun, but it's probably not in the first quarter. Probably a second quarter story for us. But in terms of just broad equity markets, we think you just need to be invested. We think you can probably lean into the U.S., lean into Japan. You still got to stay away from China because it's still a disaster. Outside of those, we think you can be kind of lazy with it for right now, and just sort of pick the top of the market stuff, pick the Japanese stuff, and let it ride for the next couple months.
Right. All right. So you have tech on there. Okay. Scott Ladner, good to see you until the next quarter, and then we'll regroup. Good to see you. Scott Ladner of Horizon Investments. Thank you, Scott Ladner. Up next, it's the big three. 3 stocks, 3 charts, 3 trades. Ben Lichtenstein will go through the technicals. Don Kaufman will take us through the trades for silver, oil, and Costco. Next here on Trading 360.
My dad was a hard worker. He used to do side jobs installing windows, charging something like $100 a.
You know you're proud of your daddy. I would be too.
SLV. Why is this one jumping out at you today?
SLV, silver.
Well, I've said this time and again. First of all, I actually like trading silver a bit more than gold from a trading perspective, right? So I'm not one of the gold bugs that's like, hiding chunks of gold, under the bed here. But in terms of silver, I like it because it's got a bit more implied volatility. And in this particular case, I think that, right now, if you're looking at markets, there's just not a lot of asset classes to necessarily rotate into. Like right now, if the S&Ps were to sell off, where are traders going to? They're going to go into the bonds? Probably not. Are they going to the dollar? Yeah, possibly a little bit of dollar. But I think metals actually still kind of stand the test of time, if you will, to some degree. I also think that, silver possibly found a floor, specifically the ETF SLV found a floor around 20. With that, I'm actually looking at an April 19th, just a straight call buy. Now, I rarely go out and just buy a straight call, but I think it's actually a nice shot in this particular circumstance. I'm just going to go out April 19th, buy the 21 calls. They're trading for around a 65-cent debit. If you get really any upward momentum, specifically to silver, the metals, in the next few months, I think it becomes a very nice risk reward. It's a decent, affordable shot inside of the metals between now and the April expiration.
All right, so a straight call buy there. And you're seeing a little potential here. Tell us a little bit, Ben, what you think about the silver chart.
Well, I think the chart's still suggesting downside momentum, right? Weakness, trend lower across multiple time frames. And so I'd agree with Don. If we were to see a shift in terms of the market, we could see a shift in SLV, but that's yet to occur with stocks at all-time highs, basically. Let's take a look first and foremost at the 5-minute time frame. And this is a very granular look at SLV, just the last few days of price activity. But as you look at this chart, I want you to take a mental snapshot, because when we get into the bigger picture, you're going to see almost an identical depiction. High conviction on the left side of your screen, sideways consolidation. You're going to transition into a move lower into the beginning of the week Monday. We traded down below 2050, and you can see how we've really been sideways since, for the most part, overlapping and rotational. Again, I mentioned we're on a 5-minute candle chart, so just looking back at a few days worth of price activity, the real conviction came on the left side of the screen. That's that initiative phase, lower lows, lower highs, and you can see follow through to the downside. And then you get acceptance, transition back into that vertical phase, and then horizontal, kind of wash, rinse, repeat. Now, notice here this horizontal phase, as I mentioned, the overlapping rotational random phase, where there's just not a lot of conviction in terms of price activity, and you're going to see that SLV is no stranger to that. As we take a step back time-wise, we're now looking at price activity since the end of August here. This is a 4-hour candle chart. You've got a very well-defined upper and lower extreme here. So 2354 is the upper extreme from November of last year, and you've got that level again, I mentioned 1897, so just below 1900. That goes back to, again, beginning of October of last year. So we can identify a well-defined parameters here right now in terms of just establishing should we get a breakout, which hasn't happened at this point. I do want to identify that we've got a pretty well-defined pivot around 2125 here. So again, even in that sense, still holding below this right now, which is somewhat bearish. So that 5-minute candle chart a bit bearish.
You got 2125
now, bearish
pretty much.
4-hour candle chart. And then one more step back. I mentioned you're going to see that same sort of pattern playing out as the 5-minute candle, SLV on the daily candle chart now. I'm sorry, weekly actually. We're going all the way back to 2012. You can see again conviction on the left side of your screen, areas of consolidation that formed at lower and lower levels, and then taking a look at this here, you can see we're currently balancing around 20. So just above that right now, which could lend itself to some more kind of chop type trade, randomness, right? Maybe work our way towards the upper extreme here before invalidating this trend to the downside. But in my opinion, to call anything below 30 still is supportive of the working assumption that value is moving lower and lower on this longer term time frame.
Right, okay. Well, you do have till April 19th for this, Don Kaufman. You're watching that 21 level. Final thoughts there?
Yeah, my final thoughts here has a lot to do with the marketplace as a whole. I mean, look, Ben, I actually agree wholeheartedly in the technical side of it. What I'm looking at, though, however, is what do you got? You got a Microsoft, maybe an NVIDIA. You're two what I would call sketchy trading stocks away from seeing everybody start to move into other asset classes. That's exactly why I'm actually looking at this silver trade. I saw the price action in NVIDIA yesterday. again, things are getting edgy out there, to say the least. And that's what it would take, actually, to cause, again, alternative asset classes like metals to rally significantly.
All right, next up, USO. Tell me about that one, the oil ETF.
All right, oil ETF. So obviously geopolitical risks, in my opinion, have actually kept quite the floor under oil right now. The other thing that I've thought of is, look, if you really are the believer, like, you know, the economy is doing phenomenally, the Fed has not necessarily slowed it down with rate increases, then it lends itself to a little bit more of a bullish trade. You know, I'll leave some of the technicals in this particular case over to Ben, but I'm just doing a very simple, what we call in-out call spread. So it's a bullish trade. It is the March 15th expiration, so not a huge amount of duration. I'm just looking for like a short-term pop up in oil. Obviously, USO moving in, for the most part, relative tandem with oil. I'm buying the 69 calls. I'm selling 71 calls. So it's a really tight $2 wide spread. It's done for a 90-cent debit. Call it an in-out spread. It's one strike in the money, one strike out of the money. Just a very minute pop to the upside in oil, and obviously the USO sees degrees of profitability in here. And what, you know, I can only term as instability, you know, geopolitical. Meanwhile, at the same time, economic activity. If you're, you know, a believer in economic activity, I think you have to be a little bit short-term bullish.
Right, all right, so you're banking on the geopolitical ideas, or maybe some people believe in the economy is good news, and that maybe that can give it that short-term pop in oil that you're looking for. Ben, your thoughts?
Yeah, I think we're attempting to get something going, trying to establish a bit of a bottom here. Take out 69.50, and I'm right there with Don in terms of the bullishness. I'll show you why when we look at the longer-term chart, but let's just begin here. First and foremost, today, 30-minute candle chart here. So we're going back to the middle of last week, and you can see that there has been some bearishness here. It does look like we're trying to establish a bit of a bottoming pattern Friday, taking out the low on Monday, but limited in terms of follow-through and just kind of balancing out here. But let me show you why I mentioned 69.50 I think is significant. Again, it's a 30-minute candle chart, and you can see areas of consolidation that are formed at lower and lower levels. So we're talking about at 73, at 71.50, 69.50, and then at 67.50. So the bears want to see us take out these lows from earlier this week, form a new area balance at a lower level. The bulls want to see us take out 69.50 because that forms a bit of a reversal here, right? If the working assumptions that values forming in lower and lower levels, if we're trending lower, why would we be taking out key areas that were established on the way down? So get above 69.50. I'm right there with you, Don, on this one. Let me show you a similar pattern playing out in terms of SLV, right? We mentioned that kind of range-bound, kind of a low conviction trade, overlapping and rotational. I've got a 60-minute chart up here, so let's take a look at what's been going on recently. A similar pattern playing out here with shares of USO. 75 is your upper extreme. We got that from all the way back in end of last year, beginning of November. End of November, beginning of December last year. And then you got a lower extreme around that 63.60 level we're talking about beginning of December last year. And since then, look at this. We've been, for the last 2 months here now, just basically sideways, consolidating around 69. And look where we are, right at that pivot level. So again, tip the scales one way or the other here, and ultimately you could see some movement here. Now, the reason I've got that bullish stance and supportive of what Don was just talking about is because this longer-term trend is very well-defined here, and this is a chart that goes all the way back to, we're talking May of 2020. Daily candles we're looking at here, high conviction all the way up into the beginning of 2022, and then look at this, we transition in the sideways phase around 74 here right now. That's really the level we need to get back up above. So you've got some key areas, 69.50, 74, but take out those areas, open up the door for retest of some of these key highs that we've seen over the last couple of years here. So have to agree with Don on this one. And also in terms of the geopolitical situation playing out there, I'm in many ways shocked to see that oil has seen such a limited reaction to.
Right, we've had kind of a limited reaction, but all you need is some short-term pop to put you in to your range. Don, thank you for that. Ben, any final thoughts there? And Don, get to Costco.
Yeah, no, ironically, actually, on the front of oil, I 100% agree with Ben. Like, if you said, you know, geopolitical risks, if you told me that, you know, a couple of months ago we're going to play out like they have in the Middle East, and that oil actually would have reacted, I never would have believed it. But I think that there's just this constant floor put into oil, which makes the bullish trade more appeasing, at least at this point in time.
Okay, next up you have Costco. Tell me a little bit about this one.
Oh, this is one where Ben and I are about to get into it a little bit because, as you guys know, I like to take the contrarian positions. So I'm looking at Costco, and by the way, I'm an avid Costco individual, right up until the point where I'm going to short it. So this is absolutely going to be a bearish trade. Like we're going to look at price action.
$7.20 on Costco.
Costco has had an absolutely ridiculous and meteoric rise. I mean, we're trading what, $5.25 a couple of weeks ago, a straight shot to 700.
It's crazy.
Tech stock, have they opened up, something spectacular here? All right, is it a cure for something? Absolutely not. I mean, granted, the $5 chicken does it for me, but the stock price absolutely doesn't. Again, the meteoric rise and then comes to an end. I think this is a worthwhile, if you will, shot to the downside. And the trade that I'm doing is definitely a lower probability trade. But in a lower probability trade, the payouts can be quite significant. So again, as a trader, I like to take what I term these out of the money shots. This one is an April 19th expiration. I'm buying the 695 puts. I'm selling the 685 puts. So it's a $10 wide spread. I'm using a spread because the volatility skew in here is big time, and the trade is going for a $3.05 debit. That volatility skew is actually helping me in this particular case by lowering that initial debit for the spread. Nevertheless, still a lower probability shot. Costco not only has to halt, has to actually reverse quite considerably, but what are they doing there at Costco to warrant price action from $5.25 to $700? This is not NVIDIA, it's Costco.
All right, so taking a chance with this one. Ben, your thoughts on Costco here?
Well, I'd agree with Don. It's not NVIDIA, it is Costco, but it is still trending higher, right? So he is going out on a limb here, that's for sure. And oftentimes, those higher probability or lower probability trades in this instance, oftentimes, as he said, are the bigger payouts. But definitely the trend to the upside here still across the board here. So until we take out some key levels here, for me to support this bearish narrative. Taking a look at shares at COST, much like we have with the other two names, I just wanted to go back to some of the price activity we've seen over the last few days. And in this instance, pretty well-defined trend up, bottom left to top right. I've got a couple areas of consolidation where we've paused and established value, and most recently it looks like around 722 as we kick off this Wednesday. This comes after a big move out of this range that we had been in throughout the beginning of the week, around 710. You can see the conviction, and then you can also see the transition from higher highs and higher lows, a breakout high conviction initiative type phase, the upside into a more overlapping rotational horizontal pattern that forms as we just get into, again, a kind of low conviction and overlapping rotational phase. Taking a look here, another step back into the hourly candle chart, and you can see a similar pattern playing out, bottom left to top right. Let's identify some of the areas of value that form, because going back to, when we bottomed out around that 640, 650 level, you can see it looks like 5 areas currently balancing, or I should say breaking out again out of the 710 level. You can see the high conviction associated with, as we just mentioned, that initiative phase, the green candles that we're seeing, 723 right now, the key level to look. But this was the area as we were balancing around 710 that we were watching. 703 was a level, that kind of line in the sand that the bulls didn't want to see us take out, because that would have brought into question the fact that value is moving higher. Why are we starting to take out some of the key areas that were established on the way up if we're still trending higher? In this case, exactly what the bulls were looking for here, Nicole. Initiative phase out of balance. Now they want to see that area of value form at a higher level and just continue that staircase type pattern and validate that working assumption that we're seeing a trend up here. Hey, taking another step back here one more time. I've got a daily candle chart here on Costco, and I wanted to show you. I might have said that was a daily candle. That was a 60-minute we just went out of into a daily candle chart here. And look at this. I mean, really speaks to the initiative phase that we're seeing to the upside here, breaking out of this range that we had been in around 500, going all the way back to the beginning of 2020, well, middle of 2021, beginning of 2022. But man, this is a big move up here. Don's right here. This one's high conviction of the upside. It's definitely counter trend.
All right, well, we'll have to wait and see. The max profit will be $6.95. He's taking a chance with this one, in your opinion there, Ben. But thank you. Even he said it himself, Don. You said this one was a little bit more of a long shot. Thank you both very much, Don Kaufman of Theo Trade and Ben Lichtenstein, for the big three today. Coming up next, we're going to spotlight ARM Holdings ahead of the company's earnings report. The semiconductor name, and we'll look at the space overall. It's been all about AI. What do we need to know? Other names too, AMD, NVIDIA, Trading 360. We'll be right back.
I was born on the south side of Chicago. It has been a long road, but now I'm working for Schwab. I love to help people understand the world through their lens.
Got a megaphone pattern on the SPX, and then we had a double bottom on this last pullback. Been a good trade, a couple puts today on this thing in this channel. Right now we're at a pivot point in the flag. So if it doesn't hold this and break out, I think we're going to drop down more. Okay, what are we done here? Yep, I think it's getting ready to give up. This is the last chance for it to hold support. If not, then we'll go to the third notch on the megaphone, and then run it back up to the third into close. 49.78. Jimmy said it. I put my foot down.
Earnings season, and it actually gave some better than feared numbers earlier this week. So that's kind of how we're looking, at least specifically on the semiconductor side of things right now.
I see. So watching some of those names that maybe people aren't as following as closely. AI, what about that, and where does that fit in here?
Yeah, no, I mean, as far as kind of the whole AI theme is concerned, I mean, again, it is all NVIDIA. All signs are that this is going to be a very good quarter for NVIDIA.
Apple double bottom. Oh, good eye.
I believe in a week or so, but 2 weeks. But you know, I think kind of the AI story remains extremely bullish. You're still in the early innings as far as kind of, you know, the shift towards kind of you know, more accelerators out there on the GPU side of things. And also kind of the upgrade on the networking side of things, which is where more than the Marvell story kind of fits in as well. So, you know, as far as the AI story is concerned, I'm very bullish on the cloud side of things. I think some of the AI story, kind of when we start thinking about AI PCs and smartphones out there, I think those have a little bit of a longer tail. You're thinking more, you know, calendar 25 and 2026. Relative to calendar 2024 as far as those themes are concerned, where maybe a name like a Qualcomm can kind of, you know, get a little bit more steam on those plays.
So a name like Qualcomm, and that's for, you know, handheld devices and things like that when it comes to AI, but maybe a little farther out. Yeah, it's great to see you, Angelo Zeno. Thank you so much for all of that of CFRA Research. Angelo Zeno, great to see you. Coming up next is the Disruptors, and George Phillips is standing by. He's going to take a close look at Pinterest. Now, Snap's earnings have been weighing on social media stocks overall. Let's see what George has to say next. And here's a look at winners and losers in the S&P 500, which has hit new record highs intraday today.
Young lady who was mid-30s, a couple of kids, recently went through a divorce. She had a lot of questions when she came in. I watched her
not again.
A single mom.
The single mom story. I do have respect for single moms because I know how bad men can get. They're selfish and they're foolish. I made one promise to myself. If I ever had a friend that treated a woman bad, I'd stay away from him. Washboardjim's getting ready. We've got a wedge or a symmetrical flag inside of a megaphone. And we still have to hit the 1, 2, 3 on the top, so I don't know. This is in between. It's going to make a business decision. Right now I'm cooking lunch. MPWR. I'm going to keep a good watch on this one here. I've not heard of this one before. I don't think. Okay, he's back. Silver dropped once he mentioned it. It's coming down to a 1-2 freebie. I don't trade silver much. I have maybe once or twice. I used to sing silver and gold. Silver and gold. Do you like that? Flag pattern. It's on the 10-minute, huh? Uh-oh, here we go. What'd Jimmy say? Oh, that was silver. Okay. Somebody wanted to break that resistance. I'm gonna go get my coffee. What are you looking at? Spy? Silver and gold. That is a pennant flag. Well, it's almost descending. It is descending. Ding-ling-ling. Spy says it's going up. Jimmy says we do have diversion.
Shares of Alibaba sinking this morning after
Yeah,
the Chinese
why?
e-commerce giant narrowly missed top-line street expectations, even after announcing a $25 billion boost to its share buyback program. That's the focus of today's Tech Check segment with our Deirdre Bosa.
Still holding
Deirdre,
that
how are you
support.
reading these results? Well, I'm reading them in that a buyback just isn't enough because Alibaba's problems are its fundamentals, and capital returns aren't going to gloss over that. Its core e-commerce business, it is barely growing, and spin-off plans have hit a snag. At the heart of Baba's decline and Chinese stocks at large is
God.
still this idea that they are uninvestable.
You're not helping.
Take a look at this chart of Alibaba shares and the Hang Seng, that's Hong Kong stock index, since December of 2022. They have moved in tandem. Christmas time in 2020, that was the key inflection moment. The Chinese government launched an antitrust investigation into Alibaba, introducing a wild card.
man,
for the
she's not
market at
helping one
large.
bit.
Essentially told investors that Beijing could and would.
Silence. If you don't say, didn't your mother ever tell you if you can't say anything nice, don't say it at all?
The crackdown that started with Alibaba and its affiliate Ant Financial, Ant Group, would change the field entirely and allow a potentially more powerful class of Chinese giants to emerge. Pinduoduo, Huawei, BYD, these are the success stories of the last few years. And Alibaba represents the decay
If I
of
get
the old guard.
74-17, I'll
To
be
try and bring back
happy.
investor confidence, it has moved Jack Ma out of the spotlight, restructured the entire company, and tried to spin off its cloud unit. Nothing has seemed to work. And its market cap
Come on, girl.
went from a peak of more than $800
Who are
billion
you?
dollars to less than
You're killing me.
$200 billion today. That expanded buyback, guys. It's kind of like Alibaba's damage control, and that might keep investors in the stock, but it does not address those fundamentals that are declining. And similarly, Beijing's
You get an
recent
A-
measures
you
to
get a
support
B
the
plus,
stock market, that
B
may
minus.
also be short-lived because it's this broader backdrop
give you a
guys,
C.
that China may just be uninvestable.
Oh, God.
Yeah, it's been this sort of start-stop when it comes to these rallies on the results after they have good news on propping up stocks. Deirdre, thank you. Deirdre Bosa, the CEO of Edgewell Personal Care, is
Sarah.
the company behind Edge and Schick Razors, Banana Boat Sunscreen, and many more consumer products. We'll get his read on the consumer and inflation and reaction to earnings when we're back in 2.
Well, it's cold. Think about making a business decision. Hello, do. Spy's beauty. Just looking at that chart. Five, 10, 15, 4 months. Yeah. Looks like Meta's double topping. Beautiful run on Meta today. Spot's up $10. PLTR broke my 2320. Pretty good run. Remember I said what? Was it last week when I listened to him at that one thing they went to? So I like this guy now. It's been 2 or 3 weeks ago.
Fiscal Q1. Joining us now for a closer look at the quarter and the consumer.
EPC.
As well, CEO Rod Little. Rod, it's good to have you back. We didn't get such clean results from all the household products companies this quarter. What are you seeing from the consumer right now?
Yeah, good morning, Sarah. Well, it's a resilient consumer. I think we've been saying that, and we're seeing that in our results. Our categories are healthy domestically here in the United States. Largely, they're healthy outside the United States as well. And so with a resilient consumer, if you put good products, good innovation, good messaging in front of them at the right price, they'll respond. And so we had a good quarter with organic sales up 3%, in line with our expectations. Where we really had the beat was on the gross margin line, and then bottom line profitability, EBITDA, EPS, and cash flow, all well ahead of street expectations. So it's our first fiscal quarter. We feel good about it. Sets us up well for the year.
So let's talk about gross margin, which was obviously a bit higher. How much inventories played into that, and how much pricing is also playing in?
Yeah, our pricing is a big driver for us. Still, we have some net list pricing still going in, largely outside the United States, where we're still putting some pricing in markets like Asia, Mexico, Latin America generally. We've had really good revenue management outcomes, so managing mix, promotional intensity, anything that's a discount between gross and net sales. The teams have done a really nice job on being very, very efficient there. So our 3 points of organic sales growth was flat volume, 3 points on price and revenue. And then the other thing I'm really proud of, and I know our team is very, very good at, is being very productive around our cost management, around our cost of goods. We had almost 400 basis points of cost productivity in the quarter, which won't continue at that rate, but that obviously helped drive the beat on margin.
Yeah, Rod, that was, I thought, one of the most interesting parts, especially your comments about continued efficiency improvement in the supply chain. And I'm wondering if you could talk about what's left to do, because there's been talk of supply chain healing for so long.
Yeah, Carl, there is. One of the things we see is everything's just in better balance, and it's more predictable. Lead times are more normal. And with that, you end up just getting efficiency, and then as you get into contract rate negotiations, you have better outcomes in those negotiations. So we're seeing that. Another example is less air freight. Things going by boat more traditionally like they have. The Red Sea aside, that's not super material for us. But we're having that happen, and then we're focused on design to value and looking at what we put into a product that the consumer really cares about, and if there's something in there they don't care about, well, let's take it out. So using less materials as we make our product is one thing we're focused on. And then the other thing that's helped is been diesel rates and line haul rates have come down and been better than expected, and that obviously helps contribute to the lower cost environment as well.
I mean, the one weak spot in the organic growth is in the feminine care market. So I wonder what you're telling investors and what kind of visibility you have there toward turning around. It was a lot weaker than analysts were even expecting.
Yeah, it was, Sarah, and that's a good point. It's actually one of the areas of our business I'm most bullish about in terms of where we are on our journey to have a consistent growing business that can win in market versus competition. If you look at that business on a 2-year stack basis in the quarter, we were up slightly. There was a big quarter in the prior year period, largely around one-time events. and resupply now happening. That business has been really choppy, as you know, from the beginning of the pandemic. Those were the shelves that were most empty at the beginning of the pandemic, and we're just now getting back into balance. And so part of that is what we were lapping and comping against. Part of it is we're getting ready to set the shelves with a new innovation that's going to take a Carefree master brand into a space that now covers pads and liners. It's primarily a pad business today. And so the part of that was us just resetting. Correct.
All right, Rod, we're out of time. We got to leave it there, but thank you for taking the questions. Talking the quarter, Rod Little of Edgewell.
We'll remain on S&P 5K watch, still about 10 points away. Tomorrow's going to be interesting, too, with Pins and Under Armour and Affirm, and we'll work our way through Disney tonight as well.
Yeah, a lot of moving catalysts on earnings and a revision on CPI on Friday.
Let's get to the judge.
Carl, thanks so much. Welcome to the Halftime Report. I'm Scott Wapner. Front and center this hour, the rallies road ahead, and why one member of our investment committee today argues concerns over the market being too top-heavy are just overstated. We'll discuss and debate as our panel makes several new portfolio moves today. Joining me for the hour, Joe Terranova, Carrie Firestone, Brian Belsky, and Steve Weiss. We will check the markets here. We got within about 5 points or so of S&P 5000. So naturally, we're on S&P 5000 watch now for the remainder of this day. We're 10 points away now. We're positive across the board. New York Community Bank, that continues to fall, so we're watching that. And of course, the debate over whether this whole thing is too top-heavy, that rolls on. To which, Brian Belsky, good to have you back. You're the one who argues that this all may be overstated, that we're overestimating the risks, so to speak, involving this concentration in the market. How so?
I think we are. Thanks so much for having us. And we published this note yesterday just because the consternation is so much top of mind for everyone, Scott. It doesn't matter if it's the media or clients or high net worth. Obviously, the big movement stocks we think in January this year is much different than it was last year, for one note. But I think what we have found going back to 1990, that the average performance of the S&P 500 following a concentration of
That's one heck of a run for PLTR.
Before the average performance the year following positive 14.3%. And I think it bodes well with...
Wait, hold on a second. What kind of history are you looking at? I mean, we've only... It's not like this has always been the case, where these are a select group of stocks.
If you look at the top 10...
That are just coming off of a huge year.
If you look at the
10
top,
years ago?
If you look at...
1999?
Since 1990. People love historical facts. I'm just giving you analysis, not reacting to what happened.
I know, but I'm dumping on the historical facts.
Please
I
dump
don't think
on it.
They're legit.
You don't think it's...
1999 that was followed by a very down year.
Yeah, so if you, okay, so again, I'm not going to be a reactive person on television reacting to what happened yesterday or last year or last week. My analysis is based on long-term historical facts. If you go back to 1990 and you look at the 10 largest companies in the S&P 500 by market cap historically, when they outperform, the next year the S&P 500 is up an average of 14%. We're just adding empirical evidence, Scott. Now, like I said in the beginning, I believe the move in January this year is very different than the move last year in January. And oh, by the way, the Magnificent Seven, which we warned people in the fourth quarter last year, are starting to see different fundamental trends. So we're starting to see some deviation there.
But I mean, if you look, Carrie, NASDAQ year-to-date's up 4.5%. Equal weight S&P is up 0.5%. That's a pretty good indicator of just, where this rally's been. The broadening since November 1st was legit until it wasn't. And then we're here wondering again what's going to cause the market to broaden out. And frankly, if it even matters. I'm not even suggesting that it matters. It's not for me to say. For now, it doesn't seem to matter. Obviously, if the S&P is nearing 5,000 and you're in the right stocks, then what does it matter?
Well, what matters is the earnings growth of the companies that are producing the type of returns that we need to keep going higher. And what we've seen so far this year is of the 5 stocks, the Magnificent 5 that have reported. So Apple had a quarter, kind of as expected. Microsoft a little stronger. Amazon great quarter. Meta great quarter. Google disappointing quarter. And you saw that reflected in the stocks. Meta is the one that had the enormous drive, up 24% year to date, I think it is.
Meta's up 32% year to date, okay?
Yeah.
32% year to date, 5 weeks.
But people had the estimates wrong. they earned more than the market had expected, and now the multiple is about the same. It's a little bit higher than the S&P. If you look at Google, their multiple is slightly premium to the S&P. Amazon, that multiple has been coming down for years because, I mean, it was very, very high. It's still a high multiple, but they over-earned relative to expectations. And if you can keep doing that for these companies that have a growth rate 2.5 to 3 times that of the S&P, not including themselves,
Okay, you said
deserve.
the keywords. You said the keywords. If you can keep doing that, what leads us to believe that these companies can keep doing that at the rate they're doing it now to justify the growth in their multiple as well as their stock prices?
I guess we're relying on history, which unfortunately it sounds like you don't want to rely on, but the history has been a very strong one of seeing
that's a low
accelerated
blow.
revenue growth, and now you introduce a new dynamic in particular for Meta.
History
where,
repeats
now they're gonna
itself.
buy back their stock. We're sitting at
Pay a dividend.
We're sitting at the early stages of the buyback window opening as we press the S&P towards 5,000, and I just wonder how aggressive companies actually are going to be right now and how aggressive a lot of these mega cap companies are going to be. So listen, I think it's a rightful concern to look at mega caps and say to yourself, is the over concentration signaling something as we move through 2024 that could be problematic? It's clearly not unique. Our good friend Tony Pasquarello, in his note this week, cited that if you go back and look at the Euro Stocks 50 from 2009, there's 5 stocks that have actually accounted for over 50% of the performance: ASML, SAP, LVMH, Total, and Siemens. So it's happened in other instances. It's happening here. I understand the concern. The concern is a rightful one. And remember, I run an equal weighted strategy.
Let me be clear. I'm not dumping all over the historical references that you make. I'm simply suggesting, and maybe I'm wrong, we've never had this level of concentration in these kinds of stocks, all in the same space. You could say the 10 biggest stocks in 1992, well, they were all up and they were very concentrated. They weren't all in the same area of AI-related technology, were they? That's what makes this a little bit different. It's like this one area the market has deemed to be, you know, so incredibly transformational, and I get it, it is. But to the point where valuations just go to the moon, doesn't matter. All in one area.
You're a sports guy, so think about the market as a baseball game. Baseball, they can mess with it as much as they can with respect to the rules, but it's always 9 innings, 3 strikes, you're out, 4 balls, and you walk to first base. But the players change, right? So in the 90s, we're going to go back there. You had the consumer staples names that were the big names put in the mega cap names that were pulling it higher. What we're saying is this. You're right, in terms of the concentration now, technically we have 3 different sectors in the Magnificent Seven.
Yeah, but that's only because comp services is a new sector.
But also
Well, you know exactly what I'm talking about.
Exactly, but what I'm saying too is that if you're a money manager and you're benchmarking yourself against sectors, you have to play that game differently. What I'm saying is this. I don't think that you can just look at 5 weeks or 4 weeks. You have to look at since the market hit that low in October. If you look at the most recent low of the markets in October till now, you have actually very broad participation. You have value up over 17%. You have SMID up over 17%. You've got growth up 21%. They're all within about 350 basis points of each other.
Yes.
So that's more broad than most people think.
It's fair to say from November 1st, Weiss, it's fair to say from November 1st to now, the market is, I mean, it was broad because if you look at gains, for example, in the Russell 2000 versus NASDAQ, it's, I don't know, high double-digit percent, 17, 20%, whatever, versus a little bit more than that in the NASDAQ. But more recently, it's gotten more narrow again. I think that's the point.
Yeah, look, I mean, there's reason to be concerned, to have concerns about it being so concentrated, if that's how you think about it. But to Brian's point, I see broadening. I see stocks I own that have had maybe not the performance of Meta, but have had pretty good performance. Whether it's VRT or pick others, pick Goldman's had a nice run of it lately. But here's what I'd say about it. I'd say that the opportunity set has changed versus even a year ago or 2 years ago. So does Microsoft enjoy and should deserve the inflated multiple that it has? Absolutely, because you've opened up a whole new opportunity set, both in AI in their Office products, but also in the cloud, which is going to need much more cloud storage, much more computing power, etc. So it deserves it. So I focus on the fundamentals, and I say, do the fundamentals support the valuations, and where else do the fundamentals are they not supporting it? I stay away from those, so I go to these that support it. But I also find it in aerospace. I don't find defense broadly. I find it in some financials if I look at the second half. So it's not such a narrow advance, but they're names that we all know. And to Brian's point also, if you're in the benchmark, and most active managers are in a benchmark, you can't ignore those. So to me, that's the fluff if they're not fully committed to the fundamentals of the company, and that's where the caution is. But if I look out a year, 2 years, 5 years, it's going to be the same companies, with the exception of an Apple that's tired, products, are falling off, etc. So
I think part of the point. I think part of the point too, though, is the outperformance from the mega caps, comm services, and tech. You can cherry pick areas from the rest of the market and say, well, look, that stock's up a lot. That's broadening out. I'm not saying that everything has been negative, but the gains are dwarfed by comm services over the last month, which is up 12%.
Without doubt.
Information technology is up 12.5%. Utilities are negative, energy's negative, materials are negative. Healthcare staples, they're up 3% respectively, 3.9 and 3.305 respectively. That's more of what I'm getting at. The question is, what is going to cause the market to really broaden out in a meaningful way? Wolf today, Carrie, says, given the valuation discounts today, many investors are looking for an opportunity to invest in the most cyclical early cycle assets. While such assets may have tactical opportunities to shine, the economy is unlikely to return to early cycle without a proper recession. So they're saying those other stocks are not going to be reliably working until you have a real recession. Others say they're not going to work until you have the first real rate cut, not in anticipation of, but the actual cut.
Well, I think that the broader market works when it recognizes that GDP is, in fact, growing faster than expected, and that we begin to see through this year better earnings from different sectors, such as industrials and healthcare and even banking. And you're beginning to see signs of that. I mean, as we talked about, some of the stocks in healthcare working, in consumer staples working, and GDP is growing better than expected. Interest rates are not going up, and inflation continues to come down. So there's no reason that we shouldn't have more than just, these magnificent names go higher. And they should go higher if all of them, if their earnings continue to grow, and there's no reason that their multiples of much of the market won't expand.
Sure, but let's take NVIDIA, okay? Let's take NVIDIA for example, because that seems to be at the center of the whole storm of this, where this conversation has been going. You had an $800 price target, I think, from Goldman Sachs the other day. Now you get Morgan Stanley raising the price target to $750. You had Josh Brown yesterday on the program saying he's been in NVIDIA longer than anybody on the show. Say that he trimmed 20% because he looked at it and this is like people have lost their minds. Those were his words, not mine. Aswath Damodaran, he is the so-called Dean of Valuation, okay, at the NYU Stern School of Business. He owns NVIDIA along with all of the other Mag 7 stocks, okay? He looks at this and says, I mean, this is kind of insane relative to the other Mag 7s. I want you to listen to what he told us and then we'll debate it.
No, you bought these stocks at the right time. They were amazing buys at some point in time. At today's prices, I mean, all of the stocks looked overpriced. But I think NVIDIA stands out as particularly overpriced. I mean, just to get a collective sense of what these 7 companies account for in the S&P 500, these 7 stocks alone account for 70% of the overall market cap of the index. They account for 11% of the revenues, but they do account for 27% of the gross profit. So they're very profitable, very valuable companies. And you can get pretty close to the current prices for the other companies. NVIDIA, I can't even get close.
Can't even get close, says the Dean of Valuation, who owns the stock and looks at the price appreciation and is like, this is insane.
Okay, so here's the challenge that we have. The challenge that we have is understanding that the intuitive observation of individuals surrounding something that appears to be extreme, that appears to have the exuberance. Josh Shaves
Exuberance.
the professor believes that the
Irrational
megacaps might have an
exuberance.
extreme valuation. There's a move that I made later in the show where you could cite the same type of condition. The problem collectively with all of that is that this dominance of angry algos, as you called them last week, in quantitative capital doesn't care about that stuff. And momentum so far in this quarter is having its strongest performance that it has had since the fourth quarter of 2020. Momentum is up 11% so far year to date. Momentum is dominating the market. And now you could look at that and you could say, okay, we don't care what technicals say, we don't care what momentum says, but momentum is in control of the market right now. And the reason that it is in control of the market is these mega caps have given the momentum players strong fundamentals to work.
It only matters. It only matters too, Brian. I guess to round back to the top, if you're in the wrong stocks, then it matters. And it matters if these stocks falter and there's no pickup from the laggards. That's why there is commentary, whether it's Barron's or elsewhere, suggesting the foundation of the market starting to crack because some of the Mag 7 stocks are getting peeled away. That's why we talk about Mag 5 in some respects.
Right. So if you kind of go back and look at your process in terms of investing, you buy stocks because of
After
fundamentals.
revenue
I think
miss.
actually you sell stocks because of fundamentals as well. And so Joe's completely right. All of our factor work in terms of the quant stuff that we run, it's momentum. And that always has me a little bit worried on a short-term basis that we could be seeing a peak. That's why we're not going to be surprised if we get some sort of a correction here. We also talk about that in our report.
But you own NVIDIA, right? You own NVIDIA.
Yeah. And
when you look at that and you look at what is a straight up line, right? Yep. I don't know what time period we can pull up longer than intraday on NVIDIA, for example. I don't know, what is it? You want to put 6 months? You want to put a year?
No.
What do you want to put up? There you go.
Year
I
and a
mean,
half.
that shows the story.
Yeah, I mean, that kind of trend obviously makes me very worried, but at the end of the day, I've owned this stock for 5 years. And when I learned the business a long time ago from one of my great mentors, William O'Neill, and you ride your winners. That doesn't mean that you sell here. I would sell the stock entirely if I saw something fundamentally
ride your
changing
winners.
operationally or management-wise, and I just don't see that. Now, it's going to be one of my core holdings, just as 4 of the other 5 Mag 7s are.
You bought, the new buys you have are away from tech, Chesapeake, DoorDash, Gilead. Chesapeake's new. You bought more of DoorDash and Gilead, and you did trim United Health. You want to just, you don't have to go through each and every move, but what's the spirit of these moves?
Well, Karen talked a little bit about healthcare. Now, healthcare is one of our neutral sectors. It's a big sector, so you want to make sure that you're broadly, I think, diversified within that. We were a little bit overweight United Healthcare, and we wanted to add to Gilead, and just because of the balance sheet and the dividend side of things. DoorDash has been a great winner for us. And we took some out of another consumer discretionary stock in our SMID cap universe. Chesapeake, we love our small mid cap analyst, and he gave us a great name, Oventive, and we rode that for a year and took profits in that and went into Chesapeake. It's just a matter of kind of diversifying and getting. Now, from a longer term perspective, right now we're underweight large cap energy, but we're more neutral mid cap energy.
You want to comment too? Let's do Snap as well, because we have several big movers today to go through. Snap is sinking, and sinking badly today, almost 35%. That's on a revenue miss, light guidance. Evan Spiegel was on in the last hour. Worst day since July of 22. You bought this on February 1st.
Yeah.
You still own it today?
We do. So we're hampered a little bit by our process because of our low turnover portfolios. Because we're publishing analysts, we have to publish the report and then buy the stock. We rarely buy things mid-month, Scott, so we were teeing this up, and we probably should have waited until after the earnings, but again, do our process.
Probably.
Yeah, I mean, with much humility, we're wrong. But at the end of the
that's
day,
low.
We like this name longer term because we believe in the communication services sector in terms of cash content and consolidation. We think it's got great content, and we think it's going to be a winner relative to the mega cap.
How do you own it? Equal weight or market cap weight?
No, we're underweight the market cap of that because it's in the SMID index. We're underweight the stock, but we own it.
You guys see cyber stocks today. Fortinet really the catalyst on the earnings there. You know, Stephanie Link, good for you on that because she owns that stock. She's talked about it a lot, but the run-on effect in some of these other names is pretty extraordinary today. CrowdStrike, Palo Alto, Checkpoint. There's Fortinet today. It's off its highs of the day, but you get my point. If you show CrowdStrike and Palo Alto, that leads me to Joe. He teased it earlier. You sold 1/3 of CrowdStrike.
I did.
Because this stock is up 120% since you bought it last August.
Correct.
August of 23.
Again, this is an intuitive observation from an individual, which is probably going to be wrong.
Don't say that.
Listen, I believe in cybersecurity. I believe in cybersecurity. We have Checkpoint. We have Palo Alto Network in the strategy. We had Fortinet. We sold out of Fortinet. Congratulations to Stephanie. Up 9%. Q4 billings was really strong. But I am significantly overweight cybersecurity. And I think longer term, that's exactly how you want to be. So the strategy was buying Checkpoint. It was buying Palo Alto in October. Those were great buys. I was able to personally buy CrowdStrike in August. And I'm just looking at the performance right now and say, okay, let's trim the position a little bit. Let's see if I'm right. Who knows? I hope I'm wrong because I still have 2/3 remaining of the CrowdStrike position.
The message of the committee of late, Kerry, is whether it's Josh with NVIDIA, 20% off top, Joe with taking some off the top of CrowdStrike, of Stephanie Link selling out of Meta completely, missing the 20+%, but saying, you know what, I made a lot, I don't even care. That's the message of the committee lately, is actually doing some trimming off the top of these massive winners.
Well, we haven't trimmed any of our big winners, these big tech names. We've added to technology. We have not.
Meta included.
We have not. And because of the move in these stocks, weights that were high have gotten higher, and it's something that we have to consider. I think it's fine to always sell some of a stock where you've made money. Right? No one should have a problem with a profit. And everyone who complains about paying taxes, they're paying taxes on profit. They still have profit. It's what you do with the money. If people just sit on the sidelines, that's different. If they are putting it into other names, that helps the rest of the market. That's part of the bullish case for the S&P overall. But just let's not forget that when we talk about this being different from other times in history, it is because the size of these stocks, their sales is so much greater, their profits so much greater. Do you realize that Apple earns the same amount of money as the entire pharmaceutical industry with less sales? It has $385 billion versus $585, same profits for the whole industry.
Okay.
It's got to be Stephanie Link's mom.
Because like clockwork, Marko Kolanovic at JP Morgan has dropped a new note as we are on the air. And it's perfect segue from what Kerry's talking about, that suggesting that, well, unlike other times in history, this isn't ridiculous. He suggests otherwise. Quote, market concentration continues to flash a warning sign as we are near the highs of the dot-com era. Stocks at highs effectively means that stocks are not pricing in any chance of recession, and a low VIX echoes the strong sentiment. The current period is in some ways worse than the dot-com bubble. That's what he says.
Yes,
Steve Weiss, you want to attack that?
I think, yeah, I do. I think it's ridiculous. The dot-com era, which I recall very, very well because I probably allocated a few hundred deals during that time. Those companies didn't make money. They didn't have market share. They were purely up on air. So you can't compare the two. That's a ridiculous comparison in my view.
Well, he says,
by the way, if a recession happens,
let me tell you what he says, because he's specific in what he's suggesting. He says, even as we didn't achieve as high a forward PE as we saw in March of 2000, when viewed from the perspective of an earnings yield spread of the top 10 versus the rest of the index, the current period's actually worse. In addition, the spread between cap weight and EPS weight is worse than in the dot-com era, and the sector composition was better then, with only 4 sectors represented in the top 10 versus 6 sectors in 2000. So what do you say?
I'm saying the same thing. It's a ridiculous comparison. You can cherry pick data points, but if you look at the fundamentals of the dot-com era, they just didn't compare to the fundamentals now. You had companies, by the way, like Cisco that were selling at 100 times earnings. Yeah. That is a GDP grower. So I don't agree with that, number one. Number two, what I'd also say about that is that in a recession, what I want to own are fortress balance sheets, cash flow machines, and companies that aren't impacted by recession. So Snap's a perfect example. If we go into recession, where do you think the ad dollars are going to go? They're going to continue to go from Snap to a Meta, to a Google, to an Amazon. So these are perfectly positioned for that. I think we make too much of it. If you want to talk about overvaluation, go back to cyber. I mean, those stocks are ridiculously valued despite the opportunity set. So I'm not troubled by it. I disagree with that note completely.
I think it's obvious, it's human nature to look at the significant rally that we have had since the end of October and say, okay, this needs to cool off a little bit. And what you have in front of us is white hot momentum. And no one knows how long the white hot momentum can continue. I understand the concern that individuals have that we're pulling forward too much performance to the front of the year. That's the Ed Yardeni thesis, that you pull too much forward. So with all that in context, it's okay to look at equities right now and say, okay, I'm going to trim a little, but that doesn't mean you're at an inflection point. All it means is the momentum ultimately will cool. No one knows when though.
It's only human
but
nature.
It's fine. But
Go ahead,
just one quick comment, Scott, if I can. It's fine, but you take a look at the professor. He still owns NVIDIA. And why does he own NVIDIA? Because he believes ultimately the fundamentals will catch up to the valuation. So you're faced with a choice when you own these stocks. There's never anything wrong with taking a profit. But do I sell and pay taxes, or do I ride out the momentary, perhaps, overvaluation? That's what I look at. In 2 years, if I sold, I'd be unhappy that I sold. So I stick with the winner.
All right, well, we got other winners to talk about, too, because we have many stocks on the move still to get to. Fresh highs today for Uber, Chipotle, Palantir, ownership of all of them on this very desk today. We'll trade them next.
Are you following the Halftime Report podcast?
No.
What are you waiting for? Look for us in your favorite podcasting app. Follow the Halftime Podcast now.
I can't do it. Okay, we dropped below support. Jimmy was wrong about his prediction. 78. 49.78. Yes, SMCI. Oh, yes. Irrational exuberance. Should we short him? Not Disney. And I don't think PayPal. No, I wouldn't short Disney. Any kind of good news out of it could drop. Could drop to 95. PayPal.
.com.
IWM is at the 200. QQQ is at the 200, or the 200 come to it. Same as the SPY.
Hit today, including Uber. The stock right there, it's reversed. Actually, it's positive now. It was
Uber.
negative after the top and bottom beats. So, Weiss, you bought more of this stock. speaking with momentum, this run has been extraordinary. Year to date, it's up 15.5%. It's up near 60% in 6 months.
Yes. More than
Yeah,
that.
So look, we talk about momentum and share price, but we don't often talk about momentum and fundamentals. So the momentum and fundamentals continues to improve. I bought some actually right after the opening, then it starts to rally, then it dipped again to the opening level, so I bought a little more
6
then.
months
So-
ago.
So it's a
Okay,
pretty
he's
decent sized
right.
position. There's scarcity value here. The company's extraordinarily well run. I mean, you would never have thought the company would be what it is today versus the IPO, where it's purely moving people around. So I continue to like it, and I continue to think that it's going to perform. They talk about Japan, they talk about Asia.
Are you
Those
going to
virtually
82.75?
untapped markets. So the growth remains there. I'm staying with this one and adding to the winner.
Oh.
I love the way that Weiss put that, momentum and fundamentals, because it is short-sighted to only look at the momentum in a multiple and the momentum in the stock price.
PLTR, huh?
And you can apply, to Meta when you talk about momentum and fundamentals, and NVIDIA. At some point, you have to wonder if the momentum sort of starts to outpace the fundamentals in some respects. You own Uber as well, and you're holding on to it.
No, that's fair to make that assessment, but I agree with Steve. There's momentum and fundamentals, and it's been obvious that this company has seen an acceleration in the strong fundamental momentum over the past year. This is a company that's going to ultimately increase its buyback. This is a company that's had its first annual operating profit. This is a company that's improved its balance sheet and has positioned itself remarkably well. Here we are, 71.17. I think the company goes well above $80.
This guy's making me
It's
laugh.
seeing strength in mobility, it's seeing strength in delivery, and it absolutely obliterated, which I keep pointing out, Lyft.
Brian, you own it too.
We do. Who would have thought Weiss and I were so aligned on a day like this? It's just amazing. No, we bought it late last summer. I talked about living by the sword, die by the sword. We bought it at the beginning of a month, I think August 1 last
He's
year.
a tough guy.
After the stock was really getting hit. So we really like the name in terms of diversifying. Remember, it's an industrial name, and we like the growth that it actually brings to industrial stocks, especially given the fact that we see more earnings growth on the domestic side of industrial, so that's why we really like it.
Joe, Chipotle and Palantir, both your stocks, both hitting new 52-week highs today, and both up quite nicely. There's almost 9% for Chipotle. Palantir surged huge yesterday. You weren't on, obviously, but here we go.
So, Steve brought this up, and you talk about companies that have strong technical momentum and companies that have strong
Look at that.
momentum. And
CMG
Chipotle has that. This company is clearly the definition of quality in terms of servicing the consumer. Palantir, I will candidly say this. I would never have bought this stock individually, and this is why I believe a rules-based approach is the right approach in the marketplace. The strategy identified, the profitability, the birth of profitability that appeared, and the strategy was then subsequently rewarded with ridiculous momentum post-earnings. Obviously, we're benefiting from that over the last several days, but it's a credit, I believe, to having that discipline and having a rules-based process when you're looking at markets.
All right, good stuff. Let's get the headlines now with Bertha Coombs. Hey, Bertha.
Hey, how are you? Defense Secretary Lloyd Austin has agreed to testify at a congressional hearing to answer questions about why he didn't notify top officials of his hospitalization. Austin returned to the Pentagon last week and apologized for failing to properly notify the White House and top Pentagon staff of his cancer and treatment. That hearing will be held at the end of the month. The EPA announcing new, stronger air quality standards today. The standards lower the levels of soot emitted by 25%, which officials say will save lives.
Okay, SPY just now hit the 200 SMA.
4 deaths and 290,000 lost workdays. States will need to meet those new standards by 2032.
It's off the
And
VBOP.
NASA's Axiom Mission 3 crew is heading back home to Earth today after being delayed for weather. The crew's Dragon capsule undocked from the ISS this morning after spending 18 days there conducting experiments, and it's set to splash down off the coast of Florida Friday morning. Scott, back over to you.
Bertha, thanks so much. Ms. Bertha Coombs. All right, coming up, we have another move to tell you about. Brian Belsky buying more of a stock that seemingly goes up every day. And so does the price targets. All right, we'll do it next.
Do it now.
Black dollars in venture capital.
Okay. That's pretty good on CMG. 27.17. That's just crazy. And Jimmy doesn't like these highs either. Jimmy doesn't like the highs either. Let's go see what our Schwabs are doing.
5 years later.
I mean, rear view mirror. I don't know. I mean, it's tough. I mean,
Yeah.
I think that we've seen the direction at which all of this, which all the way that entertainment's going. It's all streaming, and it's. I just don't see a big future for it. But one thing that I think some people forget with Disney, when you get caught up talking about sports and you start thinking about all the movies and TV shows and whatnot, the content, their parks and their experiences, including the cruise ships, it's just a rock, right? I mean, that is just solid revenue that just seems to never have a chance of going away. I mean, it is just so strong, and everything that we see is not only extremely positive for Disney when it comes to their parks and number of people going and the happiness and all that, but also when we look at consumers talking about cutting back on spending, experiences and travel is one of the last things to go. Right, they're cutting bills at home. They're spending less on groceries. They're cutting services. They're cutting cable TV and things like that, switching to streaming. They're finding ways to save money, but they're not getting rid of the road trips or the family vacations. And for a lot of people, that means a Disney experience. So they've got what you would have thought would be a headwind with consumers kind of tightening their belt a little bit is actually a tailwind, because that seems to be the last place that people want to cut. So you kind of get three companies in one, and I would say that right now experiences is the strongest, the most steady. But now I would argue that sports is going to take that second place seat above entertainment, and the battle for nonstop content and the next movie and all that is probably the thing that I would guess would weigh on investors the most out of their three divisions. With again experience being the sort of the rock, the foundation of the company.
Yeah, Landon, your park visit mentions are up 34%. Any company would love 34% growth, and that's in a Disney theme park that probably isn't doing anything new exactly, except becoming more and more popular. So Disney has. You have to remember when you look at this company, streaming is that high-profile problem right now that Disney has, but they've got so many other businesses that are doing extremely well. Landon Swan, we appreciate you coming on always and giving us the Like Folio data. Have a great day, Landon.
Thanks, Kevin. Thank you, Nick.
All right, Nick. You know, this is a company going. It traded down hard this morning and now has rallied up pretty close to unchanged on the day. It's only down. Well, it's only down about 0.9%, so it's still lower. You have a trade for us here in Disney. What were you looking at?
You know, we didn't get into it with Landon, but there's
well, let's keep going.
You and I get into it. Well, and I won't take long on it, but there's just a lot of activism at the board level with Disney right now. Nelson Peltz is like,
Nelson Peltz,
like, you know, this isn't right. We got there's 3 companies. We should spin this up, and it's not uncommon, but it's not super common to have a company this large, this high a profile, having multiple activist investors saying, hey, you're not doing this right.
He's got a $3 billion investment, by the way.
Yeah, $3 billion investment. And I think the interesting thing is, you know, their stance is like, once Iger is gone, and he's truly out of all that, like, there's nobody that can manage this. Nobody understands the complexities of all of what Landon just said, right? Like, you got this massive sports complex that's getting larger and more intricate as we speak. You have this physical thing that might be the coolest experience for people under the age of, 15 in the whole world, right? Which is a whole separate thing. And then you've got sort of the movies and the franchise and all the streaming piece of it. It's like, I just don't know if in this earnings cycle, if the park piece of it, the rock that Landis and I agree, overcomes the rest of sort of the speculation out there. And I just don't think you have all this infighting at the board level if this is the best earnings report ever.
So give us your trade.
So this is skewed a little bit to the downside.
It's right on it.
My negative pitch.
498,350.
It looks like. Yeah. So what we've got here
for the
is actually
SPX.
looking to do something in the front month because the vol is very elevated in the front week. But this is you're
gonna watch it. Oh, we went down below it. Shit, I missed it. Oh man. Yeah, these things are up 100 and some bucks now. The 49.75s. Airlines had a pop yesterday and they're holding up. The airlines. NVIDIA still looking good, almost to 700. Tesla, if you look at the hour time frame, we tried to break the 200 today. There's Tesla right here. So 191.78 right now, but tweezer top 189.67, which support just above 180. Oh, actually below it. We could go below it. Huh. I'll put it up on 180. Wow. 181.29. 181.30. Oh, my coffee. A big bounce it looked like on the SPX right there. Yep. Let's see if it breaks this resistance. Not, we come back down here. practice. Strangle. Or a straddle. Ooh. Nothing happening there. Here goes up. No, not no good. What is that? Straddle. So if I think it's going to go down, oh, what I'm doing now is I'm practicing. It's a butterfly. Ooh.
Normally, where would crude be if the U.S. wasn't pumping 13.2 million barrels? It's pretty incredible. Ben Lichtenstein, host of the Future Show every morning on the Schwab Network. Make sure you check him out. Thanks for coming on, Ben. Back now, let's go live to Salt Lake City, Utah, to Mr. George Tillis, who's going to talk about our final stock of the day, and that is PayPal. George, boy, this stock has been a lot higher than it is now. It looks like it's trying to settle itself and make a little comeback here, George.
It is. I mean, it's you have to get context to PayPal, and some would say, looking at it from an electronics payment solutions leader, they have about 40% market share. But if you actually look at the 5-year chart for PayPal, it's actually trading below its 2018 level. So I think there's a lot going on with the business. Throughout this whole time, there was a huge run up, during the pandemic and pullback. They've been buying a lot of different companies. They have e-commerce payment solutions company Braintree, Zoom, which is essentially international transfer and payments, the traditional, merchant solutions payments system, but also, you got to think about Zettle, their point of sale solutions and e-commerce business as well. And so The point I'm trying to make here is if you look at the last 5 years, PayPal has essentially gone through quite a few acquisitions. Its sales have actually doubled since then. It's a profitable business, but I think what's going on with PayPal overall is we're just seeing a situation where PayPal was a growth company, but it wasn't necessarily a value company, and now it's starting to potentially find some valuations that are a little bit more compelling based upon its growth prospects. Now, if you compare the numbers, the estimates for earnings that are coming out are expected to grow about 9% and $1.36 a share. Sales are expected to be rather modest in the mid to high single digits at 6.6%. At 7.87 billion compared to 7.38 billion last year. And I think if you consider PayPal, even in the last year, it's pretty remarkable, but it's been down about 23 or so percent. And so what I think is going on here for PayPal is we're going through a multi-year process of multiple compression. The forward multiple is around 11.8 times. Let's call it 12 times to make the numbers simple. That's significantly lower than its 5-year average, which is close to 30 times. But if you look at margins, gross margins, you would think they were expanding, but they're not. Over the last 5 years, on average, it was around 44%, and right now, based on the last 4 quarters, about 40%. So 400 basis points lower than average, and to me, that suggests that they've been spending quite a bit of money to continue their leadership, market leadership, but also to increase their technology capex. So that's, again, cutting the profitability for the business.
It's interesting, George, with so many acquisitions still in this environment. They announced the other day that they're going to be laying off about 9% of staff, with the sort of cited reason being efficiency. And I think you're hitting that exactly. We need to find a way to monetize all this. And we haven't seen people go back to cash, right? Coming out of the pandemic, and the valuation doesn't sort of show that growth. But anything else you see, kind of like, what does efficiency mean for them as they go through these integrations and push not just into layoffs, but really monetizing these acquisitions that they've made?
Well, yeah, that's a good question. I think at the end of the day, they're going to be cutting back workforce. And like I said, 400 basis points in gross margins are telling. That tells you they've either been spending too much money on cost of goods sold, SG&A expenses are too high. So then you ratchet that back. And I think at the end of the day, when it comes down to payment volume, I mean, they're the market leader out there. They've got over $1 trillion in payment volume globally that go through their platform. But essentially, it's really not a growth company anymore, just based on the estimates that I'm looking at for both sales, again, in mid-single digits, earnings in the high single digits. This is not a bad thing. One would say, looking at it trading at around 12 times forward earnings, it's trading at a discount. You could make the case that is so. But I think what will happen here too, Nick, is I can't say for sure. Looking at the balance sheet, a lot of times what we've seen in the past, and it's not just the last quarter, but it happens historically, layoffs typically bring in cash, and then they'll add to a share buyback. Now, if you look at the cash on the balance sheet, it's actually grown for PayPal in the past 4 quarters to $11.5 billion. So I wouldn't be surprised to some extent post earnings that they raise their earnings guidance and also initiate a share buyback, but I can't say for sure.
George Schultz, thanks for coming on as always, spending some time with us on PayPal. Have a great day, George. All right, let's get right to the trade. We got about 3 minutes. So if you think about the 2 trades that we've done today, we've done a diagonal and we've done a unbalanced butterfly. Put those together and you've got what I like to call a hybrid butterfly, where you're selling the front month, right? You're buying the March 8th 64 call in PayPal. March 8th 64 call. Against it, you're selling 2 of the Feb 970 calls, buying 1 of the Feb 972 calls. So it's a butterfly, but it's also got a diagonal perspective to it, where you've got time, where if it doesn't get up towards 70, you can extend duration on this trade and keep going. Nick, this is really a combination of the other 2 trades we had on today, a hybrid butterfly to take advantage of that event. We've got about 2 minutes.
Yeah, so when you look at that graph, it's almost the mirror image of the put fly that we had on. It's more of an even slope and not those hard lines because of that time component. So what you're looking for here is for the stock to trend up to that pinnacle of profitability, but you don't want that to happen today, right? That's the difference in this trade. On the one that we just showed, you want that to happen right now, and then it can hang out there. If this hangs out there now, you have this sort of calendar risk where you're going to have to deal with your short in the money front week option, and then ultimately handle that vertical on the backside. So you have time on your side, but it's a nuanced time trade.
It's a way to put some duration
That's right.
into an earnings play, right?
Yep.
You get the theta with it, but it gives you some duration on the long side where you may not miss timing wise.
Yeah.
We got to go, Nick. Thank you so much for coming on. As always, spending the hour with us. Always great to have Nick Theodorakis here. For all of us here at the TD Ameritrade Network, that's our show for today. Stick around. Next Gen Investing coming up next with Alex Coffey and Jenny Horn. Have a great day, everybody.
So what are you doing here? It's up $5. Okay, not much. I've done a paper trade on PayPal with I call it a butterfly. Oh. Now it just dropped. It's called a butterfly. 25 cents. We were at 30, then we dropped down to 24 just a second ago. Now it's at 22 on this knife. Jimmy don't like. Jimmy does not like that. Might change all these here moving averages. I like this new one I got up. See how it held resistance, the 63 right there. Then I seen another one that had the 21, did pretty good. Okay, now I'm up 2 cents on this PayPal. Oh, up 32. Wow. $32 and $22, just like that. I don't like. Yeah, that was like a, huh. Jimmy don't like. My experiment. It was at 32 cents all of a sudden, and I looked at it just for a split second and it was down at 22 on this big last candle here. That wouldn't give you enough time to, you'd have to have an idea when you want to get out and set it. I'll take 7 cents. Spy off the VWAP on the 5-minute. One, two, three, boom. 1, 2, 3, boom. Oh. Okay, PayPal.
Some momentum here as we head into 2024, their fiscal year.
Yeah, I think this highlights the importance of individual stocks versus stock market indices. We're essentially at all-time highs. Let's call it all-time highs in the Nasdaq, in the S&P 500. But a name like Roblox is like a third, maybe even a quarter of what its all-time high is. Nice move though today. Nice move off the lows, but you can see pretty much a year of nothing. But that nothing doesn't tell the story. 20 to 40, 25 to 50, that's sort of the range that this has been in. That's a big wide range on a percentage basis.
It is, and I would say, yeah, that just goes to show, even though we're making a 10% move higher, still not back to pandemic peaks. But next name today is a pretty good follow-up on that because we're looking at Snap, as Snap is making a monstrous move to the downside. I mean, I had to check my platform a few times to make sure I was seeing this correctly, down 35% in reaction to its earnings. And hey, this is the beauty of them reporting after a lot of these mega cap names because it's not dragging on the overall market at all. I mean, we're at all-time highs in the rest of the major indices. But this company's earnings obviously were not what the investors wanted to hear. Stock tumbled in reaction to each of the last 7 earnings reports. So this has been now a consistent theme. 7 earnings we've seen selling, not to this extent, but still not a good track record. Quarterly revenue came in around $1.36 billion. That was below street forecast ever so slightly. It wasn't a huge miss. Adjusted earnings also did slightly exceed forecast by 1 cent per share. But now they did say that they expect to lose more money in the current quarter than the street had been anticipating as well. Projecting adjusted EBITDA losses ranging between 55 to 95 million for the period, which is, first of all, that's a really wide range. So typically I feel like when companies give such a large goalpost, that's not exactly indicative of strong conviction, because you're just basically giving yourself a lot of cushion there. But the street had been expecting around 33 million. So they're guiding for all over the place as far as losses here. And a name that right now, in terms of like its user growth, is just not looking comparable to, unfortunately, it has to follow Meta last week. I know Meta's such a larger company, but we talked about it yesterday. 10th largest as far as social media in the world, based on monthly active users.
Yeah, I'm not even sure that's that story. I think they could paint a bright picture if that was just the story. 10% growth, although users are flat in North America. This is the least surprising thing that I've seen. I mean, I can't be outwardly bearish or bullish ever, but I wasn't surprised, I'll put it that way, to see Snap underperform. And it's the reasons that we've talked about. The ads don't make sense on the platform. And if you're talking about year of efficiency across the board, what does that mean? That means more expense discipline. It means spend less on things. And if you're in that marketing department at any company and you're deciding where's my money going to go, there's not a requirement that says I need to put some at Meta, some at Alphabet, and some at Snap. It's I need to put it the best use that I can. And if it's not this overflowing pot of money, I need to go to where my ads get the most bang for their buck. And just the numbers themselves, although revenue grew by 5%, there really wasn't impressions growth. That suggests that the engagement on the ads is not there. And so if you're a company and you're pulling back expenses, where are you going to pull it back? Are you going to pull it back from where your ads are working? Or are you going to pull it back from where ads are not working? And not to say that they don't work for anybody, but compared to Meta, you can see the reaction.
What is the reaction?
But it's not growth where it matters. What matters for Snap is not users. It's give me a reason to put an ad on your platform, because if it doesn't do anything, why would I ever buy that?
I know they moved away from a lot of this brand advertising, or like some of their core advertising, to move into different advertising deals. It doesn't seem like it's paying off at all. So I completely agree. Ad dollars are what you're fighting for.
Don't agree with him.
Tight market, and not exactly looking super attractive at this point. Although I will say I wasn't shocked with the move to the downside. I'm shocked to the degree in which we're selling.
35% is pretty insane. It
is pretty insane. It's pretty insane, actually. That's only $6. I mean, I know it's all relative, but it feels massive when you see that number. But next name here today is a really street favorite as far as the restaurant space goes. That is Chipotle, which continues to really impress as far as its growth and its overall cost management. The company did raise prices by about 3% in the quarter, so saw a nice impact from that. They also have been scaling some of their operations to be more efficient. They actually said hiring various employees and making sure they're as automated as possible to then make sure their labor is just tight. But it's amazing because they actually did say that for their busy period, which occurs from March through May of this year, they're increasing their hiring substantially. I mean, they said that they're hiring around 15 or 19,000 workers, up from a 15,000 hiring goal last year. So it's the first time we've heard of this substantial hiring. We've talked about layoffs. It's really refreshing, frankly, to talk about them adding jobs. But same-store sales rose 8.5%. That easily exceeded forecasts for 7%. We did also see revenue that rose 15.5% from last year. Adjusted earnings also did easily top expectations, and they did report a record net income that was up 26% from last year. They also did say that overall, now looking into 2024, they're forecasting same-store sales growth in the mid-single-digit range, with plans to open between 285 to 315 new locations. They're also planning 2 limited-time menu items this year, and offering this robot, which they've been testing at some of their innovation centers, that is called the Autocado, that does scoop your avocado for you. And I mention this every time. I don't think the stock cares about this at all, but I love the name Autocado.
Yeah, I'm not even going to try to say that. But what I will say is margin expansion, consistent revenue growth, and now over a third of the sales in beverages and food for Chipotle going through digital channels.
It's
so
wild.
They have set the standard for fast, convenient, and they've also adapted as more food delivery and on mobile ordering and pickup has taken center stage the last few years. They've been right at the forefront of this innovation. It's like death taxes and Chipotle going up on earnings. It's that strong, always, it seems. But despite Rick Ducat throwing some cold water on our Chipotle love, the stock doesn't care.
The stock doesn't care. It's loved. Foot traffic also increased, and that's amazing because you heard from McDonald's and Starbucks that that was not the trend this quarter. So really amazing to see them continue to be an outlier and really a leader in terms of growth in the overall restaurant discretionary space. But next name today here is Yum Brands. And Yum Brands' quarter shaping up a bit different here as this company is massive as far as its store footprint and also does have that international exposure. So for that reason, I more closely correlate them to like a McDonald's. But hey, actually, based on their numbers, I was surprised to see a 2.5% move to the upside because quarterly revenue and earnings did miss analyst expectations. They did highlight that top-line sales were impacted by the conflict in the Middle East region with various degrees of impact across the Middle East, Malaysia, and Indonesia. They also said this represented a low single-digit headwind to their overall sales growth, adding that they actually expected this to continue now throughout their first quarter, and they're hoping it will likely taper off throughout the year. But they did say their global same-store sales increased 1%. Pizza Hut reported same-store sales declines of 2%. That missed expectations. They did see that pizza chain's U.S. same-store sales shrink by 4%, while internationally it was flat. Now, Pizza Hut in particular saw sales soften in some of the Israel-Hamas regions, so that was something they attributed that weakness to. But KFC same-store sales rose 2%, that also missed. And Taco Bell, which is usually like the crown jewel of their portfolio, also came in light as far as its overall same-store sales. So all of their various brands were weak, and so to me, I read these numbers earlier this morning pre-market. I'm actually pleased to see a near now 3% move to the upside.
Yeah, Pizza Hut, that's a name I haven't heard in a while in terms of places to go, but this seems like a better than feared type of expectation. Wasn't trading at the highs, had a little bit of a participation in this rally. And it's just doing what it can, it's kind of chugging along. I know that they spun off the China piece of that. You'd have to think, although that Yum C is doing pretty well today, but not having that China portfolio within this particular holding piece, I think has probably helped it over the last couple of years. That's why it's more sideways than down. But okay results, I would say. Okay, not Chipotle-like, but better than feared. Not VFC.
No VFC, but not quite
No
Chipotle.
Snap.
You make a good point, though, where they are able to break out that China segment, which I think is huge for sort of boosting and keeping some of their results insulated from the overseas headwinds. But we'll be diving more into that name actually coming up next, looking at some technicals, example trades, as well as Roblox, two names we have discussed very often, so we'll be diving more into all things those upvoted names coming up next on Next Gen Investing.
Schwab Bank Investor Checking, the checking account built for
Not built for me. Sorry.
both moving in reaction to their quarterly updates. So here to break down the charts for us, as always, is our chart master, Rick Ducat. We'll start things off here with Roblox, as Roblox was at one point like one of these pandemic darlings. I know they've coined themselves the original metaverse, but
Let's see if he has it charted like I do.
As of late, although making a really nice move to the upside today.
Yeah, nice move indeed, but with a caveat here, because
Caveat.
it bumped up against a resistance point that we've touched numerous times in the past here. This red line.
Oh,
here,
you got it on there.
25. We just haven't been able
See
to
it?
crack it. Once again, rejected for the fourth time or so during the past year. Now, to backtrack a little bit here, this is an interesting chart because a lot of the price action is pretty much sideways.
His chart's
except
different
for
than
this.
mine.
We had a big gap to the downside on earnings on very heavy volume. We kind of meandered sideways for a little bit. Then we broke up again, once again on earnings, once again on very big volume here. So we had a very distinct kind of
volume
reversal of
spike.
fortunes in this name. Uptrending, we're up like 80% or so from these yearly lows that we carved out right here. But the uptrend was broken. You can see this purple line that we had. We broke through it pretty convincingly. We broke below our moving averages that we follow. Yellow 21-day, orange 63-day. We found some footing at the purple 252-day. Then we transitioned into
Where's
a
the
more
200
regular price pattern.
SMA?
Now, this is the kind of thing that I sit up and
Chartist,
take notice
artist.
of. You might think, oh, it's boring, it's moving in an increasingly smaller range.
I see his flag.
But that's the key thing. Is
But
that
I wasn't
low
looking at the
volatility
yearly.
can often be a precursor to high volatility. When we do get the eventual breakout, it's like the stock is coiling like a spring. We can get a big reaction one way or the other if we do break out, and that's what's happening today. We had a big push to the upside, once again on heavy volume. And how I define heavy volume is a volume spike, which is I take a 50-day moving average of volume, then you calculate 50% beyond that, 50% greater than that average. If it's above that point, that's categorized as a volume spike. We care about this because it shows conviction. It shows that people are getting in on the move and making trades based on it. And we're up today, even though we are not really that far changed from the open here, still a big move to the upside.
Yeah, I mean, still a big move to the upside. And hey, Rick, if it interests you, it interests us, because I do always think that there's like pockets of fascinating technicals here, even though it's overall been somewhat disappointing. So now in terms of the momentum of this recent trend, what are you seeing?
Matching the triangular shape and price, you can see here two trend lines converging toward each other. We had kind of a similar situation in the RSI here. Two trend lines converging toward each other, mostly in the bearish side of the spectrum here though, kind of bouncing around, not really able to gain a foothold above that 50 midline, and that's what separates bullish and bearish momentum here. So things were perhaps a little more geared toward the downside, but we broke above our trend line. We broke above the 50 midline, seeming like we're pretty comfortably above that point today. Now the question is what's going to happen in the coming days. As I said though, we really need to break above this resistance point to kind of create a new price regime, so to speak, a new trend to the upside, because we've faltered multiple times at this point here. Really not what you want to see if you're bullish, is another breakdown at that level.
Yeah, and at least encouraging, we're about 80% off of our yearly lows here. So now as far as these key
Okay,
levels
Debbie
we're watching,
Downer.
we already got this pretty high volatility event being earnings. What are you seeing?
Well, you know, now that we include our volume profile study, this blue bar graph on the right side of the screen, this shows the areas of heaviest trading. We can see that our triangular pattern here is mostly centered around the volume profile point of control. So this was a key
volume
area.
point of
And
file
today,
point of
we,
control.
have broken above that point, once again, fairly convincingly. We also add in our standard deviation channels.
Oh, the standard deviation.
Some way to gauge where we might find resistance if we do break above this repeated
you
ceiling
dog.
that we haven't been able to crack so far. So we take our blue linear regression line, our line of best fit. We take standard deviations to the upside and the downside to create the channel.
On what?
The +2 channel comes in pretty close to where we are now. 47.37 is the +2 channel. That would be a spot to be on the lookout for some potential resistance
on the
if
daily.
we do break that ceiling near 46.25, which is kind of, based on today's price action for the current situation in the short term, not looking too probable for today. Certainly not saying it can't happen in the future, but we've backed off significantly from that point today. Now, to the downside, if you're more worried about price collapsing and going back to a lower point here, the +1 channel comes in near 41.79. Then we've got our moving averages and our trend line and our volume profile, point of control near like 40, 41 or so, around those areas.
Yeah, and I think really good breakdown and there's sort of different ways to look at it. As of course, it is making. I mean, now we're
Don't listen to him, honey.
10.7%
He's wrong.
here in real time. So now in trading this name, Alex, I think that the feeling today is that there's optimism. I mean, when you see a move to this extent, I definitely think that's favorable for those bulls in this name. So
on earnings too.
Right. I do think like a fundamental update to back a move to the upside like this is definitely encouraging. Then walk us through a more bullish example trade.
Yeah, looking at a kind of a move or a trade that will benefit from a breakout to the upside. Looking at buying a call vertical, one strike in the money, one strike out of the money. It's about a $45 stock, and we're looking at a $5 wide spread, so it gives us a little bit of room for some movement here. Looking at buying the 42.47 call vertical expiring in the March 8th expiration. If we can spend $250 on that, creates that equal risk to reward, risk $250 to make $250. The break even at $44.50. That's pretty close to the current share price, which of course is our other guideline. So 1-to-1 risk to the reward, break even in the wheelhouse of the current share price. Benefits from a move to the upside, risk to the downside, looking for a move back towards those highs that we saw not that long ago. Best case scenario, move above 47. Worst case, of course, below 42, but limited to that $250 at risk, which you get from the $250 debit.
So of course this does protect you from some downside risks just in case we see things fall off from obviously the nice rally we're seeing today. But now to look at another name moving in reaction to earnings, a bit smaller, but that is Yum Brands. Definitely not smaller as far as its market cap goes, at least, Rick. And
Yummy.
Also with its various brands, some of these can really excite you. I'm a huge Taco Bell fan myself, but I know we've talked a lot about like the Chipotle.
Oh, I can't be looking at your chart.
So this one is right in our wheelhouse. So as far as the charts go, what do you see?
My wife had a lot of pregnancy cravings for Pizza Hut. I had a lot.
Looks like you've ate a lot too, sir.
Children.
That is so. Yeah, it's a place I haven't been in about a decade, so I respect that.
Yeah, but you know, kind of a not a big mover over the past 52 weeks. We're only up about 1% from that point a year ago here. Since then, we've seen some volatility for sure, but the move off the lows.
Where in the hell did you get that?
We're up about 13%. And it's been kind of a modest move upward, though. You can see we had kind of a sideways consolidation here. We gapped up on our last earnings, and then we formed this very kind of mild upward channel here. You know, I did this just by creating a conventional trend line going across the lows, duplicating it, making a parallel line going across the highs. Matches up pretty cleanly. You know, you'd be surprised how often that can happen here. Not going to happen every time, not going to fit in every situation, but it can be a way to project potential resistance or support in the reverse situation here. But now, the past 2 days of price action, pretty interesting.
You're good, but you're not that good.
We touched our channel once again, and then in one fell swoop,
1, 2, 3.
Surged above our 3 moving averages, which is less impressive.
See, I would have done it
when you
different.
consider how close together they are. They're all kind of clustered.
My line would have went from there to there.
That's what you can expect to see.
Boom.
In a weak or trendless environment. The moving averages will kind of move together. They'll kind of be on top of each other for the most part. And you can see, though, that we did get a big push to the upside. Our moving averages are now trending upward here. That's a sign that the trend is more geared toward the upside. But like our last name, we are failing at a resistance level once again here. This level around 132.50. This is another one with a ceiling that really needs to be broken to start, continued upside.
Yeah, and I feel like this is a theme we've seen in so many of these restaurant stocks actually, where they're just unable to break above these key levels we keep discussing, like you just said. So now in terms of RSI, what are you seeing here?
Damn, that's a pretty chart, buddy.
Like a lackluster trend, we're pretty much unchanged on a year-to-date basis.
Yeah, and you know,
Yummy.
Not really giving any great shakes or anything here. A lot of bouncing around the 50 midline, like I said previously too. But you know, look here, we've got a bit of a trend line to consider, and we did push above the 50 midline. We pushed above the trend line today. So momentum is improving. Momentum is getting more shifting to the upside here. Couple that with our trend improvement based on our moving averages, that can give us a more bullish outlook on the stock based on these indicators.
We missed our 1, 2, 3 opportunity on that baby.
Situation where we have some kind of fundamental change, some kind of catalyst, and it makes our
That was
technical
yesterday.
shift here, that can be a sign that there's a trend change happening. As technicians, that's one of the primary ways of technical trading. It's either trend following or mean reversion. You want to get in on the trend as early as possible when it starts to shift. These are some of the signs that it's shifting.
Yeah, I mean, that's at least encouraging because I think some shift here is welcome. But now, as far as some levels we're watching, obviously, again, just like with Roblox, we already have earnings behind us. What price levels are you keeping on your radar?
Well, once again, volume profile reveals some interesting information. We can see here that in addition to our moving averages being all around the same point between like 128 to 129 or so, we also see that we have our volume profile point of control, the area of heaviest trading. So this was kind of centered around, the movement recently we've seen is kind of centered around that key area here, kind of like a pivot point. If you give it a good strong push in one direction, it could result in a big move to that direction here. But, like I said, resistance, 132.50, that's the obvious point to be watching here. Then we've got the upper boundary of our channel. I was saying you can use this to project resistance earlier. That comes in a little bit to the upside, maybe 133.25 or so. But the ultimate area to really be watching right here. We have a similar situation of repeated tests of a high point in the area near 139.25. That's really where we would need to break above to get a new trend going here. To the downside, take your pick. We've got all our moving averages and our volume profile point of control in that area I mentioned before. But if you really saw a move to the downside, these recent lows near 125.75 would be another point to keep an eye on.
Exactly.
Yeah, absolutely. So a lot to look at here, and hopefully we start to just see some upward activity following today's nice 2.7% move to the upside. We will leave it there. Appreciate the technical.
Don't listen to him, honey.
Our chart
It's 126.
So now trading this name as well, Alex. Different situation, nice move to the upside. So walk us through again a more bullish leaning example trade just based on its activity.
He's 25 cents
looking
off.
At buying a call diagonal spread. So it's going to combine elements of what we looked at in the last trade example, which of course would be a call vertical spread, and then something we talk about often, which is a call calendar spread. Combining those elements makes
Call
the diagonal
calendar spread.
It's going to consist of two different expirations and two different strikes. What we're looking at in particular here is buying the 130 April call and then selling the March 135 call. It creates a risk profile that looks like this. It kind of has elements of that risk profile that we're used to seeing with the call calendar spread that looks like a mountaintop, but it's tilted on its axis here. Sometimes it's referred to as the poor man's covered call. When you're buying that in the money Yum call in the longer dated April option while selling against it, much like in a covered call, the shorter dated March call that is out of the money. But of course, we know there's differences between owning a call option and owning stock. You can't have the dividends. You don't have voting rights. They have an expiration.
Write this one down.
On this type of a trade, you're looking for a subtle move higher towards your short strike. And you want that to kind of happen before but near that March expiration. So this is one that it benefits from expanding implied volatility and a move higher. But because it's done for less than the width of the spread at 375, there's theoretically no upside risk on this one, Jenny. It's one that benefits from a move higher.
Gosh, and it feels like just yesterday it was November, and I was like, I can't believe we're looking at January expiration dates, and now I can't believe we're looking at April as expiration dates. Time is flying, so that is a wild concept to think about, but we will leave it there for this segment. Now, coming up next, it's time to talk all things Disney, as the House of Mouse is set to report its results today after the closing bell, but also has some streaming news we'll unpack coming up next.
Nope. There's no volume there, sir.
My dad was
My dad was a very hard worker. He used to do push-ups right when he got home from work. Said, "Ma, will you cook some fried chicken for us?" Cook some fried chicken. Coin had a good little bounce. Yep, Jimmy said it. I tried to tell you. I think Sue mentioned it too. Oh. We don't want to save that. We want to copy it. See? I didn't want to save it. I wanted to copy it. Bubba here. Gotta do this. Do it. Oh. I wish I'd bought the dip on that. NVIDIA Tesla double topping on the 1 hour time frame. Yeah, I got that alert at 126 on Yummy.
Climbed nearly about 9% this year. We are modestly lower today. For this quarter, earnings are expected at around 99 cents per share on revenue of $23.6 billion. Now, what we have also seen is this proxy
Disney.
battle between, of course, Nelson Peltz and
Disney
Bob
did hit my
Iger.
resistance.
Well, Peltz has ended that previous proxy battle that was pretty much over a year ago. We have seen the fact that he's revived.
So this, I mean, we did hit a resistance on Disney. We called it the bull flag for one. She broke out of the bull flag. We have a 1-2 fribus, a 1-2 freebie, boom, to the standard deviation channel of section 2. Oh my God, look at the SPX. What did I miss? Oh my. Oh. Ooh. SPX. Well, they're not up that much. Well, they are. They're really not up what they should be. Huh. Right now, the fat cats are back from lunch. Damn. We come real close to hitting 5,000. I really want to get it put here and just do it overnight. I'm going to take a small risk. I would advise nobody else to follow this here trade, but I'm going to do it. No, don't, not yet. Oh, God. I'm looking at the 49.90, and it was at 350, and then 360, and then 350, and 360, and then all of a sudden 390. So as we expand here, he's getting ready. Right about now. There it is. 3.50. I did put it on the SPX. Okay. Come on, hurry up. Oh, I put, okay, calls, yeah. Whew. Panic attack. Panic attack. Soma. Crowd's pretty quiet right now. He didn't use his cheat sheet this time. Tesla finally getting some, yes. Yes, it is. Okay, we're at $4. Let's have a couple more big old red candles. Right there. See, I can get out here at 450. Oh, bigger candle, more red. No. No upside. Shorted some NVIDIA at 495. How do you? Okay. Oh! 530. Hell of a time to have a sneeze. Oh! Come on, give me another red candle. Let's not be greedy. I'm having panic attacks right now if I should sell this. Panic attacks. Okay, make a business decision. No. Okay. $5. Come on. Oh. Ah. Drop. I beg you. I could have got out at 5 again, maybe. Ding. Big drop right down here would be real sweet. So what you got to say?
And then also tell the story about reduced risk when it comes to customers. Are you seeing any type of cracks when it comes to their customer base and credit and things of that nature? I think that could be a headwind. But overall, once again, the technical level right now is going to be tough to be able to break to the upside here. But the story that they've told over the last 60 days has been decent, and hopefully they're going to be able to show that and reflect it within their earnings announcement here tonight.
Kev, final thoughts here. I'm looking at a story, and looking back at the annual financials, that's largely improved as time's gone on. Yet the stock's lost what? 4/5 of its value, almost 80%, depending on what mark you want to put it in the sand. Is this a situation where this space just isn't as shiny to the market? Things are focused on semiconductors. They were focused on electric vehicles. This is just another example of an area that got a little overzealous, and the air had to come out in some fashion. So while the company might be in a stronger place, the stock had to go down.
Yeah, so there was a contraction in margins when it comes to this space, so that's a huge deal, right? So if you don't have the revenue growth to really be outsized, if you will, and the margins contract, it's harder to be a little bit profitable. And the competition in this space has gotten just ridiculously high here. You have Zelle, you have Affirm, you have Apple Pay, you have Square or Block, and what have you. I mean, there's a lot of competitors that are, trying to capture market share. So I think trying to differentiate themselves has been a little bit of an issue in the near term. But once again, you still have some green shoots potentially when you're looking at buy now, pay later. If they're able to capitalize on that opportunity and be able to integrate it with some of the Venmo offerings that they do have, I think that could be a tailwind for them.
Well, back to even on that. That's not a smart move.
The good thing, I guess, is that ahead of their earnings, their bar has been set relatively low just based on their stock performance over the last year. So that seems to be typically paying off at least this earnings reporting period. But we will leave it there. Really great breakdown of what we can expect from all things PayPal. A bit of a disappointment, to put it lightly, over the last year. But now coming up next, another name that's disappointing in reaction to its quarterly update. That's VF Corp, with shares down over 11%. As Vans doesn't seem like are able to benefit their top and bottom line. We'll discuss that more with George Tillett coming up next.
Oh, about the single mother. Wait until you see my commercial on Schwab. I can see what it's going to say. Ding, 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 ding. Man, NVIDIA. $290. Damn.
Activist investors get involved, but unfortunately, trends are still down for the stock.
A little bit of margin expansion and surprisingly stronger, a little bit of sales growth in China. That's a unique. We haven't seen that much else, but George Till is appreciated as always. Senior markets correspondent for the Schwab Network. No hats yet, no S&P 500, 5,000, but we're on the doorstep. We'll see when it happens if it does. Thanks for watching. The watch list is up next.
I remember when I first started flying.
Oh no. What are them little bats on the ceiling? Them were the days. Okay, let's see a big knife here. Right now we're at 330. We've got 6 contracts of the SPX puts at 49.90 with an average of 320. Now I can get out here and call it a over game, but we're gonna wait. Come on. Give me 5. Give me 49.92. Actually, give me 49.92.72. And I won't ask for anything more than that. You have the decency to do that at least. 49.92.73. Okay, we're waiting for you to go down. We got a double bottom on SMCI, a double bottom on SMCI. Booyah.
$762. The Dow is up 0.5%, and the Russell is up 0.2%. As you look at oil and gold, they are mixed as gold pulls back 50 cents and oil at $73.60 the barrel. In the meantime, for some of the big stories in the markets, we welcome in Kevin Hayes, Senior Equities Contributor, taking a look at CVS Health moving this today after the earnings. Your thoughts on that report, Kevin?
Hi, Nicole. Yeah, CVS Pharmacy up about 1.8% today on their earnings. $2.12 versus $1.99 expected. Revenue beat $93.81 billion versus $90.36 expected. Revenue growth 11.9%. Operating margin 3.6%. Same-store sales up 11.3%. Remember, Nicole, this is a company trying desperately to transition from pharmacy to total health care. So it's really good progress they seem to be making. Total medical membership now 25.7 million people. Medical benefits ratio 88.5%. Pharmacy claims 600.8 million. Prescriptions filled 431.5 million. So this is a company evolving from a pharmacy into full-scale medical services.
Big mistake.
All right, and then we have Disney. Of course, we got early this morning the big news on the Disney sports streaming deal with the others, Fox and Warner Brothers. And earnings after the close. So tell me what you're watching here.
Yeah, Disney stock, the high-profile earnings release after the bell today. So many different headlines and stories you can go to, Nicole. Yes, the news that came out today, their deal with Fox and Warner Brothers and Discovery, trying desperately to figure out how to get streaming profitable. Obviously, you know, linear TV and cable news is in kind of a death spiral right now, but the good news is for Disney, that's only one part of this company, right?
I bet your earnings will be good.
Theme parks are still growing. They're going to put 3 new ships in the water in the next 5 years. $60 billion in CapEx spending. So this is a company trying to figure out streaming and how to get that right and profitable while growing and expanding the other profitable parts of their business. So they seem to be getting everything on the right track. This is a big announcement today they did today, though, trying desperately to figure out live TV and sports, how to get them all together and get them profitable.
Yeah.
That's where it's at. All right, Kevin Hanks, thank you for that.
Yes, ma'am.
Now let's take a look at the bigger picture. Alexander Reed's with us, CFA, Chief Investment Officer, and Visage Wealth. Thank you for being with us, Alexander. How are you feeling about the markets? Because right now the S&P and NASDAQ hit new highs today.
Yes, they did.
Right. Thanks, Nicole, for having me. I was hoping we'd hit 5,000 during this call. It would be a great achievement. But feeling pretty good. The last couple of data points from the economy continue to build on the probabilities of a soft landing. There's a lot of focus and fear out there around the surge in mega cap tech stocks. Concentration and the leadership we've seen last year is kind of folded into this year as well through the first month and a few days of the year. And so we think that as these soft landing probabilities continue to add up, that it's a really kind of green shoots environment for a lot of different opportunities in the equity market.
Yeah, understood. What happened to that soft landing? Is that still there, or are you worried that's not the picture?
We still think that's, at this point, that's the highest base probability for the economy. We saw some of the ISM, prices paid start to increase back up last week, and some wage growth out of the labor market reports ticking back up to over 4.5%. So from the Fed's perspective, that's borderline soft landing / no landing scenario. So we think most likely scenario is still a soft landing. What we define that as is at trend or below trend GDP growth with falling inflation. And if that trend continues throughout this year, you have an accommodative Fed. There's a lot of conversation around the Fed cut 3 times, 4 times. The bond market got as aggressive as pricing in 6 rate cuts. Now we're about 3.9 rate cuts. The Fed says 3. We think the broader picture, that really doesn't matter. The fact is the Fed and fighting the Fed moniker that usually has headwinds for the market is behind us. So moving forward this year, we at least at a minimum, we think the Fed is accommodated with no further rate hikes. Whether they get 1 or 2 is positive on the margin. But we think that kind of narrative conviction as that builds, that further cements the probabilities of the soft landing occurring through this year.
Yeah, understood. So at this point, I know you like mid caps, small caps, mid caps. How would you go about placing some investments for a profitable return?
Sure. So we get this question a lot with clients of looking at the Mag 7 stocks and performing so well year to date, and a lot of people will go back and say the concentrations to such a degree that we saw in 2000 immediately think we're in a 2000 like bubble. We don't think so. A lot of the growth in the mega caps has been warranted. Great earnings. They're expected to contribute a large portion of earnings growth for this year. And so we still like mega caps, but we're taking equity exposure away from value, high beta, international equities that tend to do well in kind of this reflationary environment, accelerating growth, accelerating inflation. And we just don't see the catalyst for that. So we're taking exposure from those areas and looking for the value in the mid cap universe. We think there's kind of three major setups for small caps and mid caps throughout this year. One being the accommodative Fed. You've seen it on a daily basis when rates sell off. The Russell sells off immediately in concert, right? And so it's going to take time for that type of sentiment on small caps to abate. But we think that that sentiment changes throughout this year. Secondly, small caps and mid caps, historically, when the Fed begins the rate cutting cycle, have matched or outperformed S&P 500 returns during those cycles. And then finally, valuation on the small mid caps. The S&P today is at 20 times earnings, which is rich relative to history. But the equal weight S&P is at 16. So valuation alone is never a decision to buy or sell an investment for us. It's part of this mosaic that we take into account. But that really tells you the margin of safety is there. And it's really just kind of oscillating between the sentiment of small caps and getting more conviction on the Fed's path. That we think, and a soft landing, of course, can really open up the opportunity for small mid caps to outperform.
Everything getting ready to squeeze.
What about bonds? Where do you feel about investing in bonds?
Yeah, we think we're in a range, around 4.25. With the Fed pushing out rate cut expectations, now the rate cut expectations out to June. With 3.9 rate cuts as of yesterday morning, priced into the bond market. We're not afraid of 4 to 7 year duration in bonds.
Not afraid
from a total return perspective. Outside of a no landing scenario where we see kind of this reacceleration of growth and inflation, having a negative total return year, for investment grade bonds, in that kind of belly of the curve, 4 to 7 year duration. It'll be pretty tough to see a negative year from a total return perspective. We think kind of a worst case, it's a coupon clipping, 5-6% return for fixed income. And if we do get, the 3 rate cuts from the Fed, you could see, a percentage or two of price appreciation best case. So we think that, bonds putting past behind us and kind of looking forward, it's a different playbook for bonds. We think this year that can be additive to a multi-asset portfolio.
Yeah, and just finally, we see the Magnificent Seven. You mentioned them, 13 trillion. Now you have topped that in value as the S&P flirts with the 5,000 mark, which we didn't hit while we were talking. Final thought.
Yeah, for the Mag 7, we say they're not all created equal. From a price perspective, they've certainly all contributed to the strong returns in the overall index. I can't speak to individual names, but we are long 5 of the Magnificent Seven.
I think you need to.
And, if you look at the Magnificent Seven specifically, they make up 29% of the weight in the S&P 500, which, looking backwards, that seems like a lot.
Time for some hot tea.
21% of the earnings growth in the S&P 500. So the performance, the earnings growth is warranted and justified, we think, for certain components of the Magnificent Seven. It's just
you're fired.
These elevated valuations, the air is just thinner. The margin of safety is much lower. It doesn't mean the stocks can't continue because they are some of the highest quality, highest earnings growth companies in the marketplace right now.
All right, Alexander Reed and Visage Wealth, thank you so much. Coming up next, we're going to dive into the Fed's rate cutting path and Jay Powell's potential concerns with cutting rates too soon. Stay with us.
Looks like they broke out. Oops.
Welcome back to the watch list. I'm Nicole Petalidis, live on the floor of the New York Stock Exchange. More movers for you in the market right now. Enphase Energy soaring today. Oppenheimer upgrading the stock to outperform from perform following its fourth quarter earnings yesterday. The solar equipment company's CEO says he thinks the first quarter will be the bottom after the stock has fallen around 12% this year alone. And VF Corp falling after it missed third quarter estimates yesterday. Saw a downgrade from Goldman Sachs this morning. The parent company of Vans, North Face, saying it was strategically reviewing its brand portfolio after the disappointing holiday quarter, also citing weather and management difficulties. Then there's Amgen sinking despite a slowdown on raising their price targets after fourth quarter earnings did beat the expectations last night. The company saw revenue boosts in the quarter from its acquisition of Horizon Therapeutics, and Amgen's CEO anticipates more than a dozen significant pipeline milestones in 2024. Snap plunging over 30% in today's session after its fourth quarter revenue missed expectations and the guidance disappointed the street. This comes a day after Snap announced 10% workforce layoffs, and analysts have cut their price targets on this name, citing factors such as weak engagement, a slower than expected turnaround for ad revenue. Here's a look at the latest move in Bitcoin right now, 43,865, gaining more than 0.25% today. Continue to chat about the markets here. David Strzelecki's with us, CEO of Sound Planning Group. How are you feeling? Bullish, bearish, cautious as we hit records today?
You know, hey, it's amazing. I vote the market goes up forever. I think the quote, though, that really encapsulates this moment is one that Warren Buffett gave us here when he talked about investing in a bull market, and that is, only when the tide goes out do we find out who's swimming naked. So, you know, I think that the tide's going to be in for a second as we're looking at a melt up right now, certainly. But I wouldn't hold my breath too much on that, as the second part of the year is probably going to not bode as well for GDP.
Right, understood. So with that, where do you see, I mean, if the S&P right now is around this 5,000 mark, what kind of range are you watching for?
You know, Nicole, it's kind of difficult to you know, project. No one knows ultimately where this is going. I mean, when we look at you know, the Magnificent Seven, which is, you know, just like the, you know, the big talking point here right now, they are a significant portion of
I know one
the US
thing.
stock market.
I want this thing to go down.
Why? Because the S&P 500 is cap weighted, and so where do we go from S&P 5,000? I think that you could probably see another 10% on the upside.
Oh, God.
Possibly even 20% on the upside if we really get to a melt up type of a moment here. But valuations are going to be difficult at these kind of nosebleed levels because price per earnings is elevated right now. And they are definitely above what has been the normal trend according to the Buffett indicator or the Shiller PE ratio. We're elevated right now better than 50%, which doesn't mean that it has to crash tomorrow. It's just that we just need to recognize that we're getting a little top heavy right now. And, the downside could be significant. And there's a lot of things that we could probably see go wrong.
God. Significant.
Are people overly optimistic, maybe?
Yeah, I think that that's true. Our natural mentalities at moments like this is that we don't want to, the fear of missing out. We don't want to miss, another amazing story of NVIDIA just, destroying numbers and expectations year over year. It's been an incredible story to watch. Look at Microsoft right now, the largest company in the world. That's a home team here in the greater Seattle area for me. And so these are pretty exciting moments as we're seeing things evolve. Microsoft was stale for a long time. Now it's really growing. And this AI revolution, I think, is really, positioned well for Microsoft to capitalize on integrations into our day-to-day. So, is everyone kind of a little bit excited? Yeah, I think anytime you get into a renaissance, anytime you get into, new opportunities, we ultimately, speculate in some of these things. Big money's chasing it. Foolish money's chasing it. And, we're capitalizing on these things as well. Just we don't want to have too much exposure without real anchors that are really going to hold us.
Right. You have a few names in the Magnificent Seven focusing on AI. Do you like those names? Tell me about a couple of the names you're watching, and do you like them?
Sure. Well, it's not like you like them or don't like them necessarily. I mean, right now, hey, when things are working, of course you think that these things are amazing. Microsoft is doing incredibly well, as I just noted here. Tesla is down about 25% on the year. And so, if you look at Tesla as a strong player, which I certainly do, even though EVs are cooling down, Elon Musk is a force to be reckoned with right now, and that looks like a buying opportunity.
Go!
If we look at Amazon right now, it has been the big lagger of those seven. And, as far as my house is concerned, we've got Amazon packages showing up every single day, and I think that that's like most people here today. So, will we look and see the consumer, continue to move forward with those things? Yeah, I think so, and I think AI can really improve even what Amazon has been doing.
The guy's got the same kind of beard I used to have.
Figured out how to become as efficient
but
as
I didn't have the side
using
things.
robots and a number of different things.
I had that.
I think that there's a lot of positive things that are moving.
We're now at
right
340.
Now Magnificent Seven, especially because they
Keep
have
talking, Betty.
the ability to spend money on new advances. So that CapEx is basically happening in those big seven because they're being fed so much.
Microsoft, Tesla, and Amazon are those three picks for you, I would say. I know you had NVIDIA here as a leader, but that's less of a pick, right?
Well, here's my concern about NVIDIA right now, and it's not about NVIDIA. My concern is about the geopolitical issues that are taking place right now with Asia. And, China has ultimately said that they are going to be, Xi Jinping said that he's going to be going forward with, advancing on Taiwan, uniting Taiwan. That's what he promised everyone last year when he took his illegal third term as president. And we need to know something. NVIDIA today does not actually produce their chips. Taiwan Semiconductor does. And so if China advances on Taiwan, how does that mess up this AI thing? How does that mess up NVIDIA? That's my only caution on going too heavy that direction.
Yeah, understood.
That's smart.
We also have biotech here as a sector that could benefit from AI. Tell me about some of the other sectors that could benefit from AI and how you would maybe play those.
Sure. Well, biotech and healthcare are going to really capitalize on AI. Why? Because AI is going to make things a lot more efficient. Just think advances in medicine, taking old medicines and repurposing them because we can understand their efficacy in other ways. So AI is going to really do some awesome things. I'm just going to also note this as well, and that is AI is going to also make commodities and mining a lot more effective. Because see, when they can ultimately, look at this data, see deeper into the details, they're going to make better decisions. And so therefore their dollar for dollar is going to be, applied in a more effective manner. And so I'm really excited about some of those improvements in AI. Certainly there's going to be some negative things that we'll see at some point here with it, but new integrations are going to ultimately lift supply because demand has been curbed down because of the interest rate challenges with Jerome Powell. And, these are exactly what we need in order to continue to see GDP grow.
Right, understood. All right, David Trzaskowski, thank you so much. It's great to see you. Glad to have you on today. CEO of Sound Planning Group. Thank you. Coming up, we continue our chat about AI. In fact, it's focused on so many companies and how we can monetize AI with technology. Many companies to talk about. Dan Ives coming up.
Schwab Bank.
Leadings. Joining me right now, Dan Ives, Managing Director, Equity Research at Wedbush Securities. You've talked so much about the tech revolution, all about these tech names, the Magnificent Seven, which now amount to $13 trillion in market cap, as we are now almost at 5,000 on the S&P. So we had a dip, but you were right in the end, noting the upward trajectory. Now, AI is our next real big topic. I mean, it started in 2023. What are you thinking about adopting AI in 2024? Where does it start and continue?
I mean, the revolution's here. And I think if you listen to the Microsoft transcript, the Messi of AI Palantir, monetization's happening. And we see it from our checks every day across cloud, across software. I think now it's really going to chips to software. This is just get the popcorn ready. In our opinion, it continues to be that started in the fall. This new tech bull market's here.
So when you say from cloud to software, so what are we thinking, like from Intel, AMD, NVIDIA to what?
I think to Salesforce.com, to Adobe. Of course, what's happening in Redmond in terms of Microsoft. And then you look at the Messi of AI, Palantir, I think probably the best pure play AI name out there. MongoDB, Snowflake, that's just some examples. And then you look at the cybersecurity piece, names like Varonis, Tenable, Palo Alto, which I continue to view as a table pounder. And we continue to love the godfather of AI, Jensen NVIDIA. But this market, and it goes back to like, you could, with a magnifying glass, focus on a 60 Minutes transcript. Instead, I'm going to focus on tech earnings season, what we're seeing here.
So, I mean, should we not be worried about the economy because AI will solve everything? It will see the growth, we'll see everything moving from point A to point B, and supply chains will work, and, you know, everything that people need, they will get. I mean, should we stop worrying?
I mean, you've talked about this, you know, for many, many years, right? Like, I'm not someone that's going to become hyper-focused on when the Fed's cutting in March or Fed's cutting this year. The soft landing's here, and the bear narrative that, you know, they've continued to use over the last decade, every time they come out of hibernation mode, focus on valuation or spreadsheets. Instead, you know, someone like ourselves, they spend so much time on the road, we see the use cases. This is the biggest tech transformation since the internet, 1995. So my view is that you'll have dips, ebbs and flows, black swan events, whatever it may be. But I think we look out next 12, 18, 24 months, this tech bull cycle continues.
Yeah. You know, Kathy Wood joined on to the Palantir party. ARK got more involved here. ARK hoards 43 million Palantir stock following that big earnings jump. You're talking about Palantir. It's a name you've always liked, but we saw that big gap up after earnings. Also, Kathy Wood noting Tesla and saying once Tesla comes out with this $25,000 vehicle, it is going to be in huge demand. And, you know, I just had a moment ago, had a guest on who said, look, Tesla's down 25%, it's a buy. Do you still like names like Tesla?
Yeah, I mean, look, we have a 315 price target. Obviously, it's been very choppy in terms of post-conference call, and obviously, you know, what we've seen in terms of the Delaware issue, and there's a lot of noise going on, but we've been here before, back against the wall. It's still the second, third inning of the Tesla story playing out. Now, I'm not saying that this is going to be rose and champagne, but we've seen it before, and then they get through it. And you're going to be talking about a company that at one point is going to be doing 3-4 million vehicles per year. And I think Kathy's right. I mean, but when you go through periods like this, all the haters come out, you know, in almost at a central cast.
You were not happy, though. You were not happy with the last earnings call. I mean, you felt that Elon Musk did not come in like an adult and give any sort of clues. Instead, he just gave some big picture vision. So, you know, Elon Musk still needs to bring it, right? I mean, there's concerns about a little bit of everything. His distractions. We know they're looking at maybe more layoffs, even some drug use references that have been popping up, and so on and so forth.
Unique communication. I mean, go back to the tactician, the Hall of Famer. You know, if you look at what happened on, you know, Palantir, you look at Microsoft. That's just some examples of what we've seen.
Tell me about some of the other names. I know that Zscaler, CyberArk, CrowdStrike. Cybersecurity is something that you've always liked a lot. How much potential, when you're saying all these names in AI and how it's, you know, AI is going to software and you have cybersecurity, I mean, could we see 10, 20% gains for these names? All right, we're going to leave it right there. It is always our pleasure speaking with Dan Ives of Wedbush Securities. Thank you, Dan Ives. Still ahead in the second half of our show, standing by the COO of Chipotle. And we'll talk about some of these impressive earnings, the stock surging to all-time highs. A lot to chat about here. In the meantime, we'll also have an outlook on some of the Chinese stocks. Stay with us.
which now hit my support level.
Watch list. I'm Nicole Petalides, live at the New York Stock Exchange. 90 minutes left in the trading day. Everybody's got their eye on S&P 5000. S&P 500 to hit 5,000. Right now it has pulled back some. It's at 49.93, but did hit record intraday highs today, as did the NASDAQ 100. Right now the NASDAQ 100 is up about 1%. The Dow's up 172 points. The Russell is also gaining, and oil and gold are mixed, with gold actually flat. For a market update, Ben Lichtenstein is with us, senior futures contributor, to take a look. Your thoughts? 90 minutes left in this record day.
Yeah, unstoppable, Nicole. I mean, this market is just on a mission right now. The bulls are fully in charge here at this point, and as you made it very clear, we're talking about new all-time highs across the board here in the S&Ps, the NASDAQ. The Dow's not far from it. I did see the SPX, which topped out at just shy of 5,000 here today. The index up to 49.98, Nicole. A solid move up, basically 60 points to the upside, adding on to the move up that we saw off the lows from yesterday. And here you can see on the chart here, no rejection of that upper level. So holding this level kind of reminds me of the rally that we saw, if you remember, into the end of 2021, beginning of 2022 off the pandemic lows. I mean, we basically rallied from 2,100 up to 4,800. Let's take a step away from the SPX and just quickly I want to show you where the futures are, because they actually got through 5,000 today. You can see up to 50.19 in the S&Ps and holding that level at 50.14 right now, currently trading up on the day by 0.75%. Look where we are, holding above last month's highs. I mean, this really speaks to the conviction we've seen just to begin the year. Easily identifiable bottom left to top right here, Nicole. I'm going to show you one more step back here into the daily time frame. And again, just to look at this trajectory. Here's the move off the October lows from last year, and then you can see again the move that we saw off the March lows from last year, 3,800 all the way up and through 5,000. So we're talking about 1,200 points plus in terms of the move up off those lows from last spring. One more step back shows you 3 of the 4 majors here. You've got the S&Ps in the top left corner, the Dow in the top right, the NASDAQ in the bottom left, right up near those all-time highs. And again, as been the trend here, the Russell continues to be a bit of an outlier here. It's in the bottom right corner. Small caps still aren't willing to participate.
So we will leave that there. The small caps are not willing to participate, and we've had guests come on and say, look, I'm going with what's working. I'm sticking with tech. Even though they feel that small caps have potential, sometimes they're not really, because they're just not participating now at the moment. You're also watching crude and the EIA report also.
Yeah, speaking of not participating, right, crude's been somewhat sideways, which I think has been, well, helping stocks. As is the case with yields, hanging out just around this 4% level, right? Crude oil has found comfort right around 74, 73, and that seems to be the case here throughout the day today as well. Take a look, kind of a range-bound trade, even after a larger than expected build from the EIA at 5.5 million barrels. We had a small build from the API yesterday, but we actually saw gasoline draws, distillate draws across the board, just over 3 million barrels. Let's take a step away from the crude contract here on this 5-minute time frame. I want to show you what's going on. Take a look at the move lower that we've seen from 95 all the way recently down.
Right now we're about even. It's got to make up its mind. I mean, we're definitely at a solid support. We could automatically just go straight back up, or I'm thinking about getting out. Then when I do, we come down here.
well.
All right. Thank you so much. Good to see you, Ben Lichtenstein. Appreciate it. Is anybody taking a look at Chipotle? So impressive.
Might break
Blowout numbers, the earnings, the stock moves to a new high. The Chief Operating Officer of Chipotle, Scott Boatwright, joining me now. Thank you so much for being here. Welcome back to the show. What a quarter. Pretty incredible. And visitation growth, from what I understand, has been very consistent. What's going right at Chipotle, and can it continue in 2024?
Hi, Nicole, and thank you for having us on. Yeah, we had an extraordinary quarter, which really rounded out what we believe was an impressive year in total. You know, we have this simple strategy of staying disciplined, running great restaurants, and doing that with leading culture. And we had so much momentum this past year, really leaning into our people at every level in the organization, focused on their development to really push our growth to new heights, and as well as developing talent for future growth. And then leading into great culinary this year. We began to hit the gas pedal as it relates to throughput in Q4, and we saw some outsized results as it relates to transactions, coupled with what we believe to be our best version of carne asada we've ran to date.
So at this point,
It's got some pretty good mustard right now. It's kind of like a shoulder line. There's your head and your left shoulder, left, right, right, right. And that time we broke past it, so I wouldn't be surprised if we run up.
Groups, regardless of age or income cohort. And so we feel like we're doing a great job leveraging our digital ecosystem as well as our loyalty platform with now, gosh, I think 38 million members. And so it's exciting to watch the fandom continue to grow for this great brand. Our challenge as an organization is to continue to execute at an extraordinarily high level. And that's all done through great people at all levels in the organization and continuing to lean into innovation to drive efficiencies at the restaurant level to help support our teams in what they're trying to accomplish daily by delivering an exceptional guest experience to every customer that comes in the door.
you plan to open 285 and 315 restaurants, right? You still on track for that? And are any of them near the Middle East? Because we've heard from McDonald's, we've heard from Taco Bell and KFC, the Middle East has been problematic.
Yes, so our goal for the upcoming year is 285 to 315 new restaurants in the system. You know, we opened 121 new restaurants in Q4 alone, which really shows our capability as an organization to hit aggressive growth targets today and in the future. We did partner with Al Shaya Group in the Middle East and are excited about that partnership, although we're in the early stages today. We will open a new restaurant in both Kuwait and Dubai in the upcoming year, or this year, I'm sorry. And so we're excited about that partnership. Al Shaya has numerous American brands that they have brought to the Middle East over the last several years. And I'm sure they'll let us know if anything comes up as it relates to the conflict in the Middle East. We're excited about the partnership and look forward to growth in the market.
Yeah. Should people be worried about that exposure? Why should they not worry about that exposure for you?
You know, I don't think so today. We're in the early stages here with Al Shaya. We're excited about the partnership. We are on pace to get the 2 restaurants open I just talked about in both Kuwait and Dubai. And so we'll see where our stage gate process really unfolds and where it takes us for this year. But we think there's a sizable opportunity in the Middle East with Al Shaya and looking forward to the partnership.
Yeah. Look, I see some price targets getting way up there. UBS has a $2,900 price target. You know, so people still raising their price targets as the stock hits all-time highs. No stock split needed. Is that because you just have a lot of institutional traders, or what is it about it? Because when the stock gets up to 2,700, do people ask you about a stock split?
It's so funny, Nicole. It's our most common question. And so today we have a lot of institutional investors in the brand. We feel good about their long-term hold strategy for the organization, which obviously reduces volatility. I can't say we'll never split the stock. As it sits today, we feel comfortable where we are and feel good about the trajectory overall.
Tell me about the Super Bowl. Do you have an ad in the Super Bowl?
No ad this year, unfortunately. Our last ad was "Can a Burrito Change the World?" which ran, I guess, 2 years ago now. Super exciting commercial. We felt really good about the message it delivered and conveyed around our idea of food with integrity and this whole purpose of cultivating a better world. Not this year. That's not to say we won't be in Super Bowl ads in coming years. So we'll see.
Yeah. You know, when I think about the advertisement space and a lot of people getting familiar faces or famous faces, I mean, I do think about the Chipotle ads, and I think about the noise, the sound, that's the fresh, you know, cooking and the fresh ingredients and what it's like to work at Chipotle. I mean, I think that the marketing has worked. You know, how much is spent on ads? Do you expect to have to increase that for marketing? Or, you know, why did you skip the Super Bowl 2 years in a row when you have the biggest demographic, so many eyes? Why do you skip something like that?
You know, we didn't see it as a strategic opportunity this year. We have no plans to cut back on spending, and as a matter of fact, the ad budget continues to grow each year. And we're looking at different venues to invest in and ensure we reach our core consumer, again, in all age groups, and then ensure that our plan is hitting our targets, again, around making the brand more visible, more relevant, and loved. So I can see where you would say Chipotle should be in the Super Bowl. It makes perfect sense. Not to say it's off strategy, but this year we took a look at some different options.
Yeah, understood. When we think about, you know, the carne and all the other things that you have, like so many cool things that come and go, sometimes it's good to make a specialty dish to get some talk. And what are you excited about for Chipotle when it comes to the food and getting it out there? I mean, everybody loves guacamole on the side. I think avocado prices may have come down as well.
We've seen some normalization in avocado prices, which has certainly helped our cost of goods this past year. I'm sure we won't, that experience won't last forever, and the avocado prices will move higher in the upcoming year. As it relates to overall product offerings, Nicole, we will continue to do 1 or 2 limited time offers this year and in subsequent years. This year, we're taking a different look at our core menu and really promoting products that we've had that we think have been hiding in plain sight. One example of that is our barbacoa product, and many consumers today don't know that it's braised beef, and so we're going to lean into a campaign here in the next week or so around this idea of braised beef barbacoa, which we think is a big unlock for us, because we love the product. We think it's a high quality product that consumers will love if we can just get them to try it.
Yeah. Look, you know, in my house, Chipotle is home cooking. I've had 2 boys who can walk down the block. We live in New York City, and they get Chipotle, and to me, that's my home cooking for them. So we love Chipotle as a family. You've had others that have sort of liked the idea, like Cava is sort of Mediterranean-ish. It's similar but different, and you can tell me how different it is. They also have fish. You have no fish. Do you ever plan on getting into fish? Because McDonald's has filet of fish. Cava had some salmon, I think. Do you need to have fish there?
It's a big idea, Nicole. Unfortunately, we don't have freezers in our restaurants, and so trying to produce a fish offering at scale with 3,400 plus restaurants is just not feasible. You've got to have access to a cold chain that also includes freezer space, and that's just not part of our food offering today. So we're trying to unlock ideas there. I don't know that it'll happen anytime soon. We think Cava is a unique offering, although very different from Chipotle. We love what we do in-house, and hopefully your boys recognize that we leverage classic culinary and cooking techniques in our restaurants every morning with pots, pans, knives, cutting boards, and stovetops. I think that's what makes us unique, and it's what makes us special, and why consumers love us. We know fresh just tastes better.
It does, and it's great, and we love it. Maybe I should open my own franchise. Scott Boatwright, thank you so much. Wonderful to see you. Thank you. So. Operating officer of Chipotle. Still ahead, Alibaba earnings. Well, they fell short of expectations. Take a close look at some of these Chinese stocks next.
Baba. Well, there's the breakout on the SPX with the double top coming.
Alibaba is at $73. Do you say to yourself, this could be an opportunity, or you wouldn't touch it?
It could be an opportunity, but the truth is that the competitive landscape that Alibaba is looking at is incredibly fierce, and they're undergoing some idiosyncratic problems where they actually are attempting to spin off some of their non-core businesses, and that has proven to be more difficult than expected, largely because of all of the turmoil in Chinese equities overall, or the equity markets, and further compounded by events like the head of the securities regulator getting abruptly fired this morning. So it's a tough environment, to say the least.
Yeah, I mean, to your point, in fact, Alibaba's not rushing IPO of units given the challenging market conditions. Do you think this would help a lot, Cyrus, if you thought if they actually could do these IPO of these units?
I think it would help to a significant degree, because they could then focus on expanding and competing in their core segments, their core businesses, as opposed to kind of having their focus split among kind of 6 different segments at the same time. They just lost their CEO pretty recently, and the market is waiting for them to do this. But there's a general lack of guidance from the government or support really for the markets, and that is creating a lot of uncertainty and choppiness, which I think will prevent them from being able to take a lot of these moves for some time.
Yeah, putting billions of dollars into buyback programs, Anthony, trying to show their confidence in the company. Cyrus just mentioned losing the CEO. Where do you stand on Baba these days?
Right.
Alibaba has been going through restructuring for the past few years, and that's not a secret. And also because of the regulations, kind of opened up the field for other e-commerce companies to kind of take some of their market share and also be able to expand at a faster rate at their expense. And it's a good point that we don't that they haven't had any clear direction on where they're going with the splits. Especially now they're talking about not doing the cloud into an IPO and then delaying. So investors are kind of waiting for more confirmation on what the plan is. But Alibaba is one of the major e-commerce companies in China, the biggest, most GMV, very low valuation. It's at some point, it's when things are figured out, you think you're going to see a good move in that stock. But we also like the whole sector, Nicole, right? So Pinduoduo is doing better, Kuaishou doing better, Douyin, these guys are doing a lot better, benefiting from some of the woes for Alibaba. That's why we like to have a basket approach to that industry, because in different years you have different companies, having the upper hand, and KWeb can actually give you exposure to the whole pie.
Right, KWeb, you're more the ETF. You have specific names like Pinduoduo and Tencent and such. Just quickly, Anthony, I mean, when you think about this, the Singles Day shows that Chinese folks want to shop and they do well on something like that. We've had the backing of the banks and regulators there. Sometimes they can give a boost to these companies, but sometimes they give it and sometimes they take it away. We've seen real estate, for example, getting hit so hard. Do you like the whole group, Anthony, just very quickly, or is it just better to do the KWeb? I mean, do you have one name that stands out to you as the winner in the group?
It's for now it's Pinduoduo. Next year you don't know who. We like KWeb, but in China in general now, Nicole, is very cheap, very low positioning, and the government is still trying to deal with the issues that stemmed from COVID and lockdowns and regulations, which are hitting the consumer. That's the key today, Nicole. I think in China, the government, when they revive the consumer, the growth train will be back on track, and I think we're going to start seeing investors coming back to China.
Yeah. And Cyrus, I will say, sometimes we have guests who come on and say, look, I like emerging markets. I like Asia, ex-China. Because there is sometimes risk that goes with China, but there's also growth that could go with China. I mean, China was always an area of growth, though it hasn't been as much lately. Tell me about your final thought on the big picture and what names you think might do better than others.
I think what was just said was quite accurate. I think taking a basket approach is likely the best way to tread in that area now, because it's so hard to tell who is going to be kind of the lead dog in the race from year to year. Really, what I'm looking at in terms of the bigger picture overall is to really see some of that clarity coming from the government and from regulators to show investors and to show the market that they have faith or that they're willing to support a clearer path going forward.
What time is it? We've got 4 minutes to power hour. We've got a double top on the SPX. It's going to go to 5,000. Double top on AMD. Look at the RSI here on. Oh, it's on the minute, so I don't know if that'd be. Put it on a daily. Some got price target. Barclays has 2,400 for CMG. Chipotle. Cohen maintains a $2,900 price target. KeyBank says 2,750. Oh, Citigroup maintains a buy. Raises price target to 3,016. Wedbush, which $2,400. Then we got UBS at 2,900, maintains a buy rating. Then we got BMO at 24. Raymond James at 28. KeyBank at 27.50. Barclays at 24. Oh, who's this at 20? Oh, we got a brave one here. Stevens adjusts the price target to 3,000. Evercore says 2,900. Beard says 28.50. Gordon Haskett says 28. Piper Sandler 24.42. Uh-oh. Uh-oh. Who's this Piper Sandler? I like 24.42. Too bad they should have added the cents. It's 16 cents. I like that one. Oppenheimer says 28.25. Washboardjim from Retail Traders raises the price target from 1,800 to 2,400. Nope. To 2346.22. Might change that. $23.40.79. Overbought. I put a sell rating on it. CMG. Well, well, well. Okay.
Friend, don't fight it unless there is some outside force that will stop this train, and right now it's not really obvious what that would be. A little bit of chop in the bond market from the last week, a little bit of volatility, a little bit of tension between bonds and Powell, but no real action there. A little drop in bonds today, nothing. TLT down 30 bips, no big deal. Crude oil still in the low 70s. Other commodity prices, everything outside cocoa is pretty close to the lows. So there's no threatening inflationary indications from the commodity basket. Look at the chip chart. It's just blasting off. It had a little bit of a lull there for a week or so, and now we're right back with a big green candle today, trying to break out. It's almost good to see those pauses. That's why the whole buy the dip mentality works, because it presents opportunity and for the trade to refresh. And so the momentum picks back up. And going through an old resistance with momentum is usually a good thing. So probably want to see a little follow through tomorrow for the SMH, but back at highs is good. There's a lot of it coming from the cybersecurity trade today. The best performing theme or sector is the cybersecurity fund, Hack. A few earnings behind it. We even saw kind of a laggard in Fortinet bounce on earnings. Mixed earnings for sure, but the market is giving them some leash, because that's what happens when you have tech leading and a sector that has been so reliable, you start to pick up some of the laggards a little bit, give them a little bit more room, give them a little bit more appreciation. Looking over the past year, a few of the big leaders in cyber continue to lead. Palantir, day 2, there's the breakout. We called that report, I believe, a bear breaker here yesterday. And I think that was a good description because there were some bears hanging out in Palantir, some Peter Thiel haters, and they're paying up for that cynicism around the cyber companies' government contracts over the last 48 hours because bears are getting shredded in Palantir. Big breakout for a stock that so many have had a long time hopes for, but had been kind of stuck. And then the early leader of the group, Palo Alto, over the past year, just keeps making new higher highs. And so this trade moves on. Do you need AI to augment this sector? Probably not so much. We already know how painful some of the big corporate hacks have been over the year and tons of increased security needed from these companies. So there's real secular power, there's real meaningful theme behind what's happening in tech. This is not a valuation-driven rally. Valuations moved up a lot? Yes, they have. But they're still below where they were in COVID. A lot of this is coming from an expectation of earnings shifting into a higher gear after a bit of a slow year for the trailing numbers and some of the semiconductor hardware, but also for some of these cloud companies too that were dealing with a little bit of a post-COVID hangover from so much demand. So there's a lot of thematic earnings support for the tech trade. Look at the crude chart real fast, and again, you just don't really see any pressure on the inflation story from the commodities basket. Now, we did see a few prints the last week. Of course, employment on Friday, wages warming up, all the ISM data looking strong, the prices paid from all the ISMs going higher. But the market definitely likes to watch crude as a kind of obvious, in-your-face inflationary type of indicator. And when you get rallies and crude rejected as hard as the one was last month, then you gain confidence on the disinflation trend. We don't really have a lot of data this week either. The Fed speakers continue to generally rally, seem to be linked to the regional banks. New York Community Bank popping back might help a little bit to relieve some of those fears. But overall, it's a very supportive environment for the bulls still. So let's zoom in on something that breaks my mind. I think I understand this pretty well. The stuff that breaks my mind is the sports streaming entertainment business, Kevin Hanks and Jenny Horn, because all the action today is in all the streamers. It's like the only group that's really got something negative, I guess. I don't know, it seemed like this wasn't the worst story, that they're kind of like throwing up their arms and saying, all right, we need to work together again a little bit. Maybe kind of like the old cable days, maybe a little bit different. But all these stocks are getting hammered, Jenny, on this deal that they're going to start sharing sports rights. So take us through it.
I think because there's still a lot of questions, because we don't know how much it'll officially cost. I've seen estimates between like $35 to $40, but actually what's interesting about that, if you added the distribution fees for all of them, it would suggest like ABC, Fox, and ESPN, it would suggest it would carry a retail price of around $50 a month. So that puts it below YouTube TV, which is the way a lot of people watch sports, but is then more than like a traditional streaming platform. But the three media companies, being Disney's ESPN, Warner Brothers Discovery, and Fox, could control around 65 to 85% of the U.S. sports world. Based on estimates, I've seen low end around 60, high end around 85. So that's also right now fairly up for debate.
We have?
Disney will still own about 1/3 of the new joint venture and will operate about 100% of its sports rights.
Damn.
The platform has no name right now, but it'll include ESPN, ESPN2, ACCN, ESPN News, ABC, Fox, and BTN, TNT, TBS. To name the biggest ones. There's a few more, but those are the big ones.
This is why I can't do this.
I know.
It's too much to remember.
You can still bundle this option though with ESPN and then Disney Plus and Hulu. That's available through Disney, of course. But what I think is the most important from like a sports viewership standpoint is what it doesn't include. So it doesn't include Paramount CBS, it doesn't include Comcast NBC, and it doesn't include like Thursday Night Football, which is available through Prime, Amazon, of course. So if you're, say, a really big NFL fan like I am, for example, the new service would only give you a portion of the games you want to see. You still couldn't see football on Thursdays, and you also could miss the Sunday Ticket, which Paramount Plus does have access to CBS.
Paramount Plus has got Sunday Ticket. Amazon's got Monday Night Football.
And Thursday Night Football.
Right. And
I'll
then,
just have my children sign me up.
yeah,
and
of
figure
course,
it out.
Paramount's got the Super Bowl. Why is Paramount down 8% on this when they got the Super Bowl? I mean, isn't that like the one you want?
YouTube has the night ticket, but CBS has Sunday afternoon games, and NBC's Peacock has Sunday night football. See, they're all different things.
So how
I
come,
misspoke.
Okay, yeah. Well, but like, how come Paramount's down 8%? Even Fox, that's like in the middle of this deal, is down 6.5%.
Because the entity they're going to make is less than the sum of the parts.
Okay.
So all the parts
so they're
have to
all
come
having
down.
to give up a little bit.
Exactly.
Okay, I get that. So they're saying
Exactly.
like, hey, instead of all warring with each other,
and
let's
working towards zero,
Yeah.
let's all keep as much of the pie as we can, but that net number is going to probably be lower.
And the low-hanging like joke here, which generally I get, and I appreciate the kind of cynicism as we're like
WBD.
rebundling, going back to cable days. That's not really what this is, right? I mean, yeah, there's going to be a place now that they're going to build where you can get all your sports, but it still is sports, and they all are going to have their own still separate entities for streaming all their other content.
To me, it adds a frustrating aspect from like a consumer standpoint
Oh, it
because
already is.
I mean, like we're sitting here, like it's difficult for even me, and I'm familiar with all of these various like games and it's confusing for me. What about someone that's say middle, older age that isn't as familiar with the streaming world? I mean, this
Kid
is
just
really
said his kids are going to sign him up.
I have young adults living with me that they'll navigate this thing in seconds.
They're going to export it to the
Me?
YA category.
I don't have I don't want to know. I don't
Right.
have the bandwidth
It's like too
to
much-
take in all
Me
this.
neither. That's part of the reason why I stopped watching sports.
But here's
to be
the
honest.
thing. How do we connect the dots to what's going on with Disney today?
Okay, yeah,
right?
tell me, because we got earnings this
So
afternoon.
connect it, right, here it is. Disney had to do something, right? Because they are hemorrhaging money in streaming. So here's what picture Michael Jordan with a broken leg.
Yeah.
That's Disney.
Okay.
Right?
Doesn't he still play though and win?
no.
Oh, good Lord.
I can't even tell you're joking.
Lord, stop. Just hold on. Pass it over for me for 1 second. Michael Jordan with a broken leg means Disney has so many other parts of their business doing well, and this is dragging them down.
Got it.
So they need to get this fixed so the rest of the company can flourish.
Right.
Right? So they had to get something. They had to apply a tourniquet to this part of their business.
Yeah, no, that's a really good point because ESPN has been sort of like this really kind of albatross hanging over, despite having so much like IP and access and notoriety and brand quality. It hasn't made financial sense for them for a long time.
There was a time when ESPN was more than 50% of Disney's income. More. Now it's a small fraction as it's the blooms come off that rose a bit and other things have changed, but there was a time we used to report on the network about this where ESPN was a massive part of Disney's revenue.
I know, it's been kind of interesting to watch the fallout of that. Now, I will say last quarter, their direct-to-consumer losses improved, so we have seen some degree of a recovery, but if we don't see a major impact from their password sharing crackdowns, then I'm simply confused because Netflix that has been like really their gold mine. So Disney's tried to copy. If that doesn't work for Disney, I'm not sure what's going to work. But it's like we don't even talk about their most lucrative aspect of their business being parks and like merchandising. I mean, like Disney is so much more than just a streamer. All the street cares about is all things Disney Plus and everything that comes with it.
3 new ships in the next 5 years coming through cruises.
Yes,
3 new ships.
We hardly even talk about that.
$60 billion in CapEx over the next 10 years for Disney.
I know.
They're all in. Their parks,
Market's hated that.
like Folio's data on Fast Market today, the parks are 34% up in views. They're going crazy, and Disney still can't catch a bid because of streaming.
Well, we're off the lows we were last quarter,
Yes,
so we'll
we were.
see how tonight goes.
Yeah.
And I will say, out of all these companies today, Disney's actually doing the best.
It opened down hard and then rallied all the way back up. Right.
Yeah, not the case for the others, which are getting blasted. All right, I mean, Paramount down 8% despite Super Bowl. Fox, despite being in this, down 6.5%. Absolute bloodbath in these companies.
Disney gonna go to 100.
It does kind of bring up the notion of just how convoluted it all still is, which can't be good for these companies.
Streaming is a mess. Take out streaming, put in AI over the next couple years.
Yeah, let the bots run it.
Simplify it. I'd say simplify it as much as you can. Right now, it is way too confusing.
We're definitely going to have to use the chat bots to figure out where to watch stuff, for sure. All right, that's a pretty good use of it, actually. Thanks, Jenny Horn and Kevin Hanks, for helping me with that big story. let's get back to some of the macro conversation with John Carter. He's the president and COO at Nationwide Financial. John, of course,
Are they
going to
take it to 5,000?
Group of retirees as a focus, and you guys have done a recent survey about those approaching retirement. So give us kind of the backdrop here of what you're seeing in your client base and their needs.
Absolutely, Oliver, and thanks a lot for having me today. I mean, I love the conversation earlier, but now we have to take a deep breath. We have a lot of movement in the market, and we're going to talk about retirement. Okay, so we're just going to, everything's fine. We're going to talk about retirement. Nationwide Retirement Institute did survey 1,000 pre-retirees and retirees. So what we wanted to get was like their attitudes in retirement, and then also those that are on the way to retirement. And we found out some really interesting things, and I think it's really timely now because from a timing standpoint, we have more than 12,000 people a day turning 65 this year. We call it peak retirement. It's the most it's ever been. So we need to start talking about retirement with some urgency and maybe some of the excitement that Kevin had.
Yeah.
But when you look at the gaps that we found, I think this is what could be interesting for many tuning in today. One is that there was an unrealistic estimate about basic living expenses. Those in retirement said about 42% of what they thought they would spend. They actually spent 53% on basic expenses. The other was the lower retirement security than they anticipated. 77% of pre-retirees today believe they have what they need to be comfortable. But those that we surveyed, only 68% said, in fact, they were comfortable. So we have a lot going on there when you think of just the handling inflation and expenses. But there's something else that's interesting too. 64% of those that are retired in the survey stopped working earlier than they planned. The average was age 60 versus if you talk to those that are pre-retirement right now, a lot of those ages are like 67. And I think that's where, you start to get to some gaps where people start to feel less confident. Finally, I'll say that 36% of the survey said that they received less in Social Security than they expected.
Wow.
So those are the ones in retirement. But we also asked them about advice to their younger selves as well. And I'll pause for a minute just to see if you have any questions.
I do want to get to that, John. So what, in the meantime, for these gaps, what do you see as the most frequent solution? Are folks re-entering the workforce? Are they feeling like they need to recover lost ground by being in more speculative short-term investments to try and close the gap? Or what then is the answer?
Kind of all of the above. Actually, those that looked at what they could do or the implications, some actually said that they're going to return or considering returning to work from retirement because they fear running out of money. And some have just said, I've run out of money for my current expenses. So there's a lot that's happening there that I think, really causes a reason for a call to action. And again, I think that there's some
another
great
call to
advice
action
that those retirees gave and those that responded that I think we could all benefit from. Not only if we're almost to retirement, but I have 3 adult kids. I mean, they don't live in my home like Kevin's do, but they are young adults. And the advice that they would give their younger selves. So I would say, okay, if you're about to retire, this is something you want to listen to. Or if you have younger people in your house or in your family, this is advice that everybody can pay attention to. One is clearly we're going to expect and need more money than you think, even if you've done everything right in planning for retirement. The second is don't assume that you can necessarily work as long as you expected. Those that were in retirement thought that they'd work to age 67. The reality is that they worked until age 60. There's a lot of reasons why, but that's something, again, to play into your planning. Start saving early and planning early. I think, if you know anybody under 30 years old, those are people that need to start saving for retirement, even though the things you talked about on the segment before is a lot more fun to talk about. boy, you can do yourself a lot of good by saving early. The other was, I think this was pretty fascinating too, that working with a financial professional clearly was something that those in retirement, in successful retirement, said that was one of the keys to that. Maxing out everything that you can max out and anything that can grow tax deferred. And I'm talking your 401k, 457, your health savings plan, your IRA, your Roth IRA, anything that can.
Come from 11 cents hitting 5,000. That's big.
But what's happening now, and I think that this is something not only with 12,000 people turning 65 every day, but the success.
But at a small, I said going in, I don't trust this thing. I should have listened to my own instinct. They announced layoffs the day before earnings, and I wrote that down in my little book as red flags from now on. If you need to do that announcement, any day but the day before earnings would probably be a better sign. If you're already doing that preemptively, you probably don't have a lot good to say on the actual report. So I did not heed my own mistrust of these people, and they did not let us down.
A couple other stocks I want to hit with you. Uber is your largest position.
Yes.
This is traded very interestingly today. Wouldn't pay much attention to a one-day post-earnings move in a name like this because the many-day pre-earnings pop was so considerable, correct?
Yes, the stock is 47% above its 200-day moving average. There were not a lot of those. It's 14% above its own 50-day moving average. But earnings per share growth this year for Uber is expected by Wall Street to be 27%, 75% next year. And that's what's led to the rally in this name. It's one of the best performing names of the year. It's not even, from my perspective, it's early innings in the story of Uber. And I'm not a trader here. I'm a longer term investor. So I don't know if the next 5 points is up or down, but I'll be there.
You're watching PayPal too, which, by the way, reports in overtime. This company's been through a lot, to say the least, over the last 6+ months. You were recently in the name.
Yeah.
You got out. You were fed up. You didn't like the investor day or whatever the recent event was where the stock went down as the CEO laid out some new plans there. We learned in the last 24 hours or so that Brad Gerstner's altimeter is now in this name. They sent sort of a missive out yesterday, if you will, on social media, rather critical of what the company has done of late. And Brad has confirmed today that they're in the name. Why are you watching this closely today?
I want this to work. So I'm not in the stock, and I had been in it recently. But I want it to go up. I'm not rooting against the turnaround. I just don't feel confident, at least right now. We'll see what the earnings are and how they're received. But I really don't like the way the CEO, the new CEO, who has never been the CEO of a public company before, set a trap for himself and then put his own foot in it. So as a rule of thumb, you do not want to come out and say, we're going to rock your world this year. I know he didn't mean this one announcement. I got that. Just don't say that at all. Just do it. Just come out with the actual news. don't set the table first, because the expectations are always going to be too high, especially with technology companies. So that didn't seem savvy. They announced a 9% workforce reduction, which I guess makes sense. Everyone else is doing it. Why not? Earnings are expected to come in at $1.18, $7.8 billion in sales. I think that's all beside the point. They need to set the tone for what this year is going to look like, product launches that they have coming, and whether or not this company can return to organic growth. It's a huge question. Most people don't think they can. They're growing revenue right now at a 7% CAGR. It's a $65 billion market cap. I don't think it's worth $65 billion if a 7% growth rate is going to be the standard going forward.
Okay, so because we're on the doorstep of S&P 5000, I'm going to ask you to hang out with us. I know we're supposed to leave, but the Sadel's you had for lunch is going to power you through the next.
I feel like I can make it
35 minutes or so. So Josh Brown's going to stay with us. Let me send it to Christina Partsinevelos now for a look at the biggest movers as we head into this close and we keep our eye on the S&P. Christina.
Well, I want to talk about Roblox because it just keeps losing money. Sales, though, are still jumping for the video game company. Revenue was up 30% year over year, as well as average daily active users. And why was that? It was driven by traffic specifically from Meta's Quest headset, as well as Sony's PlayStation console. The company's still warning that they expect net losses to continue for the next several quarters at least, but that still hasn't stopped shares from soaring about 12%. Roblox's CEO will be on CNBC tomorrow at 8:40 a.m. Eastern. And then we have shares of global footwear firm VF Corp moving in the complete opposite direction, down about 10%, a miss on the top and bottom line, a CFO who's stepping down, and a turnaround plan that has yet to prove beneficial. VF Corp CEO even calling the quarter disappointing. Shares down 10%. Scott?
All right, Christina, thanks so much. Christina Partsinevelos. We'll see you again shortly, I'm sure. We're just getting started here on Closing Bell. Up next, we get the PIMCO playbook from Erin Brown. She flags where she's seeing some big buying opportunities right now. She joins us after this break, and we continue to watch the S&P 500 closing in on 5,000 for the first time ever. We're live from the New York Stock Exchange. You're watching Closing Bell on CNBC.
Trying to figure out how to recognize a bubble.
grocery store.
We're in rally mode today on Wall Street. The S&P closing in on 5,000 for the first time ever. My next guest says now is the time to add equity risk and is betting on the U.S. to outperform globally this year. PIMCO's Aaron Brown joins us now. Welcome back. What a day to have you. What do you make of what we're witnessing here?
So I think this is really just a continuation of the very strong economic data that we continue to get in the U.S., which is surpassing expectations. I mean, there were a lot of calls that have been calling for a slowdown, and what we're seeing is the consumer continues to deliver, financial conditions continue to ease, and growth is really good in the U.S. right now. And I think that the strength that you're seeing, particularly in U.S. large caps, is really on the back of that. You know, we're almost at 5,000. We're going to probably reach it today on the S&P 500. Next target that I'm looking at is breaking through that 16,000 on the NASDAQ. We're still 2% below the all-time highs on the NASDAQ, which to me is really the next, the next move to go through.
The thing that, really gets my attention today, I think from you, is the urging people to buy stocks, that it's okay to buy stocks at these levels. Back that up.
Yeah, so I mean, valuation is usually called into question, but when you disaggregate the S&P 500 from the Mag 7, the rest of the S&P 500, valuations are actually pretty reasonable, and growth estimates are also pretty reasonable given, the still healthy economic backdrop. What we're hearing from corporates is that they're seeing margins expand as inflation continues to move lower, demand is still strong, and they're able to cut costs, because of efficiencies that they're driving productivity through AI and technology. So all of this is a pretty robust environment for earnings bottom line, and I think companies are going to be able to deliver this year.
Do we care about concentration too much so? You talk about earnings. Yes, the mega caps are the ones delivering. The others, not so much. Is that picture going to improve?
Well, we've had some pretty good runners today. Today's volume, PLTR with 231 million. And I've got an extension on the monthly time frame with this. It kind of sums up resistance pretty much. Where are you? 15-year monthly. Resistance, 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 resistance. All of them are resistances but one. 2640, that breaks. Man, you could get real on fire, go to 35 for PLTR. Tesla's got the next in volume, 101 million. I wonder what that says on the monthly. That's kind of interesting. Sitting right at the 63 right now, and we bounced off that once before. These are on the monthly. We've got the SPY on the monthly. Boom! It'd have to correct itself. It'd have to pull back to 75. We'll try to get it real close. Not close enough, but right there. And where's there? 479.50. That's $20 down. Baba. Man, that thing's so cheap. If I had money to spare, I'd just throw it in there. God, NVIDIA. I mean, 500 is where it needs to be. Yuck. If I ever got to 170, Apple would be a good buy. 170. But that'd be a hard one. It's holding another 9 up right now. And we're getting close to a double top on Amazon. They reject the bill good. Where was I? The full V is complete on SMCI.
CNBC.
Welcome back to Closing Bell. The S&P 500 closing in on 5,000. For more, let's bring in Ed Yardeni of Yardeni Research. Ed, it's so good to talk to you. Your thoughts as we close in on history.
Well, yeah, I mean, happy days are here again, as they said in the 1920s. This is the 2020s, and my roaring 2020 scenario is almost on steroids here. I've been, last year I was talking about 4,600. By the end of last year, we got there by July. This year I've been talking about 5,400, and here by the end of this year, and we're already at 5,000. So it's been phenomenal.
Yeah, I mean, it didn't end very well when you talk about the 1920s, did it?
No, but
there are some who suggesting that it's. I'm sorry, there are some who suggest. I'm sorry to talk over you, Ed.
Yeah, go ahead.
I was going to say there are some who are suggesting that we're repeating one of these type periods here, that there's just too much euphoria, thinking that it's just going to go on forever in a very small number of names.
Well, I agree with what Aaron and Josh were pointing out. I would add that the productivity numbers have been awesome. I've been expecting the productivity growth boom this decade, and I think it's already started. It started last year. We had much better than expected productivity numbers during the last 3 quarters of last year. Productivity was up 2.7%, and that's like fairy dust. Productivity allows the economy to grow faster, keeps inflation down, allows wages to rise faster than prices, and it's great for profit margins and profits.
But you're the one who used the word euphoria in recent notes, not necessarily suggesting that it was here today, but that the early signs of it were starting to be present. Can you explain?
Well, it's really more exuberance, and the question is it rational or irrational? I was saying that the alternatives to the roaring 2020s is something like the 1990s, where we get irrational exuberance and things move too quickly. And there are similarities in what we're seeing here in terms of the concentration in tech. But remember, back in the late 1990s, a lot of tech really didn't have earnings. And not only that, but a lot of tech was rigging their sales with seller financing. It's particularly in the telecommunications area. This time around, the earnings are real. These companies that are doing well don't depend very much on debt. And they've got what it takes to deliver for investors.
Hey, Ed, it's Josh. Good to see you. I was going to say, there are a lot of signs that we're not at euphoria, at least not yet. For starters, Americans put $1 trillion into money market funds last year.
Correct.
Most of that, if not none of that, has come out yet. That's not euphoria. How many IPOs did we have last year? 4?
Yeah,
7? I feel like I can count them. That's not quite euphoria. No IPOs this year yet either,
Right.
speaking of. Those are two of the things just off the top of my head that you would say would be very inconsistent with this idea that it's 1999. And to your point, I was around, Michael Santoli was around. We saw the types of deals that were coming out.
Right.
Forget about earnings. They didn't have revenues. They
Exactly.
were worse than the 2021 SPAC vintage. So
recall.
this is not that. Is, you know,
That's right.
we might get there if this keeps up. We haven't gotten there yet.
I think it's rational exuberance so far. And I think it's justified by the performance of the economy. And by the way, on a global basis, we really stand out. China's in a recession. Europe is in a recession. You know, the world isn't looking too good. Meanwhile, we're doing remarkably well. Inflation's come down without a recession here because China's had the recession. So all in all, the U.S. Is benefiting from a lot of the developments on a global basis. And even though the geopolitical situation is just downright awful, we haven't seen its impact so far on the price of oil. If we suddenly see the price of oil going up, ask me to come on again, and I'll be concerned about the 1970s all over again.
What if we're doing too well, though? And that prohibits the Fed from cutting rates when the market wants, because you've got the labor market still too strong and GDP prints that are going to shock people.
Well, I have no problem at all with the unemployment rate remaining below 4%. I know some Fed officials previously said that they'd like to see the unemployment rate above 4% in order to bring inflation down, but much to their surprise, not to mine, quite honestly, we've been able to see inflation coming down without unemployment going up. And that's because productivity is making a comeback. Look, I have not been in the camp that has been rooting for or expecting that the Fed's going to give us 5, 6, 7 rate cuts this year, because I've not been in the recession camp. I have been in the disinflation camp, but I think interest rates have normalized. They're back to where they should be. I don't really think we need to cut rates. The economy's doing just fine.
It sure is. I've got Mike Santoli with us here at the desk as well as we watch this market elevate into the close here. Rational exuberance, the words that you just heard Ed Yardeni use. Look, you've seen a lot of markets and analyzed them over the years too.
Look, it's anchored in real things, which is we have this winner-take-most economy that disproportionately is benefiting a relatively small number of these massive platforms that now are the biggest market cap companies in the world. I do think that the 1999 comparison, not only does it not really hold up across the board, as I was saying earlier, but it's also a bit of a red herring, because the overwhelming odds are we never get there in exactly that way again. And so just because you're saying, guess what, it's not a bubble like 1999. All that means is, as I said earlier, the market's not going to be cut in half in 2 years, and the Nasdaq's not going down 75%, because that's what came next. So saying it's not 99 doesn't mean we're perfectly set up for great returns going forward, right? So you have to just understand what we're arguing about here. The trailing 3-year S&P 500 total return annualized 10%. Nice, not excessive. 5-year, 15% annualized. Pretty good. Market doesn't owe you anything, but it's been better. And it does usually take these big bites of upside and then sort of figure it out after the case. So I think a lot of the same stuff can be true at the same time, which is, yeah, people sure do love that NVIDIA. They keep discounting the exact same good news every single day. And as I said yesterday, it trades 5, 6, 7 times the dollar volume of Microsoft every single day, and Microsoft's 75% bigger. It shows you there's a fever. It doesn't mean it's breaking.
Does it continue to though astound you, Mike, when the stock was not It was 600 bucks not that long ago.
Yeah.
Now we're over 700 bucks, and price targets continue to
Until
elevate
the
by
earnings
day.
momentum flags, until you have analysts who have a reason for stop raising the numbers, it's probably not going to matter, right? I mean, and even the collective price target is not even for any upside because it's going to outrun the analysts' objectives.
Guys, you'll stay. Ed, thank you so much for
you.
coming on. Ed Yardeni, we'll see what happens with this market. I know we'll talk to you in the days ahead. Up next, all over this major milestone for the S&P into the close. Can it get there? Can it get to 5,000? Can it close above it? We'll track every move for you right up to the end of the trading session. We do have earnings as well coming in over time. We'll talk about the key themes, the key companies that are reporting when we come back.
$15 more minutes. Be right back.
Well, we're less than 15 minutes from the close, and we are all over this big market move today as the S&P 500 closes in on 5,000 for the very first time. Plus, coming up, we do have Disney on deck. We have top media analyst Laura Martin standing by with what she'll be watching into that print. Closing bell comes back after this break. We're less than 10 minutes away from Disney earnings in overtime tonight. Here to break down the setup ahead of that print, Needham's Laura Martin. Laura, welcome. You're not that enthusiastic about the stock. It's had a nice run now into what's going to happen tonight. What should we expect here?
Okay, so we think he's going to have a good quarter because it's the last earnings before he has a vote on his board. And if he wants to get his board reelected and not the activists, he better over-deliver estimates. We're looking for $24 billion on the top line, which is 3% growth in revenue, and $1.02, which is 3% growth at the EPS line. I expect them to over-deliver. I think the things most likely to move the stock, assuming he can do that on the financials, is what are the losses in the DTC business, so the streaming business, and is he still going to break even by the end of the year in direct-to-consumer, because that is the biggest thing weighing on earnings per share growth. And secondly, we have a new CFO here. And so will that CFO commit to higher cost cutting than the $7.5 billion that Bob Iger has already committed to in the past? Those are the things that are most likely to move the stock up if they commit to those.
See, I was going to ask you about that. It's sort of bridging the gap between wanting to cut costs, but also acknowledging that they do need new content. How do they navigate that?
So the problem with content, it takes 18 months to make, and he's fighting for his life at the board. Like, he really doesn't want activists. So I would say that he's going to be more short-term oriented and really focus on this quarter and the next quarter in 2024. And he has to invest in content, but as you know, film content and TV content is many quarters in the future. And if he doesn't sort of win in the short term, he's going to have a really difficult long term here.
Laura, I appreciate your time very much. We got to run. We'll see what happens. By the way, the he is Bob Iger, of course, the CEO, and we have a CNBC exclusive with him this evening, 4 o'clock Eastern on Overtime. Don't miss that with Bob Iger of Disney. We're all over the move in the S&P as we edge towards the close. Josh Brown and Mike Santoli are here with me to break it all down in those crucial last moments. Market Zone's next.
Well, we got a few more minutes left. Another exciting day. Damn. SPX, we come real close to hitting it within 11 cents. So that's a big number. That one guy mentioned 54. I hear him right? About time for the bell. 5 more minutes.
We're now in the closing bell market zone. CNBC's Mike Santoli. I was expecting to see that pop up first. It was like Ritholtz, Josh Brown.
Yeah,
Yes,
you got it the right way. Don't worry about it.
Exactly. No offense. No offense. You know who's here. There's Josh. There's Mike. All right, we're all on the same page now. To say we were close was an understatement. 49.99.89, Michael, is where we got to on the S&P 500 before we backed off a little bit.
Yeah, I mean, sometimes, of course, it does get a little bit asymptotic here at the round numbers. You have an obvious place where you'd say, fine, that would be a stop. We'll see if it does, get through by the close or just soon thereafter. The bigger picture doesn't change much. Super persistent rally. It keeps finding a way. It rotates away from danger. Yep, it's getting extended absolutely in the short term. Usually the back half of February brings a little bit of a choppy surprise. But for now, it's tough to argue. By the way, equal weight industrials up 1% today. They're at a new high too. It's not just megatech.
Yeah, I was going to say, if it doesn't happen today, it's okay. I don't have the hats printed yet anyway. Agreeing with Mike, though, one of the things about the rotation beneath the surface that we debated earlier this week, it's not really as strong of a rotation as you would like to see, and you really want to see those internals turn back around. Today might have been a turning point. We'll see if you get follow through tomorrow. But I don't think we want to have a scenario where, absent the defensive areas, we only have one or two S&P sectors itself making its own all-time highs. We need more. Maybe we get more. One day does not a trend make.
Yeah, the Russell, Mike, it's hard not to notice, right? We see on the right-hand side of our screen, S&P, Dow, NASDAQ looking great today.
No fun.
And the Russell's no play.
Right. There is still a little bit of a shadow over financials. It's not a broadly inclusive rally. This is not the economy's reaccelerating and it's happening in this disinflationary way and everybody's going to lift because somehow we got the fountain of youth and the economic cycle is now back to an early stage. It's not there. Again, broadening out can happen in a bunch of different ways, and it can happen in part by most consumer cyclical stocks managing to do pretty well, which they have been, even as they go over this overhang of consumer card delinquencies rising toward pre-pandemic norms and all the rest of it. So I don't think we have to worry about running out of things to worry about. And one of the things that, as I said before, investors have gotten themselves concerned about is the very concentration of this market. And it almost rebuilds the wall of worry because if professional investors have a hard time trusting a market fully, that seems like it's just these huge names doing their own thing.
You talk about these things to worry about, and then we, sort of made the comparisons between now and 1999 and how it ended and what it meant for the market in the subsequent years ahead. New York Community Bank, obviously, people think of, banking issues. They bring up, oh, is this the next big systemic risk? Is it another 08? It doesn't have to be another 08. It can still have issues for this market that are yet to be reconciled. We just don't truly know what they are.
We don't know. It's as people have said, it's very idiosyncratic to a degree in terms of the kinds of assets that NYCB had. It seems like a botched thing to let them be the acquirer of some of the other troubled banks. But I pointed out earlier, the Silicon Valley Bank